Revenue rise to beat Wall Street. UBS and Stand Chart with announcements on buybacks. So that's the banks. Then we've got tech in focus as well, because the questions about AI capex renewed by the response to the SK Hynix numbers. And then luxury in focus. Alex Morgan flagged for us the Kering results, signs of progress, reviving sales at Gucci. Does this boost the sector more broadly at the open this morning, Anna?
Yeah, absolutely. So all of those sectors very much in focus, and might we see some fairly substantial movement in individual stocks, even if the top line story on these markets doesn't tell us anything particularly exciting. But we have so many earnings stories to factor in here that could result in some single stock volatility. Let's have a look at where we are at the start of the trading day then. This Wednesday morning, the FTSE 100 first out of the gates, up by 0.2%. Sadly, we have returned to kinetic activity in the Middle East. We've seen Iran launching attacks that failed to make contact, it would seem, with US bases in the region. That's pushed oil prices higher. That gives London perhaps another leg up in terms of the energy names. We'll watch if that is in the driving seat, or whether it's further rotation away from tech themes that is boosting some of the FTSE names. The Stock 600 as a whole then up by around 0.1%. The AEX up 0.1%. The IBEX pretty flat. Of course, we're waiting for the Fed and the Fed rate decision a little bit later on today, Lizzie, which has a lot of uncertainty attached to it. But in the meantime, digesting these earnings stories and not moving very far at the overall index level. What do you see then on the sectors?
Well, if we break it down, we've got about 3/4 in positive territory this morning, and basic resources and energy, as expected, leading the gains this morning. So basic resources up 1.5%, energy up 1.3%. As you say, we have got a higher oil price this morning off the back of the latest in the Middle East. Brent up 3.6% at $87 a barrel. So surprise, surprise, that is boosting the FTSE. Outsized gains of 0.4%, and energy near the top of the leaderboard. Tech, as we would have expected, at the bottom of the basket, down 0.7% this morning, off the back of the broader sentiment that we've already seen in the Asian session, the Kospi down, that spreading more broadly, and Nasdaq futures back in the red as well, down 0.1%. Now, if we look at some of those individual names that we had been flagging, Standard Chartered off the back of their results, Bill Winters will be pleased with this, up more than 2%. UBS up 1.7%, waiting for Deutsche Bank to open. But ASM International, right, down more than 5.5% as things stand. We were speaking to their boss earlier, their outlook beating estimates, and yet those shares in the red at the moment, Anna.
Yeah, it did seem as if the ADRs were a little weaker after those numbers dropped last night over in the United States, and there did seem to be some concern around the second quarter, despite the very positive story that they're telling and the upgrade that we got to the sort of forward-looking numbers. Interesting on the individual names then, EssilorLuxottica moves higher, Glencore moves higher, Process BASF, we had numbers out of BASF a little earlier on. Hermes is one of the big fallers then this morning, and we had numbers out of Hermes, didn't we? And their conversation around China a little more nuanced perhaps than the one that we got from Gucci. ASML down by 1.9%. GSK, numbers through from GSK yesterday, and that stock is just on the back foot this morning.
Well, let's get some analysis now. We can speak to Marina Zavolok, who is Chief European Equity Strategist over at Morgan Stanley. She joins us around the desk now. Marina, great to have you back. I want to start there with this China theme, because it's touched luxury across the board, from Mercedes to Kering on the upside. What do you make of it? Are we at an inflection point?
No, it doesn't. I mean, that's what luxury results are telling you. China continues to be a drag, whether it's through competition or through direct exposure and lack of, a meaningful consumer recovery. I think stabilization in the China consumer, which some of the luxury names are pointing to, is not enough to drive a V-shaped recovery. It's not enough to sustain the multiples that we still have in the luxury sector.
But is it how you play it? We're waiting for Kering shares to open, but Luca De Meo yesterday saying that it's the upside. There is an upside there if you do it right.
Yes. So interestingly, so we've been underweight luxury in our model, and it's been at the bottom of our model for years now. But what's happened in the last, let's say, 9 months or so is that we used to have all of the luxury stocks in the bottom of our screens. Now there's much more dispersion in the sector. So I agree with you. There's some heavyweights in that sector that are still dragging down the sector overall. And then you have some idiosyncratic story, be it new designers, new kind of lines.
Erling Haaland carrying
exactly.
a handbag.
Yeah.
It's all a bit unpredictable on that front.
And you have strength elsewhere. So the US is helping.
So if we take a step back from the luxury space, we've got Kering open now. It's up by 9%. So just to sort of tie a bow around that conversation, there we are. Kering is benefiting where Hermes is maybe not this morning. So that's the luxury story. If we take a step back, though, Marina, going into this earnings season, you were quite constructive. Targets have been increasing. How do you feel now we're getting into it properly?
I mean, this is a great earnings season for Europe. It's also good for the US, but I haven't seen such a strong earnings season in Europe in years. Earnings revisions breadth has shot up to the high teens. So the net percent of analysts upgrading their numbers is very high. It's higher than the US now. If you look at earnings revisions by sector, almost every sector is now in the green, by the way, including luxury, which is unusual. And we have earnings growth consensus for this year. I think some people drop off their chair when they hear this, but it's 17%. I mean, Europe normally does 0 or 1%. We're doing 17% growth this year.
Yeah.
So we're seeing more interest in European equities, in part because of the strong earnings season that we're seeing.
And so is there one factor driving the strength? That's incredibly broad, isn't it, that statistic?
Yeah,
or is it all
it's a
focused
combination of
in one
factors. I would break it down into a few, so 3 main ones. So number one, AI. We do have some AI. I know that there's been a sell-off recently, but it is still driving earnings strength in Europe. And I think Europe was kind of lagging that earnings strength in the US, and now it's coming through. So AI is the top of earnings revisions breadth still. You have the banks, which are coming through very strong, higher yields, steeper curves, higher oil prices. This all helps the banks as long as we stay out of a recession. So banks are very strong. And then, to your point, there's broadening. So it's happening across sectors. And one stat I've been pointing out a lot is that Europe actually benefits from inflation as long as we're not in a recession, because 60% of our earnings pie is real assets, banks, compute, all areas that benefit from inflation. So we're seeing that rise the tide.
Yes, if you've got the pricing power to deal with the inflation, then yeah.
Okay, so like a really fine line to tread there, really, if you're trying to get between inflation and recession risks. Just on the AI theme, though, how do you play it more specifically?
Well, I mean, it's all kind of acting as if it's one trade right now, globally, the AI trade. We still like European semis. We still like some of the larger cap goods, which are very AI heavy. We're overweight. Obviously, it's been painful recently. But I mean, one thing I would say is that we typically get poor seasonality and momentum in the summer. This is unusual, this level of seasonality. The last time we saw this was 2022, this unwind in top momentum and rally in the bottom momentum. But typically in August, we start to come through that. So I am hopeful that you start to see a recovery in the AI trade in August, and we would play that through European semis and cap goods.
And how are you positioning around the war uncertainty?
I mean, we expect this to be, let's call it a volatile de-escalation. And we expect oil to come back down to around the $75 level ultimately, but not in a straight line. It's going to be choppy. And for Europe, actually, if oil stays in the 70 to 100 range, that's out of recession territory, but that's still driving moderate inflation, that's actually the sweet spot for European equities. And I've been saying that since the Iran escalation began. And that's what we're seeing in earnings right now.
And we're seeing that in the earnings story. Sticking with other sectors that I think you like, or at least you did like in June, it'd be good to get your updated view, Marina. The banking sector, the mining sector, where do you see most, I don't know, where are things mispriced and the opportunities the biggest, do you think?
Yeah, the banking sector we still like. That's a steady grind higher. You have kind of almost like a profit bonanza at these level of yields. Again, as long as this AI unwind doesn't broaden to other sectors. And then we're starting to see flows coming back into Europe. And the banks, when we start to see these flows come back on the broadening, banks are typically the #1 beneficiary of those flows. But then beyond the banks, we're overweight mining, we're overweight utilities, telecoms. But we published a piece a few weeks ago where we made the point that the market is so idiosyncratic, and it's almost better to choose those few luxury names that actually have idiosyncratic drivers, those few staple names that have idiosyncratic drivers. And that's what we're seeing is a lot of interest in diversifying across all sectors and the best stock within sectors.
What do you think that diversification rotation story looks like, or breadth story looks like into the second half of the year then, Marina? Is Europe's to play for? Is this something that Europe can really benefit from?
I think this is partly seasonal and tactical. I mean, we've been calling for diversification. At this point, if we look at breadth, we are on a 3-month measure, we're halfway back to the peak. So we started around the time the MOU was signed and before this tech sell-off began, we started at historical low levels of breadth in the market. Now I just heard you say 75% of stocks are outperforming today. So breadth is very high. I think when we get to that peak of breadth, we're halfway there, then we start to see a narrowing again in the market. Okay. That's typically what happens.
Marina, thank you very much. Thanks for joining us. Marina Zavalok, Morgan Stanley Chief European Equity Strategist. Let's dive into a few core names that we keep across here in Europe. We've got ASML down by 0.8%. That's the technology thing, which is an area of weakness this morning, along with Schneider Electric. Sometimes they are linked. Nestle up 0.5%. LVMH getting a boost, perhaps from Caring, not being dragged down by Hermes, and that stock is up by just shy of 3%. That seems to be the biggest mover amongst the core 6. Let's get to some of the other individual stocks that are on the move this morning. Alex Morgan has a breakdown. Alex.
Well, I would, I'm loath to talk about luxury in the company of the two of you, given you know so much more about it, but I'm going to start with Caring. That's because they really are leading the pack this morning. Out of the gates, up now, you can see 11% this morning. And yes, that is on the earnings, pointing to a recovery for Gucci. Still not the full story that they want to get to, of course, as part of the turnaround plan. There is also Yves Saint Laurent in there, but it is Gucci that makes up more than half of Caring's profits. And the turnaround there, you can see, really being warmly welcomed by the market this morning. We got a sense that might be coming from a trade gate earlier, but here we are now, up around 11% this morning. Let's turn it over to tech, though. Different picture. Now, this is, as you were saying earlier, that read across from Asia, the SK Hynix disappointment. You can see the companies touched in Europe in the semiconductor space down. And there's also that broader concern that you're talking about day in, day out about the worries about circular funding, the AI model. So you can see a read across from Asia to European chip makers and those involved in the European chip sector. Let's flip it over to to miners. Let's get to miners here. Rio Tinto and Glencore both in the green this morning, of course, talking about commodity prices. A part of that, you can see Rio Tinto up around 2%, Glencore around 4%. Now let's get to Danone as well. Have a look at how they are doing. Down around 3%. Some earnings are also out this morning. ENI, though, in other news, on the back of talking up a share buyback scheme, we're seeing them around 5% in the green this morning. But really the big name that we're talking about is Caring, up more than 10%. And that's coming off the back of those warm words about Gucci's recovery. All
right, Alex, thank you very much. That's Bloomberg's Alex Morgan. And coming up, we will get back to the banking story, earnings out of that as well. UBS rising on the back of a strong quarter as wealth management assets beat estimates and trading revenue surged. Stay with us for that. This is Bloomberg.
you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Look, if I look at the macro picture, the geopolitical picture, the ongoing debates, also the big dispersion we see in equity markets, and the pressures and on energy prices creates potential headwinds on inflation, and that may turn out to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
The UBS CEO, Sergio Amotti, speaking there to Guy Johnson, of course, a little bit earlier. UBS shares then this morning, we'll put those up on the screen. You can see the response in the market, up by 2.4%. The bank has announced a new $3 billion share buyback program to run until mid next year, and has posted net income of $2.8 billion for the second quarter, beating expectations. In fact, beating expectations on lots of metrics this morning. Let's get to Guy, who is in Zurich after that interview with Sergio Amotti. So lots of numbers beating expectations. We haven't talked as much about the equities performance on this particular stock that maybe we did around Wall Street banks and others earlier on this week, Guy. So what's the equity story? How responsible is that for the beat?
It's huge. With all these banks, the equity performance has been very, very strong. We saw it yesterday with Barclays. Today, you're getting it with UBS. But how do these European banks stack up against their US peers? I think is a really interesting question. I think there is also a question around how heavily UBS is leaning on its equity business to sort of produce the kind of performance it's seeing at the moment. I think you probably look at the market reaction this morning and say, actually, there's not much in that argument. But some analysts are certainly pointing at the fact that equities did such heavy lifting here that it maybe affects the quality of the earnings. But European banks generally have underperformed their US peers. And why is that? Why is the number from UBS at 53% plus is really strong, but Wall Street did even better. So I talked to Sergio about this. Is it a capital issue? He says, no, actually, it's not a capital issue, because what we're seeing here is actually a sort of transactional story. It's about the volatility spikes he was just talking about. The volatility is a big driver of this. It's not about kind of providing more capital for this business. They gave it a little bit more capital, and maybe that sort of produced a better performance coming through here. But are European banks, are Swiss banks underperforming their US peers because of the lack of capital? Is there a cost to being a European bank? In particular, for UBS's case, is there a cost to being a Swiss bank? Now, that was a question I asked him, and he said firmly no. He said, he used the language, I'm very happy being a Swiss bank. We are very happy being a Swiss bank. And that's really important in the context of what is happening with the capital rules right now. Maybe a slightly friendlier tone coming through from Sergio Motti when it comes to those capital rules. So I think, yes, equity markets have been, the equity division has done really well here. Hasn't quite done as well as Wall Street, but there's a reason for that. And that is that this is a bank that is designed to serve its clients, not to be a trading platform. And that is maybe the reason. That's the opportunity cost that you have being a Swiss bank and being a big wealth manager. And that's the kind of the story that comes out here. And I think the market's responding quite well to that.
Yeah, the shares up nonetheless 2.3%. Guy, thank you for bringing us that interview. In Zurich, that's Bloomberg's Guy Johnson. Well, as he says, we've also had results out of Standard Chartered and Deutsche Bank this morning, both in the green. Stanchart announcing a $1 billion share buyback after its second quarter earnings beat expectations. I've been speaking to the CEO, Bill Winters, earlier on, and he told me that they're investing in growth.
We're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, yeah, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
Well, Bloomberg's Charlie Wells is with us to walk us through all of this, give us some more context. Charlie, how would you frame it all? It seems like good, better, best when it comes to European banks.
That's exactly right, Lizzie. So it's beats and buybacks that really have been the theme of the day. And I think the question really had been, what would this do to bank share prices? Because we saw similar results yesterday, and that actually did not bode well for the banks. But we're seeing a lot of green across the board today. What we're seeing here with Standard Chartered is the shares up well over 3% this morning. They had a really strong earnings report. I want to bring that up and talk about some of the key findings from that earnings report for Standard Chartered. They've got that $1 billion share buyback that we've been talking about. Of course, they had that beat, but we also saw a lot of strength coming from their wealth unit. Now, this was really important for Standard Chartered because there had been a lot of concern about Chinese authorities trying to limit the outflow of money from mainland China to places like Hong Kong. And we know Standard Chartered has a lot of exposure to Hong Kong. Let's bring up how Standard Chartered has been performing, because recently they've been hitting record highs, but I want to just show you why that wealth unit was so important. Look at that dip right there. Look at that dip in June. That is investor concern about what could happen on the back of that attempt to limit the outflow of money from China. So what we're seeing is a really solid recovery here, and we're seeing that wealth unit at Standard Chartered help to propel this bank forward. So that should be positive for Standard Chartered. Another big bank in Europe, that's Deutsche Bank. Let's bring up how they're performing this morning, because they have been in the green, and they certainly still are, up well over 5% this morning. So again, a strong showing on the back of these earnings. I want to bring up some of those key findings as well to explain some of this movement, some of the investor confidence in Deutsche Bank this morning. What really stood out here was fixed income trading, right? So we've seen across Europe a little bit of a mixed picture, some weakness in FIC at a number of these units, but actually what we saw from Deutsche Bank was outperformance. They were up in the quarter year over year 16%. Now that beat the average from Wall Street competitors who are up on average about 13%. So that's really important for Deutsche Bank. Why that's important? They don't have that equities trading exposure, backed out of that in 2019. So FIC is really crucial for Deutsche Bank, and they really outperformed there. Also buyback, we've been talking a lot about buybacks. They've got that 500 million euro buyback, and then they also confirmed their revenue outlook. Now this is really important for Deutsche Bank because they've had a huge valuation gap compared to a lot of other European lenders. Look at this gap. That white is other major banks in Europe. That orange is Deutsche Bank. So Christian Selig really trying to close that gap. These results should help.
Charlie, thanks very much. Charlie Wells with a breakdown of the banking sector reporting season. Let's get to luxury then, where Kering shares are surging this morning. This after the luxury company reported that sales at Gucci came in better than expected in the second quarter. The move is sparking optimism that a long-awaited turnaround at Kering's largest brand is starting to take shape. Let's get into the detail here with Bloomberg opinion columnist Andrea Felsted. Let's start with Kering because we've had other numbers. Good morning, Andrea. I mean, this is fascinating, isn't it? That big pop higher in the share price on the back of Gucci revenue that didn't turn positive year on year. It was better than expected, and it's more in line with the pack, more in line with what others are doing.
That's right. I mean, Gucci's been really struggling, and it looks like it's going in the right direction. It's not growing yet, but it's less bad than it was, and it's less bad than is expected. So the market's taken that as a sign that perhaps the Gucci turnaround, which is so crucial to Kering, is working.
I don't get it. Is it Demna? I mean, look at the fate of Hermes, right? Weathering the downturn in demand better than its peers, but you would expect Hermes, its shares are down, right? What about the Haaland effect that you've been writing about?
I know. I think Hermes has really got a boost from all these footballers carrying these big Hermes bags, because there was a sense that particularly the Kelly and the Birkin has got a bit overexposed. There were lots of them around on resale sites, and they'd really kind of lost a bit of their cachet. And I think the footballers all carrying the Hermes bags has kind of helped their brand value. I got some data, and it showed that actually Erling Haaland carrying the Birkin and the Hack, which isn't a Birkin but it's like a Birkin, has actually added $8.8 million to their brand value.
Carrying all sorts of things in that photo. pretty weird stuff. But lingering on Hermes and the China effect, I suppose, more broadly, they've said some nuanced things about China. I wonder if that's where they come unstuck, because they said they see stabilisation in China, but no fundamental rebound. And I mean, that, for a lot of these companies, has been a big headwind. We're going to talk to an economist, actually, a little bit later on in the programme. The Chinese consumer is just sitting back.
Exactly. That's been the picture for all of the brands. They've all said, you know, China's sort of stable. We're not seeing the big upswing. Now, what's happened is the US and to some extent South Korea has really made up for that stability, because the wealth effect from AI, roaring stock markets, that's
you see that in luxury sales in South
Korea,
do you?
Absolutely,
right.
Yes, and Japan to some extent as well. But I mean, particularly in the US, US demand tends to be correlated with stock markets. So the stock market's been doing so well till recently, at least, that they've been spending. Now, the big worry is the sort of some of the sell-offs we've seen. If that spreads, that equity market story isn't as strong, then that could be a real break on spending. And you've got China not coming back yet, so that's really the worry.
That's really interesting. I want to hear more some other time about the difference in taste between Koreans, Chinese and Japanese within the Asian market. But for now, Andrea, great to have you back. Bloomberg opinion columnist Andrea Felsted on the latest in the luxury sector. Coming up, though, we are going to turn to the Fed. It is Fed Day, lest you forget, given all these earnings, but a lack of clarity from Fed Chair Kevin Warsh on the future path for rates, really keeping investors on edge. And we're going to discuss today's US rate decision with the HSBC Global Chief Economist, Janet Henry. She'll be with us next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. You know, it's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. It's Wednesday morning. We're 30 minutes into Wednesday's session here for European stocks. And we're factoring in a lot of corporate earnings, and some of them are really positive. We're seeing some outperformance in some of the luxury names, even consumer white goods, those kind of businesses. We've got some really interesting upside stories. But this is the overall picture before Lizzie gets to some of that detail. So the Stocks Europe 600 up by 0.2% as we factor in the earnings. Also factoring in a higher oil price. Sadly, a return to some violence in the Middle East over the past 24 hours. That means the oil price is up by around 3-4% this morning. The FTSE 100 benefiting from that as we see some of the oil majors moving a little bit higher. And we do see broadly FTSE outperformance this morning. The DAX up by 0.2%. That's the broad picture then, Lizzie, across these European equity markets as we wait for the Fed. That still lies ahead for us. And we wait for big tech earnings. That's going to be really interesting for markets. After SK Hynix, we move on to some of the other big names over in the US. But what have you got in the European session?
Well, Anna, you can tell that it's a busy day for earnings because the balance of Stock 600 members is to the downside, 310 in the red. But as you say, at the headline level, the Stock 600 is up today. Volumes higher as well, up 21%. So let's take a look at some of those individual movers that are distorting the picture, perhaps. So Kering up more than 10%. We were just discussing with Alex Morgan. We've had Gucci's better than expected sales, sending those shares higher. A margin beat also for EssilorLuxottica. Of course, we've seen the combination with Ray-Ban when it comes with other brands when it comes to their smart glasses, and UBS shares out alongside a raft of other banks this morning, Deutsche and Stanchart, but announcing a buyback plan, as did Stanchart, as that investment bank division has surged, so up 2.7% for UBS. But here are the laggards this morning. We've talked about the broader tech theme, results from ASM International, and shares falling 7.8% despite those results. Logitech sliding as well, nearly 6%, a supplier incident hitting sales, and Hermes in the luxury space, the opposite to the Kering story, down 3.4%, Hannah.
So luxury moving in two different directions. Let's step away from the earnings stories for a moment and get an update on some of the other stories that we are following this morning. Oil has jumped after the US said it intercepted an attack on American military bases in the Middle East. US Central Command also said US and Saudi forces had carried out strikes on Iran-backed militants in Iraq in response to attempted drone attacks on US forces. The attacks end days of relative calm and cast a shadow over diplomatic efforts to end the conflict. SK Hynix has earmarked at least $31 billion in capital expenditure this year after reporting a six-fold surge in quarterly profit, a record outlay that coincides with growing fears about overinvestment in AI capacity. And the Federal Reserve is out with its latest policy decision later today. It is Fed Day. The central bank is expected to keep interest rates on hold when it concludes its two-day meeting. But market participants are eyeing the possibility of a surprise hike as patience with high inflation inflation wears thin. A lot of anticipation then ahead of a pretty uncertain Fed today, Lizzie.
Yeah, which is perhaps the point when you take away so much of the forward guidance. Let's get another view on the Fed today. Janet Henry, Chief Global Economist over at HSBC, joins us round the desk. Janet, great to have you back. What's your view? Are we going to have a surprise hike from the Fed today? Does it need to have a surprise hike for credibility purposes?
Good morning. No, is the short answer. I would very much doubt we get a surprise hike. I mean, the market's got about a 30% probability of a rate rise. If anything, I think the likelihood of a rate rise is less than 30%. We don't get forward guidance. We'll get a lot of words in the press conference. I'm sure it'll be another frustrating one for all the journalists asking the new Fed chair the various questions, but I think it's extremely unlikely.
But why is it unlikely when we've had oil topping $100 a barrel? Tensions in the Middle East just seem to flare up again and again and again, even if there's this kind of sense of inevitability that things will die down ahead of the midterms. Again, we're reminded that they haven't yet.
I'm not saying necessarily what they should do. I'm saying what I think they will do. And I think Walsh was quite clear at the last press conference. Obviously, he made it clear there's going to be no forward guidance. The committee are split. Half of them said there was a likelihood of a rate rise by the end of the year. Half of them had rates basically on hold. But you've got to remember, a lot of those members of the FOMC, earlier in the year, they were all saying that rates were actually going to be cut. And you did also get a lot of words regarding credibility. So I think the data that we've had since then has been actually slightly softer labour market data. It's been slightly lower inflation data. So we will hear a lot about credibility. So some really quite hawkish language, but still all the usual noise regarding AI, future potential disinflationary impacts of AI. And of course, we want to tighten the balance, shrink the balance sheet, but you'll have to wait for that. I would be surprised if a newly appointed Fed chair steered the committee towards a rate rise in the space of 1 month when the data has provided some comfort, but keep sending the signal. It's not up to us to tell you what our next move will be. We'll look at the data and we're willing to, as our #1 credibility factor, meet our inflation mandate, but the implication will be not right now.
So a hawkish hold then is what we're what you're expecting.
Yeah.
So that's the overall expectation. What about the task forces? Is he going to hide behind all of these task forces once again instead of commenting on anything that's particularly tricky? How many times, Janet, are we going to hear there's a task force for that?
You're going to be hearing that for at least the next 3 to 6 months. It really will be. We'll be having these same discussions at every meeting. And, we'll then be thinking about Jackson Hole in August, and then the next dot plot that will not include Chair Walsh's dot for future interest rate expectations in September. So I think September will be the immediate focus. But it will be all these questions regarding inflation. Is it core PCE? Is it trimmed core PCE? He'll say there's no perfect measure, which is why I've got a task force for that. It's because we need a new inflation framework. And the balance sheet, we need a task force. And then FOMC members will move on it. So, yes, you're going to keep hearing about the task force.
It's funny that the Bank of England borrowed Ben Bernanke and the Fed's borrowing Mervyn King.
Yes, indeed. All of these legends of central banking travelling around a little bit to share their expertise. And thinking, moving on to the Bank of England then, and thinking about what we get there. We're used to dissent at the BOE. Maybe it's a little newer at the Fed. Are we going to get quite a lot of dissent at the BOE this week, Janet, or just a little bit?
You're going to get dissent at the FOMC. I think you will get 2, maybe 3 FOMC members voting for a rate rise. And that's what markets will have to latch on, given they've got no forward guidance. For the Bank of England, you will still get a little bit more in the way of forward guidance. I think it's pretty much a done deal. You'll get 2 dissenters, the usuals. Hugh Pill has been the persistent dissenter, potentially Megan Green. It's possible you get a 3rd with Catherine Mann, but I think we're expecting it to be 7-2. And there is an expectation, certainly a lot of sell-side economists have been saying maybe we get more of a central forecast this time, which over the forecast horizon would actually have inflation a little bit below target in 2 years' time. But again, a hawkish a hawkish hold. We stand ready because we know that the tensions in the Middle East, if we do not get a full reopening of the Strait of Hormuz, the oil price will grind higher. We've already seen Chinese imports of oil, which have played we saw a dramatic decline in Chinese imports of oil, down about 40% year on year in June. They've already started to come back in terms of July. So there is that real binary outcome. Is oil going to 70, 75, or is oil on its way to 150 if we don't get this reopening?
And that having an impact fiscally as well. A report from NISA this morning saying that the new Prime Minister, Andy Burnham, faces a £24 billion squeeze from UK inflation. When you look at the fiscal situation, do you worry that the new Chancellor, John Healey, isn't going to be able to leave a credible amount of headroom against the fiscal rules, even if they can say, yes, we met them? Is it not going to be enough for markets?
Well, you're right. Markets do want to see a certain amount of headroom. Partly, they want to see more now, and against a backdrop where from recent years we've had a persistent reduction in the amount of fiscal headroom, but because we seem to be living in incredibly volatile times. We have been since COVID with these unpredictable moves. So when you've got this huge amount of volatility and uncertainty, yes, markets need to see more headroom, but also they need to see a plan, and they need to become confident that the difficult political choices are going to be taken regarding reining in spending or raising taxation or some combination of the two.
So you see that as inevitable? Tax rises, spending cuts?
I think, yes, there has to be some combination of the two, and it's no use saying, well, we'll do all of that in year 5 of the fiscal plan by keep saying, well, by 2029, 2030, debt to GDP will be on a declining trend.
Yeah, we typically in the UK expected a lot in the future, haven't we, in terms of that fiscal consolidation. Let me just dip into some micro news to ask you a macro question. And this is BMW, a headline from BMW this morning, then a red headline on the Bloomberg terminal, Janet, saying that BMW is offering severance packages to thousands of its German staff. I mean, this just taps into the underlying weakness of the auto sector. It's a sector that's trying to pivot to all sorts of things, to defence and supplying other parts of the German landscape. I wonder your expectations for the German economy, given we keep hearing from lots of corporates about higher energy prices weighing on European manufacturing and European industrials. But at the same time, the German fiscal engine is now up and spending quite a lot of money on defence and infrastructure. What is the outlook for the German economy, do you think, right now, Janet?
Well, I think the kind of potential growth rate of an economy that has lost quite a lot of competitiveness over the course of the last decade, that has been very dependent on the auto industry in particular, and now they face enormous competition globally, and obviously they're not at the forefront of electric vehicles. They've got those structural headwinds as well as the demographic challenges. So the kind of speed limit for growth without igniting inflation is very low for Germany. Maybe it's 0.5%, if that. So that's your base case. And now we have got the fiscal spending on top of it. So while you may have had the excitement a year or more ago regarding the role of fiscal policy, everything takes a bit longer. We think it will be adding to growth, but exports are not going to be the engine for it. I think world trade growth is going to be a bit weaker. So, yeah, it will be the usual story of a quarter slightly up, a quarter slightly down. We have got a mild technical recession in our outlook for Germany.
OK, Janet, thank you very much. Thanks for joining us. Janet Henry, HSBC's Global Chief Economist, going around the world with us there. Back to the UK, though, on a programming note, the opening trade will have special coverage of the Bank of England's rate decision. Don't miss the BOE decides, 12:30 p.m. That's tomorrow, isn't it, Lizzie?
Oh, come round quick. You'll be kicking me out to stand in the heat wave. But coming up here on the opening trade, a tech sell-off deepens on AI spending fears ahead of Microsoft and Meta's results. So we'll get more on those next. This is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We're turning the corner. I tell my team we haven't quite finished turning the corner. We've got more work to do, but I am pleased with the progress so far. We're ramping up production across many of our product lines. Markets are very strong, so our backlog is very, very strong. So our story is really focusing on executing that backlog.
That was the Boeing CEO, Kelly Ortberg, there, speaking with Guy at the Farnborough Air Show. And the context this week for the aviation coverage is that the plane maker Boeing was out with results just yesterday, reporting a better-than-expected cash flow in the second quarter on continued strong demand for its aircraft. We're now looking ahead, though, to Airbus earnings due aftermarket today. Let's get a preview of what to expect. Benny Camel joins us, Bloomberg's managing editor for space and aviation. Benny, let's start with the civil side of things. I'd seen some headlines broadly, not Airbus specifically, but broadly around Farnborough, that maybe there hadn't been as many announcements of purchases of aircraft as some had been expecting. What do you expect on the civil side from Airbus?
So it looks like things are looking up, and we heard just now from Kelly Ortberg, who said we are turning the corner, and that is sort of the overarching theme really for the industry. This is an industry that has been through tough times over the past couple of years. COVID obviously was the big cruncher, but then in the post-COVID era, we had supply shortages. We've now most recently had the wobbles from the rising fuel prices. That's sort of dampened supply or demand rather, and so all these things combined have led to a slightly problematic picture for Boeing and for Airbus, but to use Kelly Ortberg's words, they are turning the corner, and that's the sort of optimism that we heard from Boeing yesterday during their earnings. As you said, better than expected numbers, and it's also what we expect to hear from Airbus today. They gave a little bit of a teaser last week at the air show where they came out with long-term targets, and those are generally very well received. They think they can double profit, and the biggest part of that will come from the civil side. So Airbus is best known for its planes. They also make helicopters, they make rockets, they make defense material, but really the civil side is what's going to push the performance of this company, and that's what we'll focus on tonight.
Well, how healthy do you think the outlook will be for the defence side, Benny? Because, we talked a lot during Farnborough about the appointment as Chancellor of the ex-Defence Secretary here in the UK. We've talked a lot about defence spending across Europe and tensions rising in the Middle East. Where does that leave Airbus?
Well, one big question that has come up and that was discussed in Farnborough is how much can Europe sort of assert its own sort of dominance, and how can it create a sense of dominance for the region? How can they wean themselves, as it were, off the US? Obviously, the US is an important partner within NATO, but also as a provider of advanced weapons. But Europe is trying to sort of create its own environment for that, and Airbus plays a key role in that. It is one of the biggest defense manufacturers in the region, alongside companies like Rheinmetall here in Germany or BAE in the UK. And we have seen rising demand for defense products, and that is something that will feed through to the bottom line of Airbus. The defense business was traditionally very up and down, more down really than up over the years. Lots of charges, lots of things that didn't go right. And in the last couple of quarters, they have sort of found their stride. So again, something that we expect to see in the numbers tonight, a more upbeat picture, particularly on the civil side, but also the defense side certainly helps.
Okay, Benny, thank you very much. That's Bloomberg's Benedict Camel there. And stay with Bloomberg for an interview with the Airbus CFO, Thomas Terpfer, later on today.
Let's turn our attention to technology. We'll get a good read, perhaps, on the global tech landscape when two of the Mag 7, Microsoft and Meta, report their latest results later on today. Let's bring in Bloomberg senior strategist Neil Campling, who can get us set up for these big tech events yet to come. Neil, good morning. So what are the expectations around these two businesses? So far, it seems to me the market has not responded well to either higher CapEx or just incredibly large CapEx, based on the example of two, which is, what did we have, Alphabet and SK Hynix?
That's right. And I think the other thing to consider here is that two measures that the investors will demand to see are growth in terms of decent revenue growth to justify CapEx spend. But the other measure that we need to look out for, obviously, is free cash flow. And that's what kind of spooked some investors last week with Alphabet's first ever quarter of negative free cash flow. It's likely that Meta will have negative free cash flow tonight as well in their quarterly results, which may concern investors. And then the other way of scoping this out, of course, is that the CapEx increases that we're seeing. Now, a third of that CapEx being spent next year is expected to be on memory within that. So where you've got Hynix with its reports today and a six-fold increase in profit, at the same time, 50% increase in their own CapEx. So there's all these different sort of these data points which are necessarily inflationary in the short term and takes a long time to feed through in terms of the guidance for that spend.
Neil, you've also got all these fears about circular funding rearing their head again. We were speaking to the ASM International CEO earlier on about those concerns. Just take a listen to what he had to say.
The semiconductor cycle is the name of the game. And it's something that's very normal. But what's very important is that the fundamentals for AI in the medium and long term are still there. So we're really not concerned from this point of view. And as far as we're concerned, okay, what's happening is that the need for leading edge technology is going to continue unabated for a company like us. It's being driven right now by AI, and it's needed to be driven by AI.
Do you agree with that from Hichem, that the fundamentals for chip stocks are still strong?
Today, yes, but chips are cyclical. And if you're an equipment company, you're not going to see a change in the demand dynamics from your customers for a year or 2 years' time, but those can change. And if we look at historically, if you're looking at these stocks on a price book basis, they are elevated relative to trends. So the fundamentals are strong at the moment. In the meantime, token prices are coming down significantly, which means, and tech should be deflationary by nature in terms of its use over the long term. So to get ubiquity in terms of usage, you have to see pricing coming lower. And at some point in time in the future, visibility will reduce and demand could have issues for the chip equipment companies.
That AI inflation link, we might hear more about that later on from the Fed. Thanks very much, Neil. Bloomberg's Neil Campling. Let's take a closer look at the markets then with the Fed in mind. Skylar Montgomery-Koenig joins us from our Markets Live team. Skylar, I will ask you about the Fed then, because it's Fed Day and we haven't talked as much about it because, of course, we've got a lot of earnings to deal with. But the market has been well, it's been quite exciting, hasn't it, to watch market pricing around a Fed hike, because I think we're suggesting that there's going to be a hold, but there's been 30-40% expectation of a hike this week. I mean, that's not nothing.
Yeah, exactly. It feels like a very binary outcome today in terms of, on the one hand, you have consensus very much saying it'll be a hold. You had a softer inflation print in June that should, in theory, give them some space. And they've been on hold for so long that you'd think that would be a natural progression before you had more data, particularly because in September you get another forecasting round. You have 2 more big data rounds before then to look at. But I think on the other hand, you have market pricing kind of pushing it in the direction of a hike, because there's this idea that Warsh will want to shore up his inflation fighting credibility, that inflation is already 2 times target, and you have a resilient economy. I think today that very much moves pricing in terms of it's a wobble for the dollar, it's lower yields if you have that hike not delivered. If the hike is delivered, it's very problematic for equities. It means a stronger dollar, higher yields. I think longer term, though, it doesn't matter as much, right? We know where the direction of policy goes. It's whether or not that hike comes today. So it's a timing issue, not a direction issue.
Okay, and obviously it comes back to the oil price in large part. You say that the path of least resistance for oil is upwards. Why?
I'm absolutely so puzzled by why we aren't higher now. In terms of last week, we were at $100 a barrel. Now, that came down over the weekend because U.S. and Iran stopped fighting. Overnight, they started again. And the big things that got us there are still in place, in that there's not ships transiting through the Strait of Hormuz. You have worries around energy infrastructure still being targeted. And the big development last week for me was the fact that Saudi facilities were being targeted. And so that didn't even stop over the weekend in terms of some of your big facilities on the East-West pipeline that have a lot of the kind of release valve or helped in terms of mitigating factors for Hormuz closing. That's now under threat. And so I really think even if you just get a continuation of the current pace where reserves have drawn down quite considerably, nothing's going through, the bias is higher oil prices.
Skylar, we're heading towards the end of the month, aren't we? The end of July. Does that, I mean, it's been volatile on the tech story, certainly in Asian markets, and to some degree in US markets as well. We've seen quite a lot of volatility, quite a lot of pullback. Does that get worse as we head towards the end of the month?
Yeah, I think for Korea, we're certainly not in a safe zone yet by any means in terms of, yes, we've fallen 40%, but I wouldn't even classify that as a bear market yet because we're not even oversold, right? If you look at an RSI measure, it's not oversold. Today, we just went through the 200-day moving average. If you look at leveraged ETF exposure, that's kind of undone half of what we had working up into this year. The good news is that the volatility hasn't spread to other markets, and that standard deviation moves in those markets are still pretty contained if you look at even NASDAQ tech-heavy stocks. I think the bad news is you are seeing more of that leakage into tech in terms of it's a global issue, what you're seeing, in that you have huge capex globally. Whether or not that translates into a return of investment is very much a global issue. You have increased Chinese competition. You have greater cost of capital. And so as we head into earnings this evening, we've seen that tech struggles even on very strong results. And we have big macro events into month end in the Fed and the Bank of Japan, et cetera.
Okay, well, NASDAQ futures just flat to the downside as we leave things. Skylar, thank you very much. Skylar Montgomery combing there from our Bloomberg Markets Live team. That does it for the opening trade. The Pulse is up next. Euro Stocks 600, currently flat as a pancake. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The tech rout deepens over growing fears of AI spending as SK Hynix slumps despite a massive jump in quarterly profit. Banks get a boost. UBS beats quarterly profit estimates, and Deutsche Bank's fixed income trading revenue jumps. Plus, oil rebounds as the U.S. says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's, Fed decision. So there is quite a lot going on in the markets. U.S. stocks seem to be on a rise. Traders holding off, though, doing any major bets ahead of U.S. interest rate decisions, but also earnings from Meta and Microsoft. Again, these earnings will be closely watched because they kind of also arrive at a time when the AI trade is really faltering, with a lot of traders questioning whether this vast spending behind the global build-out can actually deliver returns. And I'm looking at Brent, 87.31. It did briefly rise above $87 a barrel, rebounding from its biggest 3-day decline since April 2020, following a flare-up of violence in the Middle East. It's now at 87 it's still actually above 87. The picture in Europe is really one of watching what's happening with the Fed and the Strait of Hormuz. And you can see a little bit of, flatness for the DAX and the CAC, and then the FTSE is gaining 0.5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's a big day for earnings with some of Europe's major banks reporting. We'll tell you how they performed. Of course, it's also Fed Day, and we'll have a preview a little bit later. Now, geopolitics front and center, again, as the uneasy calm in the Middle East is shattered. But it's also the tech story that's, again, driving markets. SK Hynix shares down sharply today after second quarter operating profit missed estimates despite jumping more than 550%. Now, investors are concerned that the firm has earmarked at least $31 billion in capital spending this year. Microsoft will give an update on its data center spending later, while investors, of course, will also hear from Meta's efforts to build a cloud business. Well, we're now joined by Shona Ghosh, our EMEA tech editor. We're also joined, of course, and to discuss what it all means for markets with Natalia Lipikina, head of EMEA equity strategy at JP Morgan Private Bank. So thank you both for joining us. So look, SK Hynix is a little bit counterintuitive, Shona, because they had some good results, but the shares are getting slammed. Why?
The market's very irrational, transpires. So as you say, that operating income is up more than 500%. These are stellar results. The numbers across the board are excellent, but investors are increasingly concerned when they see capital expenditure from any company going up, particularly when that CapEx is a record, as it is in this instance. We've seen across other tech companies, not necessarily chip makers, Google moving into negative cash flow as a result of its rising CapEx. So these rising numbers are increasingly something that investors are scrutinizing alongside growing revenue and profit.
Natalia, when you look at the sector as a whole, what exactly is priced in at the moment?
Well, I think back to what you were saying, good morning, I think the market is just trying to rationalize and really scrutinize the CapEx increase and also what it means for the return on those investments. It can be revenues, it can be operating profit, it can be cloud growth, and I think such a big focus tonight and tomorrow as to what the companies will be delivering. To me, that's probably the story in the markets right now, and the market will definitely be looking into the free cash flow of what those companies are reporting.
But Shona, has anything changed? And if you go back to Google last week or SK Hynix today, it is about growing AI spending concerns. But we've had those. Is there a piece of news that the market is latching onto, or they're just going through numbers and are becoming restless in terms of the time frame it will take to build it out?
Yeah, so there have been reports that China, which is quite limited in terms of the cutting-edge US chips and European chip-making equipment that it has access to, is maybe able to produce somewhat cutting-edge, maybe more like mid-tier chip production machines on its own. These are DUV machines, which are mostly produced by ASML out of the Netherlands. ASML has also had stellar performance because it has a stranglehold on this element of the chip production market. But it's very bad news for ASML and some of its related suppliers, and perhaps the broader market, if China is able to produce its own chip-making machinery that could bolster the advances in its AI chips and therefore, be on par with the US and Europe, particularly the US, in terms of amazing AI models, cutting-edge tech. So far, it's a little behind, but we're seeing more and more with the release of K3, for example, the AI model that came out on Monday. These advances are happening quite rapidly. So any even quite small rumor that China is advancing can be enough to send the market sideways.
So I'll ask you in a second how the market or how investors should play this. But actually, what are you expecting from Microsoft and Meta that are reporting later?
Again, everyone will be watching CapEx very closely. These are two of the biggest spenders, both in terms of data center leases, so how long they'll sort of occupy a data center and the rent they'll pay, as well as CapEx building those data centers. And investors will be looking quite widely across the board because those costs are split out across different areas of the balance sheet. So I think you'll see quite close scrutiny of the expenditure there.
So Natalia, if you're an investor today, how do you look at AI? Do you still are there parts that are unloved, or has everything been bought and overbought?
We still do like the parts of the AI trade. So when we think about different sectors that will benefit, you have hyperscalers, and everyone is very focused on the return on those investments. And when you look into hyperscalers, they actually have underperformed this year. We think to have back that trade, you basically need the hyperscalers tonight, tomorrow, confirming that there is a return on these investments. We believe that if your time horizon is 1 year plus, you're probably in the good place to be. For semis, I think the story is slightly different. For semis, you need to have the confirmation that demand continues to rise. We truly believe and continue to believe that demand is still there. But at this point, I think the market just scrutinizes absolutely everything. And we need to see that there is still confirmation that demand is there. When I take a step back and think about what does it mean for markets, we're still constructive on the market. When we look into S&P, for example, we still see upside, 8,200 by mid-2027. We still think that we're in this super cycle, 20% earnings growth this year, double-digit next year, is still very solid. But this time of the year, the market is just scrutinizing everything that has to do with AI.
But Natalia, do you actually have to take a calculated bet on how far or how near China is on some of these models?
Well, it's interesting because it's not really the first time we're hearing these concerns. We had these concerns a couple of years ago. So yes, it is concerning, but at the same time, this is not a new thing. And again, coming back to the point that I made, I just think that the market tries to find every single thing that can go wrong with the AI at this point.
Shona, I mean, the other big thing which happened 10 days ago, which we're still talking about, is some of these models, especially this latest OpenAI model, inadvertently hacking other platforms, Hugging Face. I mean, have we gone to the bottom of exactly what happened, whether it was prompts that weren't good enough, or can we make sure that it doesn't happen again?
We haven't got to the bottom of what happened, and actually more news keeps emerging. So we learned overnight that a sandboxing platform called Modal was also compromised by these models. A little unclear how that tied in directly to the Hugging Face attack, but we know, I think it's likely we will hear about these two particular models that, hesitate to use the term broke out, but sort of went beyond their instructions, let's say, and hacked Hugging Face. I think we'll hear about other platforms being compromised too, but the news is emerging piecemeal, possibly because some of these platforms in question didn't notice that they were under attack so early, so these systems seem to have sat there for many hours, which isn't great, to be honest. So I think it's a little early to say exactly what the scale of the hack was, but I think we will hear more.
Sure. Does it feel like it's part and parcel of just testing this out, or could we see regulation? I don't know. Are there consequences of this?
I think we will see regulation because no one likes the sense that, one or two companies have control, but actually they don't have control and no one's really regulating them. That's never a great place to be, particularly for technology that certainly they bill as particularly powerful. So I think we will, can expect at least some loose regulation. Maybe it'll be quite company-led regulation, sort of industry-led regulation, rather than something sort of from the government. But I think we will see some sort of movement towards tighter controls.
Does this have a direct impact on investors, or it feels like we're just at the beginning of trying to figure out where it ends? I've also heard of like a tech NATO type, alliance, but it feels very far away.
Yeah, I think, and I would actually agree with you. I think at some point there may be becoming regulation, right? As I mentioned, the market is just scrutinizing everything that is happening, but does it mean that it will absolutely impact the whole AI trade, right? We need to start and see what those models are, how they impact in the market, whether they're cheap to produce or not, what that it means for the CapEx spending. So I think at this point there are a lot of different unknowns. It's just the market tries to find the most negative news at this point.
Do you agree with that? In that it does feel like the market is testing because maybe they're trying to balance out the euphoria of the last 6 months?
Completely. I think, there's a big positive swing, and then now, any signs that that the kind of hullabaloo has been too much, I think, sends the swing back the other way. So, I think you see these big movements, and I feel like next week it could go the other way again. Who knows?
The roller coaster that is summer and tech companies. Thank you both for joining us. Shona Ghosh, RMA tech editor, Natalia Lipikina from JP Morgan Private Bank stays with us because we have to talk more earnings, and we have to talk about the Fed. Now, UBS has launched a new $3 billion buyback program after beating second quarter net income expectations as a 53% surge in equity trading revenue supported its investment banking division. And the bank's wealth business also saw stronger than expected inflows. Well, very old Guy Johnson is following the results in Zurich. Good morning, Guy. So what are your key takeaways from numbers and your conversations with Sergio Armati?
The key takeaway is that this is generally being taken as a fairly strong set of numbers pretty much across the board. There are highlights within the numbers, but the market broadly has taken UBS higher today. It's not been the case with all banks. Look at what happened with Barclays yesterday. But today, certainly UBS is moving on the upside. One of the key standouts, as you say, has been the equity division. What has happened with that equity division? It is plus 53%. Why is that? Well, there's a number of reasons for it. The most prominent one, and I talked to Sergio about this, was the fact that we are seeing significant amounts of volatility in the market. There's a kind of huge transaction wave as a result that comes from that, and UBS is really benefiting from that. Is that sustainable, Francine? I think is one of the key questions going forward. So I asked Sergio whether or not he thought this kind of volatility story that we're seeing, and you've been talking about what's been happening with the Cosby overnight, whether or not we will see ongoing bouts of volatility. This is what he had to say.
Look, if I look at the macro picture, the geopolitical picture, the ongoing debates, also the big dispersion we see in equity markets, and the pressures and on energy prices creates potential headwinds on inflation, and that may turn out to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
So it's interesting. European banks have done well. They've done well in equities. UBS has done particularly well in equities, and these kinds of volatility incidents certainly are a big factor behind that. But European banks trail. what we've seen over in the United States. Look at the numbers that have come out of JP Morgan. Look at the numbers that have come out of Morgan Stanley and Goldman Sachs. They're super strong. Is there a gap between where European banks sit in the equity story and where US banks lead in the equity story? And why is that gap? So I talked to Sergio about this a little bit, about this as well. And basically what UBS has done here has delivered this performance without any significant extra capital going into the equity business. So that's quite a positive thing. And the reason for it, he says, is that actually the equity business is there to serve the wider bank, the wider wealth business. This is a decision that was made back in 2012 after 2008, the crisis there, that the equity division is effectively subservient to the wider bank's needs. And as a result of which, it is a price worth paying in the good times to maybe underperform a little bit, to have the stability that maybe you will have maybe in the bad times. So that's an interesting side of things as well. But why is this gap existing elsewhere? Are we going to see it changing? And the sense certainly seems to be not. And I asked him whether or not it's just a cost of being a Swiss bank, because that's a huge debate here at the moment. Is there a cost of being a Swiss bank? And he said, you know what, maybe that's a price worth paying. I am happy to be a Swiss bank right now. And that's going to be heard loud and clear by the government and the regulators. UBS is happy being a Swiss bank because there's this huge debate that is raging at the moment. The government wants UBS to have a higher capital standard. UBS says it goes too far. There needs to be a compromise. We're not yet there, but signs are that we're certainly moving in that direction. Francine.
Guy, thanks so much. A great interview, which you'll also hear in its integrity a little bit later in the program. Guy Johnson there in Zurich. Now, still with us, Natalia Lipikina from JP Morgan Private Bank. Natalia, I mean, I don't know whether this is just symptomatic of the wider earnings story in Europe so far, which is they're fine, they're good.
I would just pick up on the discussion about the banks, because lots of banks reported this morning, but overall what we're seeing is a very strong story. You're having obviously very strong investment bank division results, but also loan growth and deposits, they're all coming through. The ECB just hiked rates recently, and it's all going through the banks. It's a very similar story to the US. In the US, you know, the banks kicked the earnings season a couple of weeks ago. It was very similar. Very strong loan growth, especially in commercial loans, shows that, you know, the whole CapEx activity is showing up for the banks, but also deposits as well as investment bank. So we feel like this is part of the market that is doing well. In fact, that outperforming the market months today, we'll feel pretty comfortable with the bank story. But also taking a step back, if you look into the overall earnings season, it's pretty solid, especially in the US. It's the 7th consecutive quarter of double-digit growth.
Yeah,
if we
impressive, really impressive, actually.
Yes, if you think about, it's now ending, well, close to end at plus 27%. If you exclude some of the gains, it's much better than what the market expected even 3 months ago. And it's the 2nd consecutive quarter of plus 20%. Was there not to like?
And actually, when you look at some of the indices, I mean, you're expecting the S&P 500 quite a bit higher by mid-2027. Is there anything, I mean, is there one big bet that could derail? Again, if you look at the earnings, but the question marks around AI, what's driving this?
Yeah, if you look into what is driving the earnings, especially this quarter, for example, it's still tech. So if there is one risk to our constructive view, it's the tech story. If the tech story is not panning out the way we think is, then probably there is a risk. But we still remain quite constructive. And as you mentioned, 82 by mid-2027 is our forecast.
Natalia, when you look at the Fed, I mean, there's a little bit of anxiousness actually after Citadel Securities, you know, made a call for actually a Fed rate hike, or said that they would hike. Like, is there a benefit for delivering a rate hike now?
Look, when you look into the market expectation, the market is probably expecting a hawkish hold. I would characterize that. 30% market expectation that they will hike. We don't expect a hike today. We think it will all about, you know, the guidance and how they think about the oil price. The CPI print recently was actually quite okay. It's all about the oil price at this point, which is seesawing, as we see. But we think that probably the Fed will be on hold today.
I mean, how much does the equity strength, but also in general markets, depend on what happens with the Strait of Hormuz, which frankly is anyone's guess, because there's diplomacy, there's talks, but actually then we go back to square one.
Yeah, you're absolutely right. The market is watching the oil price, but I would say the market will be, if oil is going up higher than 110, 120, this is where you may see a pressure on the equity markets, because this is the level at which, you know, the market will be questioning what impact oil price will have on earnings. But it was interesting to see that oil sharply sold off earlier this year, right? So the market is still expecting that at some point then oil may actually come down, and that will be the tailwind for the market.
Natalia, thank you so much, as ever, for joining us. Natalia Lipikina, head of EMEA Equity Strategy at JP Morgan Private Bank. Now, coming up, a days-long pause in fighting in the Middle East ends, increasing the risk of a return to a full-blown war. So we'll have the latest on this next, and this is Bloomberg.
To the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Oil has surged after the U.S. says it intercepted an attack on American military bases in the Middle East. Now, U.S. Central Command says it joined Saudi forces in retaliating with strikes on Iran-backed militants in Iraq. Now, the latest flare-up brings to an end days of relative calm. Well, let's get more from Paul Wallace, who leads our coverage in the Middle East and Africa. Paul, thank you for joining us. So just bring us up to date on the latest attacks.
So there was a lot that happened overnight. As you mentioned, these joint U.S.-Saudi attacks on the positions of Iraqi militias, that's very significant. The first time that we know of that Saudi Arabia has attacked Iraq in years. And this has... The activities of Iraqi militias, many of whom are backed by Iran, has the potential to open up a new front. Iran is denying that it's involved with anything that the Iraqi militias have been doing recently, and they, in the past few days, have been attacking Saudi Arabia with drones, attacking Saudi Arabian oil facilities with drones. But even though Iran denies that it has anything to do with that, its links with these groups are very strong. It funds them, it trains them. And so certainly this will be seen by the Americans and by Gulf Arab states as part and parcel of the U.S. war with Iran. So it's a pretty dangerous escalation just days after everything that happened around the southern Red Sea with the Houthis and them attacking ships in Saudi Arabian territory. So yes, as you say, the sort of relative lull that we've had over the past few days seems sort of well and truly shattered for the moment.
So, Paul, what does this mean for the prospects of a truce?
It underscores, I think, just how far away the U.S. and Iran are from, a return to formal negotiations, let alone a permanent end to the war that sees the Strait of Hormuz reopened and Iran agreeing to a deal that curbs its nuclear program. That seems like a long way off at the moment. We're simply, the sides are simply trying to get to a point where there is a ceasefire that actually holds and where traffic can pick up through the Strait of Hormuz, even if the vital waterway isn't fully reopened, and that's left to these sort of wider negotiations.
Paul, thank you so much. Paul Wallace there with the very latest, of course, on the Middle East. Now, Ukrainian President Volodymyr Zelensky says he discussed Patriot air defenses and diplomatic efforts to end Russia's war during his White House meeting with President Trump. Zelensky also described the talks as productive as Kyiv looks for ways to deter Russian attacks.
So now Putin is losing 30,000 his soldiers per month. This is big, too much losses, like President Trump says. It's many losses, but he doesn't want to stop this war. So now initiative not in the hands of Putin.
Let's bring in Greg Sullivan, our Russia economy and government editor. Greg, good morning. A very positive interpretation by President Zelensky. What was your reading of these discussions?
That's right. Both Ukrainian President Volodymyr Zelensky and the White House seem to strike a positive note coming out of those discussions. In reality, it's potentially a bit more of a mixed picture for Zelensky and Ukraine. On the one hand, Zelensky does seem to have warmer relations with Trump. You will remember that last year there was that infamous blow-up in the White House. Relations between the two leaders were a bit more fraught. That seems to be behind them now, with Trump even praising Zelensky and Ukraine's battlefield performance earlier this month. So that's a positive for Zelensky as he seeks to keep that relationship on his side. But Zelensky did go to the U.S. seeking air defense for Ukraine as it faces these Russian onslaughts and airstrikes. It's unclear whether he actually secured more air defenses in the interim. We do know that they discussed the domestic manufacturing of the Patriot missiles that Trump said he would allow Ukraine to do under license. That's going to take a while to get up and running, and Ukraine does have a shortage of these interceptors in the meanwhile. So he needed to secure those. It's unclear if he did or what comes next or how those next steps will play out.
Overall, where do we stand on the war? Is there any hope for ending the conflict?
Well, that's also a pretty fraught picture. We did hear from the Ukrainian leader last week that he met with U.S. envoys, or that he discussed with U.S. envoys restarting diplomatic efforts. But right now, there's really no sign that U.S. brokered talks will resume. They've been stalled since February as Washington has been distracted by or focused on the war in Iran. Right now, there doesn't seem to be momentum to return to the negotiating table. And from the Russian side, quite frankly, Putin has stuck to maximalist demands. He's still demanding territory that he doesn't control militarily, and he hasn't really shown a willingness to negotiate an end to the war or back away from those. So it's hard to see where a negotiation actually goes from here, but the first step would obviously be returning to the table, and right now there just doesn't appear to be much momentum towards that.
Greg, thanks so much. Greg Sullivan there with the very latest, of course, on Ukraine. Now, this is the picture across the board for European indices. Look, this is what I would overall say. First of all, UBS shares are gaining as much as 2.4%, but the wider picture is really what we're seeing with not only AI, but also the Fed. U.S. stocks are edging higher, traders holding off any major bets ahead of a U.S. interest rate decision. And then, of course, we're looking at earnings from Meta and Microsoft. Coming up, we'll be speaking to the chief executive of one of the world's largest testing, inspection, and certification companies as they raise their guidance. That's coming up next, and this is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is The Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend. This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua in London, and these are your top stories. The tech rout deepens over growing fears over AI spending. SK Hynix slumps despite a massive jump in quarterly profit. Banks get a boost. UBS beats quarterly profit estimates, and Deutsche Bank's fixed income trading revenue jumps. Plus, oil rebounds as the U.S. says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's Fed decision. So let's get more on the Fed now, which is expected to hold rates steady later today. Traders eyeing a near 1 in 3 chance of a surprise move higher as the central bank grapples with inflation pressures. With a preview, let's bring Alistair Bull, one of our senior editors. Alistair, good morning. A hold is not necessarily a done deal.
Not at all. I mean, this is probably the most legitimately uncertain FOMC meeting we've had in years, and that's really down to a couple of factors. On the one hand, Kevin Walsh, the new chair, has been very careful and very cagey about not showing his own hand, about his preference. He's deliberately said he doesn't want to provide forward guidance. And then you have half the committee who we know from previous projections want to raise rates, and the other half who sounded happy to stay on hold. And the ones who want to stay on hold have a pretty legitimate case. I mean, the CPI print was softer in June, payrolls undershot, and showing a little bit more patience now, holding off at least until September, would give them another 2 months' worth of inflation data that could validate the belief that some people have in the markets that inflation peaked in May and that the right strategy is to stay on hold. But the reason the market's pricing a third chance of a hike is there's good strategic reasons, not least Walsh's own very hawkish comments, to raise rates now, do it preemptively, buy a little bit of insurance, and also act well before the midterm elections in November. Francine.
Alistair, the Fed has kept rates on hold this year, so how much longer can they actually afford to do so?
That's going to depend on the data. If the data come in on side, it shows that CPI and inflation peaked in May, then staying on hold was the right call, and Walsh will be a hero. If they don't get those numbers coming on side, then they may have to go harder and go higher, and do so in the politically perilous environment of a tightly contested midterm election, which is going to draw a lot more fire from President Donald Trump, who, as we all know, wants lower rates. So, I mean, no pressure, Kevin. This is going to be a very tough call, and it's going to be a very interesting press conference where we're going to listen very closely to his words for guidance, if they do stay on hold, for how much more patience he has, Francine.
Alistair, thank you so much for the terrific briefing, as always, Bloomberg's Alistair Bull. Now, shares in France's Bureau Veritas surging this morning after lifting its sales growth target. Now, the company is one of the world's largest testing, inspection, and certification firms, and as businesses navigate trade disruption, supply chain challenges, and the energy transition, demand for compliance and, of course, risk management is evolving. So let's discuss the outlook with Hinda Garbi, Chief Executive of Bureau Veritas. Madame Garbi, thank you for being with Bloomberg this morning. First of all, your share price is actually, higher, so congratulations on that. But your company really provides testing and certification across a range of industries. So what are you seeing in terms of economic outlook? Are you positive? Are you worried? Who's doing what?
Good morning, Francine. Look, we're very, very pleased with the results for the first half. The business environment is obviously complex. I just listened to the segment before. But what distinguishes Bureau Veritas in this market is we're a very diversified, decyclicalized group, and we've been working to continue to do so. So we are rather balanced in our view of how the market will evolve. We think our market fundamentals are particularly strong, even if the backdrop of the macro environment is complex. And we have been pivoting our portfolio and rotating our portfolio to align it with the fast-growing, resilient segments of this market. So our view is to continue to cautiously monitor situations like the Gulf, of course, the conflict we see in the Gulf. But what's important for us is to continue to control what we can, which is executing on our strategy.
When you look at the Middle East, how are these renewed tensions actually affecting your clients? And has there been an impact on your business there?
Well, there was some impact, of course, once the flows of oil couldn't leave the Gulf. There were some impacts on our oil and petrochemicals activity. But what we've seen resilience in capital projects where plans have been maintained, a bit more softness on any of the OPEX activities where there is a little bit more discretionary decision-making there. But overall, I would say this is a very important region for oil production, of course, and a number of projects continue to be maintained. But, of course, some cautious on whatever could be controlled in the short term to preserve cash.
Yeah. I mean, given all of these geopolitical uncertainties, what do you think happens to inflation, and how are you projecting your own growth in the next year?
So inflation is an important question because inflation, of course, is something we monitor very closely, and we have built a good, I would say, response program to deal with that from a pricing perspective. So we work in over 140 countries, Bureau Veritas, and therefore we're exposed to inflation in different parts of the world. And we've developed, as I said, a response plan to manage pricing with regard to inflation. The service we do is an essential service, and therefore very necessary for projects, for companies to operate.
You've also acquired Lotus Work. I think it's the biggest acquisition that Bureau Veritas has done in the last 10 years, and it really specializes in critical tech facilities like data centers and semiconductor plants. I mean, this is the thing we talk about every day. So how important will that business be to your growth?
Is very, very important. We're part of our strategy to develop our buildings and infrastructure segment, which represents 30% of our business, is to move towards more complex assets. And data centers, semiconductor fabs are these kind of assets. Lotus Works specializes in commissioning and quality assurance and quality control in the semiconductor space and also in the data center space. So we've been really developing our portfolio around these mission-critical assets, and we think that will be highly accretive in terms of growth to the company, and they allow us to be in spaces that have high barrier to entry because the expertise is very deep, and the capabilities, you need a long time to develop these capabilities for commissioning.
So in 5 years, if you look at some, I mean, there's, questions about AI infrastructure, of course, but also, volatility, valuations, but potential bubble. If I speak to you again in 5 years, how much will testing of AI infrastructure be within your portfolio? How much will that grow compared to other businesses?
I think I'm more optimistic on the AI development. We work in so many sectors of the economy. The adoption is real. The capabilities of the technology are unusual in a way, and very fast adoption we have seen. So therefore, we consider that the underlying market continues to be strong, and we think that the growth is going to be strong. Just to give you a perspective, we started this activity of data center since 2017. We have multiplied the small acquisition we've made by 7 times since then. So you can see the kind of growth we've seen, and we think it will continue. Of course, the capabilities will be developed further to ensure we are expanding across the full services needed for these assets.
You also announced last month that you were in talks to sell off some of your oil and petrochemical operations. Are you any closer to sealing off that deal and sell them off?
Look, we've signed an agreement with Triton Partners to pursue this deal. I think we are on a good path. Of course, it's not done until it's done, but it's definitely a key element of our strategy to rotate our portfolio. And we consider that this activity for the future is not an activity we would like to keep, and that's why we've been working quite a bit now to achieve that. So yes, I'm rather positive that we should be progressing.
I mean, it's going to be a big year politically in France over the next 12 months. Do you worry about volatility? Do you think clients in France will delay decisions until the presidential election next year because they don't really understand what will happen?
Well, look, France is a historical position for us. It's our home country. We have expertise. We have a good position, but it represents, around less than 20% of our business, rather 16% of our business when we operate in the rest of the world. So we monitor the situation very closely, and we prepare for ourselves for how the market will evolve. But at the end, it's not as big as one would think, being a French heritage company. So we're cautious. We monitor how things will progress, but we have a very resilient business in France, exposure to OPEX and regulatory activities, which tend to be stable.
Hinda, thank you so much for joining us. Hinda Garbi, the Chief Executive of Bureau Veritas. Now, Rio Tinto has posted a jump in first-half profit on the back of strong commodity prices. The miner says it will double down on efforts to cut costs and build cash by boosting productivity and selling non-core assets. The Chief Executive, Simon Trott, has been speaking with Bloomberg.
Iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products, and that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG, and so through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export-related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China and those products flowing to the rest of the world.
I think domestic suppliers and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support. Is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So, aluminium, copper, lithium, as well as steel. And if you look forward, I mean, the spend next year on from hyperscalers, $1 trillion. And you convert that across, that's a lot of lithium, aluminium and copper. And so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp-up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only 2 copper smelters, and then a big pipeline of growth beyond that.
Well, that was Simon Trott, Rio Tinto's chief executive. Coming up, an earnings boost for 3 of Europe's biggest banks. We'll dig into the details and hear from the C-suite. That's coming up shortly, and this is Bloomberg.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Well, the latest numbers from UBS really show that wealth management assets are beating estimates and trading revenue surging. The lender has announced a $3 billion buyback. Our Guy Johnson asked the chief executive, Sergio Armotti, about the buyback as it comes amid ongoing uncertainty over the bank's future capital requirements.
The issue is that what we have is this programs that we have to file with the stock exchange in terms of buyback programs that we can execute in theory over 2 years. And our capital return policy and ambition has been set at the beginning of 2026 when we say that our aim was basically to start with $3 billion and then assess the situation at the end of the first half. So what we do now is we have a new plan, a new program that, and we intend to execute it over the next 12 months. But the pace and size will be determined by our capital position, so staying at 14%, and also the ongoing development in the business, which we are very positive of, but also the ongoing discussion on too big to fail, like we did in the last 2 years. The language hasn't really changed.
The language hasn't really changed, so I shouldn't expect in 3 months' time some clarity on too big to fail.
The billion has to be seen as a minimum commitment that we will do, rather than putting a clear indication on anything more than that.
Equities, very strong. Plus 53%, I think, is the number. That's a nice number. The surprising thing is that you've done it without any extra capital. That's the real standout here. Let me ask you the same question I asked Venkat at Barclays yesterday. If you'd have given that division a bit more extra capital, if you'd have funded it differently, if you'd have provided more for it, could that number have been significantly higher? Are you throttling back equities at the moment? How high could that number be?
Not really. Actually, what we did, the point you raised is a good point, but what we did within the investment bank, we also shifted some capital from the fixed income businesses to the equity business to help them. But our focus is really, which I also believe that the numbers are very strong because they are mainly driven by intermediation activities. And rather than deploying capital in prime brokerage. But going back to your story, this is more about our strategic capital allocation at group level. We made that decision in 2012 that our investment bank fits strategic ambitions that we have to support our wealth management clients, our institutional clients, our corporate clients, but with a defined capital allocation. So we had ups and downs in times in which it was very rewarding to have that, and times in which you may have some opportunity cost. But when I look at the full results, 23% return on allocated capital for the investment bank is pretty strong result. So we are very happy with
Okay, but let's the opportunity cost. Let's just talk about the opportunity.
Yeah, but the opportunity cost.
JPM did 86%.
Yeah,
could you have done that kind of number?
Yeah, but is not something. If and when doesn't matter, because I think our philosophy, our capital allocation, and our stock is rewarded by this business mix and not by taking opportunistic and tactical view on momentum in any of our businesses.
Do you think if you were a US bank, you'd do something close to, what was it, 86% for JPM, Goldman Sachs did 71%. If you were a US bank, do you think you'd get those kinds?
It's too hypothetical to answer that question.
Well,
we are not a US bank, we are a Swiss bank, and we are very happy with that kind of
you can see where I'm going with that. If you re-domiciled, is there a cost to being a Swiss bank?
I think there are also a lot of good opportunities, but of course things have to be fully balanced. But I'm very happy with our results and what we achieved as a business mix, right? So if you look at wealth management, you look at the Swiss business, asset management, and the investment bank all together put up a very strong set of results.
UBS Chief Executive Sergio Ermotti there speaking to Guy Johnson in Zurich. Now, it's been a big day for earnings at some of Europe's biggest banks. Standard Chartered and Deutsche Bank both beating profit expectations. Charlie Wells has all of the details. Good morning, Charlie. So what have we actually learned from these two banks this morning?
Well, Francine, we've learned that these banks really have been having a show of force, and that is translating into their share prices in the market. Right behind me here, we've got Standard Chartered up well over 4% this morning. Now, this is on the back of a very strong earnings report. Let's take a look at some of the standout points from that earnings report that we got this morning. Now, we heard, of course, this $1 million share buyback. Now, investors love those buybacks, but what's also really striking here, and we've been really paying attention to this, is strength coming from their wealth management unit. Now, the wealth management unit is really important for Standard Chartered, and there have been concerns about that. Let's flip and take a look at why. If you take a look at the share price of Standard Chartered this year, they are currently flirting near all-time highs, but if you look at early June, you can see that dip there. Now, that dip is related to Chinese authorities trying to limit the flow of money out of mainland China to places like Hong Kong. Where does Standard Chartered have a lot of exposure? Hong Kong. But investors are calm this morning in particular because of the strength coming from that wealth management unit. We're seeing a return to force here for that share price. Now, again, that confidence is really giving the bank, a justification for that buyback. Let's take a listen to CEO Bill Winters talking about that return.
We're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, yeah, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
So that was Bill Winters talking about that buyback. Now, this has really been the theme of the morning, share buybacks. We also heard about a 500 million euro buyback from Deutsche Bank. Investors, of course, love that. That bank up well over 5% this morning. Let's take a look at some key points from their earnings report as well. We got that 500 million euro buyback, but also what really stood out this morning was fixed income trading, up some 16%, now beating a number of Wall Street competitors. I really want to zoom in on this because this really puts it all into context. Let's bring up and see how Deutsche Bank performed relative to some of its Wall Street competitors. You can see here that increase in the quarter, year over year, of 16%, beating a number of these major Wall Street players and also beating the average. So, of course, we see behind me Goldman Sachs up much more, but the average was 13%. So on FIC, crucial to Deutsche Bank because they did not have that equities trading business. They really got a strong beat here, but that wasn't it. Let's take a listen to CFO Raja Akram talking about the litany of records that Deutsche Bank had this quarter.
Not only is it a record second quarter, but it's also a record first half for us. But what's extremely pleasing is you mentioned the significant beat on investment banking, but actually we had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise. Capital position strong. We announced another buyback today. So I think all in all, I would say in this political and geopolitical environment, I think these are stellar results.
So again, Francine, that was CFO Raja Akram talking about that set of records from Deutsche Bank. And again, Deutsche Bank and a number of other European lenders really up in the markets on the back of strong earnings today.
Charlie, thank you so much. Charlie Wells there with the very latest on some of these banks. Now, Kering shares on the move after the luxury company reported that sales at Gucci topped estimates in the second quarter. The move is also sparking optimism that a long-awaited turnaround at Kering's largest brand is starting to take shape. Let's get more from Andrea Felstead from Bloomberg Opinion. Andrea, always such a treat to speak to you. So what were your key takeaways from the Kering results?
Well, Gucci isn't as bad as it was. It's going in the right direction, and it's not as negative as people thought it was going to be. It does seem to be a positive from Gucci, and that's what's got everyone so excited because it is the main driver of Kering's results and its share price.
Yeah, so what is selling well? Again, that we went from minimalist to maximalist. Like, is there a general trend of what people want?
I think we're moving away a bit from minimalism. Luca Di Maio, CEO, said they were having success with Gucci's leather bags, which is good because, they are the real profit drivers of the industry, and they've been in a bit of a slump. There are doubts about whether, not least for myself, whether Demna is the right designer, but this showed some sort of positive signs that his products were resonating with customers.
What's going on with Hermes? So they're better than others, but actually they're getting slammed in the market.
Yeah, the leather goods was slightly below estimates. There's just a feeling that Hermes was so much better than everyone else. It was untouchable for so long, and it's not. There are worries, particularly about the Birkin, the Kelly, the real drivers of that business. The one thing that I think has been good for Hermes, and I think it has really helped the brand, is all the footballers carrying these giant Hermes bags. I think there was a feeling that the Kelly, the Birkin was a bit overexposed. They tend to change hands in the secondary market at a premium to the retail because you can't get them easily. That had been falling, but I think the footballers have really given a fresh, lease of life into the Birkin.
Who knew? Football, World Cup, and Hermes. There you go. Not something that I thought we would be saying a year ago. Andrea Felstead from Bloomberg Opinion with a terrific view, of course, on some of the luxury sector. Coming up a little later, we'll be speaking exclusively to the L'Oréal chief executive Nicolas Hieronymus on earnings after markets close this evening. Up next, Bloomberg Brief.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market. Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Decision day in the U.S. Futures wavering ahead of the Fed, with markets eyeing the possibility of a surprise rate hike. Microsoft, Meta, and Qualcomm on deck after SK Hynix whipsaws down as much as 18%, up as much as 6% following results. And oil bounces after Iran attacks U.S. bases overnight, and Saudi Arabia joins the conflict with strikes in Iraq. South Korea experiencing more violent swings in today's session. Let's get straight to Winnie Su in Hong Kong for the latest from Asia. Winnie.
Yeah, good morning, Vonnie. A very volatile day, especially in the Korean market. We have the Kospi here closed down 6%, but during the day it was down as much as 13%, triggering a circuit breaker. Well, it was in fact the very first back-to-back circuit breaker from yesterday, so you can see that momentum unwinding very quickly. Well, the big trigger here is SK Hynix missing analyst expectation for its earnings and also raising CapEx expectation further. Now, the earnings call saw a little bit of a lack of details when it comes to the shareholder returns and the longer-term contracts. So some disappointment around that front as well. Now, we have just kickstart this emergency meeting by authorities, including the finance minister, on the current market situation around top of the hour. So we will see what kind of measures that they will come up with in the next 2 hours or so. Flipboard, we take a look at how that's affecting the broader Asia market, with the MSCI Asia down about 0.7% here, extending losses for a second day and also headed for its lowest level since April. The bright spot, though, is actually in Hong Kong shares. We are seeing tech shares gaining on that front, with rotation away from AI names and also some pressure easing when it comes to the memory chip pricing. Back to you, Bonnie.
So, Korea's finance minister calling an emergency meeting on market stability in South Korea. Winnie Su, thank you so much. Let's get to London now to see if there's much of a bleed across into Europe. Justina Lee, what's going on?
Good morning, Vonnie. Now, yet again, Europe is nowhere as dramatic as Asia, even though we are seeing the Stocks Europe 600 completely erasing some of the gains it saw earlier this morning to be down 0.2%. But we actually have gotten a spate of pretty good earnings out of some big European stocks, Deutsche Bank, UBS, Kering, and of course Glencore, which is supporting a lot of the mining stocks we're seeing here. Now, overnight, we've also gotten a bit of a flare-up of Middle Eastern tensions again, with oil climbing, and that explains, a rise in short-end German bond yields ahead of that Fed decision later today. But, I've been saying, a lot this week that, Europe has been the source of calm in global markets. And if you flip the board here, you can really see that in the year-to-date charts. I mean, Europe didn't enjoy that big run-up that we've seen in Asia with kind of the relative lack of tech names. But more recently, it also means it's been pretty resilient, holding on. And if we are seeing a bit of that rotation back into value names out of those high momentum names, Europe could be a relative beneficiary here, Bonnie.
All right, Justina Lee, thank you for that in London. Well, just to illustrate what Justina was saying, here is your oil price coming into this Wednesday Fed day. Brent crude above 87, so bouncing 3.5% plus on those attacks that were not expected by Iran overnight. That said, we're well off the $90 a barrel mark. New York crude just above 82. European gas futures rising again as well. The tech story, though, is a fascinating one today. You had SK Hynix, by any measure, blowing out earnings, massive, massive numbers, and yet there is so much to parse in those earnings reports and in the South Korean reaction that it's difficult to know how investors will come into the U.S. session. So we have NASDAQ 100 futures wavering just a little bit. We're positive now. We are definitely positive on the S&P and the Russell 2000. The equal-weighted S&P hit a record yesterday, but the NASDAQ has had 5 down sessions in a row, and of course it's Fed day, so it's anyone's guess. Also, obviously, as we said earlier, Meta, Qualcomm, some of the major companies on deck with earnings today. Let's take a look at yields as we process what might happen with the Federal Reserve. About a 30% chance of a hike baked into this market. So obviously, if there is one, that would be a surprise to the market. The 2-year yield up a basis point. We're holding in around our levels that we've seen all week. Once again, the auctions yesterday showed demand at the very front end, less demand as we move to the middle and the back end. All right, let's get to some individual pre-market movers now. For that, we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We are seeing some weakness across those chip stocks this morning, except for Intel, after the SK Hynix results really rekindled those fears around this potential AI overspending. And so we are seeing some weakness across that sector this morning, and we're down in particular for Marvell and SanDisk in pre-market trading. Moving on to Bloom Energy, which is having a great day today and soaring in pre-market after raising its guidance and reporting earnings that were double what was expected. So this is due to very strong demand from data centers, and so it seems that not all is negative in this AI trade. And finally, let's go over to Europe, where Kering in the luxury sector has reported very strong earnings and very strong sales, actually, for Gucci, which seems to indicate that the ongoing turnaround for that company is paying off. And we are seeing investors reward that this morning, with shares up almost 13% for Kering.
A nice pop there. Chloe, thank you so much. Chloe Melly there. We'll be back later in the hour. Also coming up this hour, the countdown to the Fed with Priya Misra of JP Morgan Asset Management. First, oil rebounding after the U.S. said it intercepted a surprise attack by Iran on military bases. Joining us now from Dubai is Bloomberg's Abir Abu Omar. Abir, what happened overnight?
That's a good question, Vani. So this surprise attack by Iran on U.S. bases in the region. We also heard in the early hours of the morning here in Dubai from Jordan, with 5 missile attacks on its grounds from Iran. And so again, this follows a couple of days of calmness, really. The U.S. had halted attacks against Iran on Friday evening after 13 consecutive nights of hitting targets in Iran. Iran later on Sunday saying that it will suspend its own attacks on the region, only for us to hear overnight that it started by attacking those U.S. military bases. Now, Central Command did say that it intercepted the missile and that there was no damage done. But parallel to all of this, Vani, we also heard that the U.S. Central Command, alongside Saudi Arabia, have hit targets in Iraq, eastern parts in Iraq. We actually just heard from Iraq that there were cities, including the capital Baghdad, Kirkuk, Karbala, among others, that were hit with about 20 people killed, several others injured. Saudi Arabia says that this is an act of self-defense, that it was a response to those Iran-backed militia in Iraq hitting the country earlier in the week. So we're seeing new fronts really emerging in this Middle East conflict, Vonnie, but at the heart of all of this remains the Strait of Hormuz and the pretty much paralyzed movement there. And this is why you're seeing just across the screen now Brent crude prices 3.7% higher as we continue to monitor the movement or the lack thereof in the waterway.
Abir, thank you so much. Abir Abu Omar there in Dubai. Investors bracing for a host of AI-related earnings, then with a focus on capex spending. Earlier, shares of SK Hynix plunged and also rose after lots of numbers out of that company. Let's get straight to Bloomberg's Neil Campling. Neil, a six-fold increase in quarterly profit, revenue that was literally up more than 1,200%. Sure, lots of capex and maybe not that much of a plan to give back to shareholders, but what's the logic for the trading here?
Yeah, so I think for Hynix, as you mentioned, it's traveled a long way in terms of the stock price performance, but raising their own capex by 50% this year, it follows a similar capex hike for the next fiscal year from rival Micron that we heard from late last month. So if their capex is going significantly higher, what is that going to do to the memory DRAM pricing longer term? That's going to be the concern for the investors of the memory stock specifically. It's actually, if you think of it, longer term, going to be good for the hyperscalers because out of the $1 trillion plus that hyperscalers are expected to spend on their capex next year, about 1/3 of that is actually going on memory pricing. So that could be a sort of longer term and actually a headwind that becomes a tailwind for the hyperscalers, which is not going to come through in numbers tonight, but something to keep a track on going forward.
As long as we don't see some slowdown in chip pricing power, are we starting to see that at all, Neil?
We are. So we're not yet seeing the memory pricing coming down yet, but I'll tell you what is coming down, and that's token pricing. If you look at the gap between the two, they have tended to track each other. So as token prices come down, it would seem that the memory pricing won't be able to sustain the kind of levels they're at the moment. So that could be something, I think, to focus on going forward as to where in that disconnect the balance comes out.
Now, we get Qualcomm later today. Last Friday, we already learned that it's planning on increasing prices for some of its products by double digits. What will investors be concentrated on in today's earnings?
Yeah, I think the key focus will be on unit volumes. And the reason I say that is because obviously us as consumers are likely to be kind of wearing those cost increases in terms of the price increases for products. And if we've already heard from Apple this year that that's going to be a challenge in terms of pricing, and that could feed through into the Qualcomm model in terms of those volumes. So keep an eye on the volume numbers tonight out of Qualcomm.
And Neil, we also obviously get Microsoft and Meta, two very, very different companies. What will investors be focused on a piece?
Yeah, so I think for Microsoft, clearly it's going to be the cloud growth. The cloud growth needs to be significant to justify what will be expected to be high in terms of their capex forecast. And as far as Meta's concerned, it's really balancing up, again, the top-line growth with the capex investments. And it seems likely that actually Meta will follow what we heard from Alphabet last week, is it could well post the first free cash flow negative quarter when they report numbers tonight. So they're going to have to carefully balance those metrics of justifying the spend with accelerating top-line growth.
Yeah, because we know what happened the last time this earnings season that a company reported negative cash flow. Neil, thank you so much. Neil Campling there. We're obviously also counting down to the Fed's rate decision set this afternoon. Bloomberg's Jill Desus joins us now for more. Jill, the market's really only pricing in 30% chance of a hike today, yet there have been voices in the last few days, perking up and saying this is a real possibility. What's the likelihood the market gets surprised?
Yeah, Bonnie, I mean, you're talking about how technically the market's mostly pricing in a hold here. And so really it's that hike that would be the surprise, but that's not really what the vibes are really feeling going into today. This is actually more volatility than we've seen in terms of, that divergence between what the market's ultimately thinking in quite some time. By now, ahead of a Fed decision, you would think that the market will ultimately converge on one position. I mean, I think the one that really kind of, made everybody sit up and take notice this week week with Citadel calling for a hike here. Obviously, a huge component of this is the fact that Kevin Warsh is still fairly new in the position, and he seems pretty adamant that he doesn't really want to give a lot of forward guidance about what the Fed's decision ultimately will be. But also, Vani, I think there's a lot of other elements that are really at play here. I mean, when you're looking over the past several weeks in terms of some of the price pressures, inflation pressures that we're really dealing with, we saw a lot of that cool off after the U.S.-Iran ceasefire was announced last month. But just in the past few weeks, we've seen that ceasefire put on pause, then come back again. I mean, we've obviously just heard some more reporting on some tensions that have flared up overnight. So that's introducing a little bit more volatility there. And then I think the other thing that you have to really think about here, Bonnie, is in terms of timing for a potential Fed hike. Does Kevin Warsh want to pursue something now or later this year? I mean, the closer we get to November, for example, the closer we get to U.S. midterms, suddenly a live Fed decision starts to look a little bit more politicky there. So I think there's a lot of equations that are really in play here, and it actually does make for a much more interesting Fed meeting coming up.
And Jill, while we may not get forward guidance, what are investors hoping to see from the new Fed chair?
Yeah, I mean, I do think that still kind of plays into it a little bit. I think we're all kind of still getting used to Kevin Warsh in the Fed chair seat and trying to get an understanding of where he's really kind of expecting the Fed to go this year. And again, I do think it kind of comes down to the question of, even if the Fed pauses again today, as we've been talking about, would be in line with the majority of market expectations for now. Is there any kind of clues that you can kind of hint from anything that Kevin Warsh says that gives us some idea of whether or not there's a hike in play in the future. So still will be really interesting to see again how he just conducts himself in what's really only one of his first Fed meetings here.
Yeah, Mark is just getting used to his cadence. Jill, thank you so much. Jill Desus there for us. Now to other top stories trending on the terminal this morning. BMW is offering voluntary severance packages to thousands of its workers in Germany. The move is part of a restructuring plan to create a leaner company. The departures are expected to account for most of the 8,000 positions BMW aims to cut globally. Hermes shares are falling after missing estimates for its leather goods unit. The company's CFO also said there will be lower product price hikes for 2027. While the numbers outperform much of the struggling luxury industry, a lack of growth in China is weighing on shares. Porsche's operating profit jumping, powered by the success of its high-margin 911 sports cars. The results are a relief for the struggling car maker. However, shrinking China sales, U.S. tariffs and uneven EV demand continue to hurt the company. Coming up, strong results from some of Europe's biggest banks. We'll unpack the reports next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Good morning.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The big dispersion we see in equity markets the pressures and on energy prices creates potential headwinds on inflation, and that may turn out to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
Sergio Armati there. UBS, Deutsche Bank and Standard Chartered all rising after the latest earnings reports, with billions of dollars in fresh buyback plans following revenue surges. For more, Bloomberg's Charlie Wells joins us from London. Charlie, it's a little bit like the United States, pretty much great across the board, yet many of Europe's economies are struggling. So where were the high points? Where did the strength come from?
Yeah, that's a really good point, Vani. And you know, what we've really seen has been this combination of volatility and rates really helping a lot of these banks across the continent in a similar way that it did in the United States. So we saw this rate picture that really helps on that net interest front, which we've seen positive from a number of other lenders. And also what we've really seen this quarter has been that volatility, right? We've seen these equity trading desks at the like of UBS, which reported today up 53% in the quarter. You've seen them able to capture that volatility. But what you've also seen and what you heard in that interview with Sergio Armati of UBS is a note of caution. This idea that, you know, are we at a point where we're at as good as it gets, given a lot of the threats out there, given the volatility, the fact that volatility is great for a moment, but it can also get to be too much. Rates as well, they can be great for banks' profit to one degree, but going too far can hurt them. So again, a little bit of a warning there, but right now, from these results and looking at the reaction from the market, very strong across the continent, just like it was in the United States.
Is there anywhere in the earnings across the board, Charlie, where we might be able to see the beginnings of some of those warning signs, any little fragilities or cracks?
What was really interesting was to look at, you know, fixed income, right? We saw some misses on fixed income at a number of these major banks here in Europe. So Barclays yesterday and traders really kind of homing in on that. But you saw a show of force in fixed income from the likes of, say, Deutsche Bank, where, you know, they had growth in the quarter of 16%, outcompeting their Wall Street competitors. The average from the major Wall Street banks was about 13%. So again, strong showing there. But if you think about where cracks could be, Vani, as you're talking about Deutsche Bank, there has been a big valuation gap in Deutsche Bank compared to a number of these other major European lenders. That's concerns that maybe things have gotten as good as they possibly can get. Concerns about Deutsche Bank's exposure to, say, private credit. And again, some concerns about the macro picture as well, Germany's slowing growth there. So again, as you say, some challenges in Europe, but at least for today, at least on the back of these earnings report, things are looking positive and investors are responding in kind.
And Charlie, just as you mentioned it there, you know, there's obviously a whole different scenario in Europe than there is in the United States, but some of the macro pressures are still there, such as rising gas prices, you know, a war on its doorstep, as well as a war a little bit further away. How are banks preparing for what might be another volatile quarter, but maybe not as helpfully volatile as the previous quarter?
Well, this gets to the point that, you know, rates are actually helpful for banks until they're not, right? If we think about that inflationary picture, we are in this environment where rates are looking like they may be held or stay higher for longer. Another issue that we had going into this reporting season was, you know, the price of risk. Were banks going to have to set aside more for potential soured loans than markets had expected? And if you look across a lot of these major lenders, there were not a lot of huge surprises in how much banks had been setting aside for potential write-downs. You saw less at a number of these large lenders. So at least right now, the picture is looking pretty strong here in Europe.
Bloomberg's Charlie Wells in London. Thank you so much. Coming up, a look at what's making headlines in your front page news. This is Bloomberg.
anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
For your front page news. First up, the New York Times reporting ICE arrests are surging in airports. Agents are arresting spouses of Americans, tech workers, and others whose visas have expired as they pass through airports. The Times says many of those arrested have active applications to stay in the country. Next up, the Financial Times reporting Mark Zuckerberg says the U.S. administration should not block Chinese models to gain an edge in the AI race. In an interview with the FT, Zuckerberg expressed concern AI might become centralized in the hands of a few powerful groups in the United States. And the Wall Street Journal reporting New York City has published an online list of property owners who might be subject to the surcharge on luxury second homes. The list encompasses 960,000 properties and individuals from a cabinet secretary to President Trump's niece. The new surcharge, which went into effect July 1st, targets second homes worth more than $5 million. Coming up, we're going to push ahead to the Fed decision with Priya Misra of JP Morgan Asset Management. This is Bloomberg.
Point in your tennis career did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Decision day in the U.S. Futures slightly higher, but wavering ahead of the Fed, with markets eyeing the possibility of a surprise rate hike. Microsoft, Meta, and Qualcomm on deck. This after SK Hynix whipsaws down as much as 18%, up more than 6% in the Korean session following results. And oil bounces after Iran attacks U.S. bases overnight, and Saudi Arabia joins the conflict with strikes in Iraq. We'll start there, looking at Brent. Above $87 a barrel, so up almost 4%. Nevertheless, well off the $90 barrel mark. New York crude just below $82 a barrel. Elevated, but staying in position. European gas futures as well going to inflict a little more pain on that market. 58.87 per megawatt hour right now. Let's look at futures, because it was a fascinating session. Free fall basically in Korea again, to the point where the finance minister decided to host an emergency market meeting on market stability today. Sentiment continuing to sour around the AI and chip trade. SK Hynix batted it out of the park, but upping its capex spending and just causing investors a lot of angst, and that stock was really whipsawing today. We're at peak earnings season in the U.S. as well. We've nearly $6 trillion worth of market cap reporting today, another $8 trillion reporting tomorrow, and this after the NASDAQ 100 has fallen for 5 straight sessions. Right now, futures are positive. It may not be a sixth, but we'll see. The equal weight S&P 500 index is at a record as well. And then yields-wise, of course, all eyes on the Fed. Not too much movement, up about a basis point, just under 430 on the 2-year, still well above 5% on the 30-year, and the 10-year yield holding in at that 461 and change mark. Let's get to some individual pre-market movers now with Chloe Melee.
Good morning, Vonnie. We are seeing those chip stocks back in the green. So we've seen some initial weakness on the back of this capital spending plans from SK Hynix, which had really fueled those investor fears around AI overspending, this overinvestment in AI. But now we are seeing this reversal in sentiment, and the likes of Micron, SanDisk, and Marvel back in the green in pre-market trading. Some of that might have to do with some positive updates and results from some other names in the AI trade. And speaking of that, we have Seagate, the computer storage and hardware company, beating expectations, with analysts saying that the AI cycle has further to go with this company, and therefore we are up in the green this morning, up about 5.5%. And it's also a similar positive story for Bloom Energy, which has raised its guidance and has also reported earnings that were double what was expected, and that was thanks to very strong demand from data centers, and we're seeing that really drive the shares this morning. We're up more than 11%, and so it seems that there are some positive stories around this AI sector, despite those worries around SK Hynix.
All right, Chloe, thank you so much. Chloe Melee there in London. Joining us at the desk now is Priya Misra, Portfolio Manager at JP Morgan Asset Management. Priya, you're not expecting a hike today, but how confident are you in that view? The last few days, have any doubts crept into your mind that we might actually see a hike, given the return to hostilities, the escalation in oil prices, and so on?
Right. So I think conviction level has to be lower because the committee is divided. There's a lot of uncertainty around the war, around even whether tariff inflation has peaked. So I think there is that concern. And then we have Chair Walsh that doesn't believe in forward guidance, and he wants a good family fight. And the committee is divided. So I think conviction level is lower. But, I take a step back and I think about data over the last 6 weeks. And the data, whether it was the jobs data, whether it's wages, whether it's inflation, PCE, PPI, CPI, it's all come in a little bit softer. So if the Fed is truly data dependent and, they've got another meeting just 7 weeks away, I think they can buy time. They can reiterate the commitment to price stability. I think you're going to get a couple of dissents, 2 or 3 dissents. So that'll indicate that the Fed is very much focused on the fact that inflation has been above target now for a while. But the urgency to act today is a little bit lower. The data has been weaker, and they've got another meeting. I don't think we'll get any forward guidance that they're not going to hike or they're going to hike. They're just going to remain data dependent, which is why we ultimately think they don't go. But the market's going to keep these hikes priced in because the inflation backdrop just has been higher than that 2% target.
So how many, if any, dissents will we see, and what will they be based on?
I think the dissents are ultimately based on inflation credibility and the fact that inflation has been above target for a while. I'm thinking President Hammack, President Logan, very likely, maybe even President Kashkari. So you might get 3. And I think this is where Chair Walsh is likely to suggest that there was a good discussion of a hike, which is why I think the market's going to keep these hikes in there. If they don't hike today, well, they can absolutely hike, in September, in October and beyond. And so I think that's why the dissents are important, to suggest that this is not just him driving the decision. This is a committee decision. So, I think the market's expecting 2, I would say 3. Now, it is a committee, it's a democracy. So I think if it's more than that, I think then the market does get concerned. And a sense of why the hikes. And, I know Chair Walsh doesn't want to give us forward guidance, but is this a hiking cycle? Like in our view, this might be taking out the rate cuts from last year, not a full-on hiking cycle.
Is there a risk that if they wait for the next time, or even the one after that they are missing the boat? Because sure, while this might be temporary in terms of the escalation of hostilities and oil prices and gas at the pump being back above $4 a gallon and so on, there are other factors too, such as maybe the wealth effect is coming off if we continue to see stocks sell off and less confidence in the AI trade.
Right. I'm glad you bring this up because I think it's the entirety of the issue. So the point that would it be too late? Well, I think financial conditions have tightened. You look at real rates. This move higher in rates has all been driven by real rates, and that's part of the tightening in financial conditions. Then some of this optimism around the AI trade, more capex is always good news. No, I think the market's now looking for monetization, use cases, things like that. So I think some of that wealth effect might be, coming off. And again, I look at inflation expectations. Whether you look at break-evens, surveys, the Fed has credibility, without hiking right here. Now, I think, does that credibility go away if 6 months from now inflation's still here? It can start to wane. But I think right now the market's giving the Fed benefit of doubt that they would hike if inflation has not peaked. Our view is inflation's likely peaked. Energy might still remain high. Oil prices might stay at this while, but it's not going to be a source of inflation, and the labor market's not a source of inflation.
And the consumer seems resilient, at least according to many of the companies that we've heard from Hilton to Royal Caribbean.
Right.
Is there a risk of upsetting the market if the Fed hikes today? So even if the Fed chair were inclined to potentially hike today, this market seems a little fragile right now.
It does, and I think the tricky part is if they start hiking, is the hike primarily because inflation's above 2%? That's what, if you listen to the hawks, that's their argument. Well, then why stop at 2 or 3 hikes? And so the market has to broaden the distribution of maybe this is 4 hikes. Are we taking out the rate cuts from 24 and 25? I think that's why I think the market's a little vulnerable. Without a dot plot, without getting much forward guidance from Chair Walsh, I think it's just the concern, risk premiums will rise. And that's obviously important for interest rates, but credit spreads, equities. So this is why I think the market is vulnerable. A hike without telling us the end point or even giving us a sense of the reaction function. That's what I'm hoping we get a little bit of. We need not get forward guidance. But what exactly is the Fed overall looking for in terms of how much more are they going to hike? I think that's what we'll be looking for if we do get that hike.
The Treasury auctions that we saw this week, what did they say to you? We had plenty of demand at the very front end and, even maybe out as far as the 2-year, and then not so much.
So, I mean, they were not terrible, but there was that little bit of a tail. And I think it's telling us that there is a competition for capital, you know, globally from sovereigns, energy independence, you know, just energy security, things like that with the different conflicts. You also have now competition for capital from the AI-related debt boom. You know, the AI party has come to the bond market, and I think as supply comes in, high-quality companies issuing further out the curve, now you've got, you know, we've got global sovereigns issuing, you have all the hyperscalers and the entire AI ecosystem issuing, plus US Treasury issuance. I think that's where the competition is coming in, and people have to see the value in treasuries relative to some of these really high-quality, you know, AI companies.
You know, one of the reasons cited for the AI trade coming off has been that hyperscaler debt has been getting just a little bit more expensive, right? But that's also a factor of just the amount of issuance, and if, you know, investors are going to continue to take it on, they're going to want to get paid more. Have you at all looked at some of these offerings and how much more complex they're getting? Would you be interested at all?
We find value across the you know, AI ecosystem, as we're calling it. So it's not just the hyperscalers, it's chips, it's power. And to your point, they're being extremely creative, which I think is the right thing to do, because if they have that much in funding needs, just straight up unsecured debt, you know, you might exhaust the market. So whether it's an SPV type structure and then paying us for different risks, if it's a construction risk, if there's amortization in the schedule. So there's a macro view that these companies are strong. We think the AI trade is there. But then there's a lot of under the hood. Are we getting paid for all the risks we're taking? What spread levels? How much more supply is there? Absolutely. We love some of the AI related debt, but you have to be very careful in terms of what you're buying.
Well, that made you so happy, Priya. There must be a lot of opportunities out there. We have to leave it there, but thank you so much. That is Priya Misra of JP Morgan Asset Management. Now to other top stories trending on the terminal this morning. UBS announcing a $3 billion share buyback program. Wealth management assets beat estimates and trading revenue surged. CEO Sergio Ermotti spoke with Bloomberg TV.
Standout is good momentum across all our businesses. You know, you can see that in 45% increase of our underlying PBT, and so basically the synergies and the top line developments are working well, and net assets are up 7.3 trillions of assets. We manage good inflows, and the integration is almost done. Still not fully done, but I'm very pleased with our momentum.
OpenAI says the AI models that hacked Hugging Face also accessed a customer account on cloud platform Modal and used it to launch attacks. The hack is reinforcing fears that AI models are becoming increasingly capable of carrying out sophisticated cyber attacks. The US is tightening restrictions on some foreign-made robots and solar power inverters. The FCC says the products pose potential supply chain risks. The move could add to tensions between China and the US ahead of the Trump-Xi summit in September. Coming up, military strikes flare up again in the Middle East. More on Washington's response next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Tensions flaring again. A pause in military strikes in the Middle East disrupted after what the U.S. called a surprise attack from Iran on American forces. Bloomberg's Megan Crane is live now from Washington. Megan, is this the first time that Iran has attacked U.S. bases preemptively?
You know, it's not. There have been flare-ups in that conflict over the last several months. Unfortunately, when I left yesterday, we were talking about gasoline prices and oil prices had plunged after a lull since Friday, and that seems to have dissolved overnight, really showing how far apart the two sides are in trying to come to a lasting ceasefire, lasting peace in that area.
Absolutely. The U.S. calling it a surprise attack was also obviously means that they were not prepared for something like this, or at least they didn't see it coming, let's put it that way. How would they not have seen that coming? I mean, there must be some breakdown in communications with the mediators.
Yeah, I'm not really sure how that would have come about. They certainly said that they were prepared for it in the sense that it was unsuccessful. There weren't a lot of details as to what the attack was, where they were headed. But I think that, until we have a peace deal, there's always going to be some sort of skirmishes and some threat that there could be violence.
Trump also saying yesterday that he had good meetings with other world leaders, Volodymyr Zelensky and Benjamin Netanyahu. Any more details on what the U.S. might be providing in either case?
Well, for Zelensky, he certainly was happy that yesterday the Senate passed a sanctions bill that had been something that Lindsey Graham had been really anxious to push forward. That would allow increased sanctions on purchasers of Russian oil and Russian energy more generally, which is something like a tool that Zelensky was definitely looking for. So they didn't come out and say that that was what he, had gotten yesterday, but that he definitely left with that in hand. As far as Netanyahu, he came out and said that they had had a good meeting. But they didn't give a lot of details as to what they had talked about. He did say that he was in lockstep with the United States and whatever Trump decided to do with Iran.
Yeah. Megan, just domestically, a brief word on the Trump administration deciding to end the drug plan subsidy for Medicare. It seems like it might be a difficult message to put across if you're campaigning for midterms.
It is that for sure, right? The Trump administration is sort of serving two interests. They want to talk about cutting prices. They want to talk about cutting costs. And the billions of dollars of subsidies are one thing they can say that they have done that. But that could raise prices and costs for consumers, which is something that's really not popular on the campaign trail. So the timing seems a little strange to me, but that is, how they've decided to do it. And I think it kind of shows how they really are struggling to come up with a message that serves both interests.
Yeah, absolutely. Megan, thank you so much. Bloomberg's Megan Crane in Washington, D.C. Turning back to tech now, the latest results from SK Hynix reinforcing investor concern around AI spending ahead of more earnings in the United States. The South Korean chipmaker expects its capital investments to increase around 50% to at least $31 billion. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, surely we were expecting this, right? The market was expecting that CapEx would be at this level. Why is the volatility so strong in those shares today? There was so much good news in that report.
There was, but when you look at the numbers relative to where consensus expectations were, they probably missed the top line by 5%. So it was surprising given the US ADR listing, but I can see why they don't want to, be in the news about the price increases on the DRAM side, given companies like Apple have already raised concerns about higher memory prices and the impact that it's having on them. So from that perspective, I think they want price increases to moderate on the DRAM side, and that's probably played a role in terms of why the numbers were shy of consensus.
Speaking of pricing power, Qualcomm is set to report later, and we already know it's increasing its pricing for some products by double digits. What more will investors want to hear from Qualcomm?
I mean, all these companies, whether it's Qualcomm or Apple, they're at the receiving end of, the higher component prices, such as memory. And so from that perspective, I think the impact of higher memory prices on Qualcomm's margins is what I think everyone would be looking forward to. And also the feared demand destruction when it comes to, raising prices that Qualcomm is doing. How it's going to impact the unit volume. So I think the consumer side right now feels left out because of all the focus on data centers, and Qualcomm is getting into data centers, but it's a much smaller portion of their overall business.
And we should get an update on that as well. We're kind of getting all sides of the picture today, though, because we're also getting results from Microsoft. What are we expecting to hear about Azure and some of the other aspects of the business?
Yeah, I think the bar is very high for Azure given what Google reported last week. And we know everyone is expecting both Microsoft and Meta to raise their CapEx numbers, and not only for this year, but also have some guidance for 2027. And some of the memory price increases is what will drive these CapEx increases as well. So if they don't raise their CapEx, that would raise a concern that, they're cutting back somewhere else. And I think everyone is fixated on the top line growth, but also the CapEx growth for both Microsoft and Meta.
So Meta will also hopefully give investors a steer on how it's going to monetize its compute, the leasing of its compute. Will we get details, do you think, Mandeep?
I think so. And if they don't give any details around, how they're thinking about the cloud business or how their latest MuseSpark model is doing relative to all the frontier labs, and still raise their CapEx, I expect a negative reaction. But look, they've released a new model, MuseSpark. It seems to be doing well on certain benchmarks compared to their prior Llama models. And so from that perspective, expectations are low, and any details they provide both on the cloud rental side as well as the model side, I think would be cheered.
And then after all of that, we go back to Korea and we actually get Samsung earnings tonight. Obviously, it's a little bit more diversified than SK Hynix, but I mean, will it rescue Korea, Mandeep? Obviously, there's an emergency meeting happening right now as well.
Yeah, at the index level, there's a lot going on in terms of margin calls and other things in that market. But when I look at the fundamentals of these businesses, whether it's SK or Samsung, they do look very strong. And I expect these companies to generate a lot of free cash flow, and probably, once they're done with all the local concerns, then probably pursue some buybacks as well. But these companies will generate a lot of free cash flow over the next 3-4 years.
All right, it's going to be an absolutely insane 48 hours. Mandeep, thank you so much. That is Mandeep Singh of Bloomberg Intelligence. Coming up, a Fed decision and earnings front and center in your day ahead next. This is Bloomberg.
trillion industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today. First up, the Fed's rate decision coming at 2 p.m. Eastern, followed, of course, by Fed Chair Warsh's news conference at 2:30. Then a raft of earnings. We get Microsoft, Meta, Qualcomm, ARM. They're all after the market close. And then you got to stay up for Samsung out of South Korea. Plus, Starbucks, P&G, Chipotle, General Dynamics, they're all reporting after the close as well. Some earnings movers for you. Let's start with Seagate. A large gain here. Strong results and a revenue forecast, so bucking the trend there. Not so much for Logitech, down almost 10%. Its devices sales forecast really missed estimates for the second quarter. Some supply bottlenecks there, and that stock is down 10% now in the pre-market. And then Bloom Energy, well, it was down 11% in yesterday's session and has been lower in the last few sessions. But investors were pleased. The fuel cell maker surging on higher guidance. Earnings actually doubled estimates. Let's look at the macro environment as we head into this whopper of a trading day. So Nasdaq 100 futures are actually climbing all the while, even after a spectacularly volatile session in South Korea, which caused an emergency meeting on that market. Looks like perhaps the selling might be done. We have had 5 straight declines for the Nasdaq 100. Gold just a little higher, and the 2-year yield just up a basis point as some parts of the market tread water before the Fed rate decision. Oil, though, is higher, up more than 3% on Brent and WTI. Also, European gas futures up almost 3%, back at 59 euros per megawatt hour. That is it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market. You can get that from a bank. You can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Tech is the future, but I think right now we're in an air pocket.
It's important to remember narrative follows price.
Anything that puts a dent on the perfection of the chip stocks or cause a market reaction. The mood is souring a little bit.
The fears of this gyrations in stocks, I think, will not slow down at all.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, facing down a triple threat. Economists looking for a hawkish hold from Fed Chair Kevin Warsh as the latest diplomatic effort between the US and Iran is facing a setback. SK Hynix is kicking off a big day for tech earnings, missing very high expectations. Microsoft and Meta up next.
Operating profit at SK Hynix only up 557%. So that was incredibly disappointing for a lot of people. Look, it's almost funny that we're talking about SK Hynix as some sort of leading indicator from Microsoft and Meta, considering that their shares are up 120% so far this year, even with a 50% drawdown. Meta is down 10% so far this year. Microsoft is down 18% so far this year. So here is the issue. Do they face the same high bar because of concerns about CapEx spending, or are they coming from a weaker place and just have a lower bar to really clear?
Just sit on SK Hynix. Look at that move. Look at that move today off the back of a six-fold surge in quarterly profit, off the back of posting margins of 80% plus. The bar is simply too high for this stock, for Intel, for Samsung. To Bramo's point, Microsoft and Meta, you flatter them. They've been in bear markets, off the highs of more than 20% for much of the last month or so. And to your point, is the bar lower for them? Now, if they put up good numbers later on this afternoon, and people start to freak out about the CapEx number, even though growth elsewhere is decent, and those stocks have been battered over the last few months, then we've got a very different problem in this equity market.
And maybe Max Kettner will no longer be bullish. If you really have this serious pushback to CapEx expectations, you've already seen a bit of pushback when it comes to valuations in credit markets. That will only continue if you see that kind of reaction in equity markets and speaks to something beyond just positioning.
Let's turn to the commodity market. Check out crude this morning. 3-day slide on Brent. Down something like 15% over that period. This morning a bounce, up by close to 4. Brent crude at 87. WTI 82, 4 days of relative calm. The strikes make a comeback.
Yep, the strikes are back. That calm that we saw since Friday is now over. The United States CENTCOM is talking about these surprise attacks that they intercept in terms of ballistic missiles towards U.S. military installations in the region, and then they fired back alongside, this is Iranian-backed militias in Iraq, alongside Saudi Arabia, which just goes to show that you can potentially see an opening for more Gulf Arab partners to join the United States when it comes to striking back on Tehran.
This is why you didn't get a massive rally in the bond market over the last 3 days or so. Check out 2s this morning, still around 430. Check out 10s. 10s this morning, up a basis point, around 462. Heading into a Fed meeting, and we said this repeatedly on this program, if you're an official at a central bank and you were pinning your call on what happens in the Middle East between now and the end of summer, you need to look for a new job because you don't have much of an argument to begin with.
Which is why you're not expecting a significant move one way or another as a result of near-term fluctuations in oil prices. That said, in some ways, the market's been doing the Fed's job. If you're worried about inflation being too high, you've seen a general tightening of financial conditions with the NASDAQ down more than 5% since the last Fed meeting and spreads wider on both high-yield and investment-grade bonds. They want to keep this going if they want to get inflation under control, even if it doesn't necessarily require hiking rates today.
You know, we talked about the three-part act of the ECB, statement, news conference, and then the post-game reports. I think we're entering that phase potentially for the Federal Reserve. Three-part act, statement, news conference, not much in it. And then afterwards, you start to find out what actually happened at the meeting. You get the speeches, and they take on additional importance. We'll have this conversation later this hour. I think it might be a new era for the way we think about the Fed decision, when it's made and the implications of it.
Does Kevin Warsh still have the leadership role where he sets the tone on the Fed? Because right now, a lot of the rhetoric seems to be from other Fed officials who are filling a void because Kevin Warsh has not given us his view. And so suddenly, Chris Waller's voice is as strong right now as Kevin Warsh because we're not hearing what the lodestar is for Kevin Warsh.
We have been talking about this for months. If you don't offer forward guidance, if you're not going to offer a framework to financial markets and commentators, then someone else is going to fill the void. And that's potentially going to happen after this meeting.
That decision, 2 p.m. Eastern Time, the news conference 30 minutes later. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore on the sky-high earnings expectations. Colonel Wayne Sanders of Bloomberg Intelligence as a surprise Iranian attack sends crude climbing this morning. And we'll catch up with Claudia Sam of New Century Advisors, with Wall Street flying somewhat blind into a Fed rate decision. We begin this out with tech stocks looking for stability, going into back-to-back risk events. Julian Emmanuel of Evercore writing the following: this week is very important. For the bull case to resume, we want to see positive share price reactions from the hyperscalers and stabilization in the semis. Julian joins us now for more. Julian, good morning.
Good morning.
We do not have stabilization in the semis yet. We might this morning briefly, not on SK Hynix, certainly. Are you expecting some positive reaction to those hyperscaler earnings later on this afternoon?
So you set the narrative at the beginning here is that the share prices of the hyperscalers have been so battered, and the narrative around the increase in CapEx set last week by the first hyperscalers announcement and the poor price reaction there. The bar has been lowered sufficiently, in our view, that you really are sort of setting the pace for a potential positive reaction. But the bigger question, and that's been the question for weeks and weeks and weeks now, is that days when software and the Mag 7 work are days when the chip stocks sell off. Can you actually have them work together? And I would say it would be interesting and somewhat ironic if you had an earnings miss like you had overnight in Korea, and then we'll hear again from the other part of the tag team in Korea, whether earnings misses actually are what forms the bottom and results in the end of the Korean retail selling, which really has been the proximate cause for a lot of this.
Do you think we're going to have that washout? Are you seeing that washout now? All that leverage, importing some of that volatility into America, are we washing that out now?
Yeah, we definitely think that's the case. And look, again, and we've said this a lot of times, if you're a tech stock investor, you have to be comfortable with higher volatility. And frankly, if you had told me that Korea would have been down, whatever the number is, 33, 35% from the top, and the NASDAQ barely down that 10% threshold, I would say that's probably not a bad result.
So what would it take for you to get all in and say, okay, we really have reached some sort of bottom where you could see both of these sides of technology working together?
Well, I think the first lesson is, if you're a portfolio manager, is that given what we've seen of the volatility of the last several months, not just to the downside, to the upside too, the concept of all in is a little bit different, right? So because the volatility is higher, and we expect it to be higher for the medium term, probably the rest of this bull market, all in means slightly smaller positions. But for us, actually, again, it's how the shares react to what we're going to hear in the next couple of days. And then I would also say how the reaction to the unlock of the additional float in the world's largest IPO next week, how that reaction comes about.
You mean SpaceX and just what's been happening to their shares since the IPO, and it has performed worse than 90% of all IPOs of its size going back to World War II. How does the Fed factor into this? Is some of the tightening that we're seeing and frankly the sell-off in big tech related to a much more hawkish tone than people expected at the June 17th meeting?
Well, yeah, no, absolutely, because remember, and this is different from the March sell-off in technology. It was very apparent. There was massive hedging visible in oil, massive hedging visible in the larger credit indices, massive hedging visible in the triple Qs. Not as apparent this time because a lot of the hedging is actually happening in single name stocks and single name credit default swaps. And, when equity investors start paying attention to credit default swap price action, not even on the indexes, but on the single names, it's a little bit more difficult of something to parse. And so we would look for a little bit of tension to release, just given the passing of whatever it is he is or isn't going to say. And we don't think they hike this time. But frankly, if the narrative is as it was in June, we're worried about 2%, we're focused on 2%, that's good, because you anchor the longer end of the yield curve, and that is going to be very helpful for the debt issuance of the hyperscalers.
Not to throw even more shade at equity investors, but when they start to become fixated on bond auctions, when I see that turn, when I start to see the equity guys look at the bond auctions and how they priced, then I know maybe the yield story's gone too far.
You mean when suddenly the 7-year yield in the 7-year auction matters?
Like the pure equity guys that never even look at fixed income.
I think that means welcome to the club. I think that you're focused on the right thing, because ultimately is the cost of funding, and that gives you a sense of just where we are right now.
Are you also focused on what's going on with oil? In your last note, you talked about 80's manageable, 95 is danger zone. Could the Fed look through 95 or higher?
No, they won't look through it. And if we're talking about $95 WTI in September, you better believe the rate hike regime will begin. We don't think that's the case. Our view is sort of mid-80s is the landing zone for WTI. But here's the other issue, right? Think about it. We have had, again, as you said earlier, if you're a central banker and your base case is predicated on the movements in oil, you have neck pain from the whipsaws over the last 4 or 5 weeks. And the whole thing about markets is part of the reason that this bull market has been able to be as robust as it has been is because the 10-year yield, every time we look, it's either 430 or 450, for 4 straight years. And if we had more stability in the oil price at a number we think we could live with, call it the mid-80s, that would be a positive.
Someone messaged me the other day and said, never do a Trichet. Never go full Trichet and start hiking interest rates purely because of what happens with crude. That was the ECB a long time ago. Crude this morning, Brent, 87. 82 on WTI. Gillian Emmanuel of Evercore is going to be sticking with us. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. SK Hynix shares plunging in Korean trading. The company's record profits still falling short of sky-high expectations. Executives say they're signing long-term contracts with no end in sight to explosive demand. They expect demand to outpace supply until at least 2030. Deutsche Bank shares gaining in German trading. The bank reporting revenue from fixed income trading that jumped in the second quarter.
We had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise, capital position strong.
Deutsche Bank also announcing a new share buyback of more than $560 million. The OpenAI agent that breached Hugging Face also compromised a customer at a second technology company, Modal Labs. Hugging Face says the agent broke into an isolated testing environment known as Sandbox that Modal was running for a customer. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour in about 30 minutes' time. Up next on the program, a return to hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Honestly, they haven't seen anything yet. We've been nice. Every time they hit us, we're going to hit them 20.
That's exactly what happened in the last 24 hours. Colonel Wayne Sanders of Bloomberg Intelligence joins us next, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I've said repeatedly the week begins on Wednesday. In many ways it does, because we've got some big events taking place, but I already feel exhausted. I'm sure you do too, after the last 2 days. Doesn't feel like we had 2 days off, that's for sure. The Federal Reserve interest rate decision just around the corner, 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Walsh. Then after the closing bell, no rest. Microsoft and Meta reporting after the close. Into that 5-day slide on the Nasdaq, the longest since January on the Nasdaq 100. This morning, a small bounce, up a third of 1% on the Nasdaq. On the S&P, up a quarter. In the bond market, 2s, 10s, and 30s just hugging. Anchored around 430, up 2 basis points this morning. With this move in crude, it's a bounce back. Crude higher, WTI and Brent crude around 88, higher this morning by 4.5%. Under surveillance this morning, it's a return to hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Every time they hit us, we're going to hit them 20.
When they hit, we hit. We use their language.
Honestly, they haven't seen anything yet. We've been nice.
We want to get it over with, and we want to do it right.
So here's the latest this morning, a multi-day pause in fighting coming to a halt. Crude climbing as the US intercepts a surprise Iranian attack on army bases across the Middle East. Bloomberg's Tyler Kendall has the latest in Washington. Hey, Tyler.
Hey, John, good morning. Well, this marks a major escalation amid a new threat that another front in the war could be opening. CENTCOM confirmed in a statement overnight that the U.S. military intercepted successfully multiple missiles launched by the IRGC at U.S. forces. But this came after Saudi Arabia confirmed that it, too, intercepted successfully multiple drones launched by Iranian-backed proxies from Iraq, prompting U.S. and Saudi forces to team up to hit sites in Iraq overnight, targets that Saudi Arabia hasn't hit in years. Washington has been trying to dilute Iran's power over these proxy groups, with President Trump telling me earlier this week that the U.S. remains in constant contact with Saudi Arabia regarding the Houthis in Yemen as commercial shipping continues to be disrupted in the Red Sea. And at this point, traffic in the Strait of Hormuz remains halted. The IRGC said overnight that it successfully halted at least 3 tankers that were trying to transit through amid new reporting that the country has turned down a new proposal by Oman that would have sought to reopen the strait to traffic. John, that would have included utilizing the so-called Middle Passage, giving both countries equal control over those transits. But we heard from an Iranian official saying that so far the country is vying for what they called, quote, sole control over any traffic that is trying to get through.
And Tyler Kendall with the latest in the nation's capital. Tyler, thank you. More from Tyler in the next hour. Joining us now to extend the conversation, Colonel Wade Sanders of Bloomberg Intelligence. Colonel, welcome back to the program. Every day I wake up and go through these stories, I'm always thinking about what's new, what stands out here. And what's new is Saudi Arabia. Saudi Arabia teaming up with American forces to strike Iranian-backed militia in Iraq. What's the significance of that to you?
Yeah, I take that as a huge significant area right now because Saudi Arabia controls the largest Gulf state Arab Air Force. It's also one of the key areas right now. They've always been a missile defense supporter and a logistics area for the United States, but they've mainly stayed out of it. So now that Saudi Arabia is entering into this as an active, overt participant with some of these strikes, it's letting them know, letting the rest of the world know at this point in time that they're starting to move forward with this, that they've had enough. It's also, given the fact that their influence over the GCC, that plays a huge part in this as well, in my opinion, because countries like UAE, Bahrain, and Kuwait normally end up taking some of their leads as well from somebody like Saudi Arabia.
So are you suggesting potentially we could see a more active entrance from the likes of the UAE or Kuwait or Bahrain as well?
Yeah, I wouldn't be surprised, especially when you look at UAE. They have asked for a UN Security Council resolution to allow them to enter the conflict, for the last few months. This isn't something that's new on that front. They've they've stayed back a little bit in terms of that, but with Saudi Arabia being able to add in the area that they currently have, UAE with their capabilities, not only from an intelligence, surveillance, and reconnaissance area, but also some of their expeditionary capability along the coast and the strait, plays a huge part in this as well. Because I think that when you look across, now when you start entering this, up until now, U.S. has somewhat felt alone with the Gulf states being in a very supportive role. But now what you're seeing is actually more of a partnership role, and I think that's going to be very significant going forward.
CENTCOM yesterday said that the IRGC forces when they launched these multiple ballistic missile attacks, it was a, quote, surprise. Do you understand what prompted that?
No, all I can think of is that at that point in time, IRGC thought that they had a target of opportunity to be able to go through. I think at that point in time, when you look at some of the military channels, if you will, to say, hey, look, right now we're in this pause right now to allow diplomacy to take another chance, that both sides are like, okay, all right, we're going to just sit here and let that piece play out before we resume anything. And the fact that those actually took place and those missile strikes started coming back in, I think CENTCOM, while they're always going to be prepared, I don't think they were expecting it as a most likely course of action, but they always look at it as the most dangerous course of action.
Colonel, a couple of months ago, people thought that wider involvement of more actors in this war would be problematic, that it would turn into a regional war, and that would only escalate the potential damage and length of this conflict. Are things viewed the same way right now, with the potential of other allies getting on board in addition to Saudi Arabia with the active fighting?
I don't actually think so, simply for one fact. None of these Gulf states right now are talking about adding into something that would end up in a ground invasion. The United States is not looking at a ground invasion, so you're still looking at air power being the predominant method for this delivery. So now what I think you're seeing is more of that shift for a vocal GCC vote that says, we have had enough of this. We've done everything that we can at this point in time to support in just a defensive role. But especially when you look at the Houthis from Yemen, as well as the Iran-backed militias coming out of Iraq, Saudi Arabia has to be able to defend itself. And the fact that they're doing this in an offensive way, I think is a good sign where the rest of the world is looking, going, okay, the U.S. is not an aggressor here in this. It's Iran refuses to come to the table no matter how many times we try to come back for diplomacy.
Colonel, it's good to see you. Thank you, sir. Colonel Wayne Sanders there of Bloomberg Intelligence, struggling to break out of this, Bramo, struggling to break out of this uncomfortable new normal, just switching between strikes and diplomacy with no sustainable diplomatic off-ramp.
When you ask people, what's a resolution that seems sustainable, they say, well, you're looking at it. Ultimately, there's not a whole lot of other options given the fact that the IRGC doesn't have a lot of levers to pull. Why would they give up their control over the Strait of Hormuz? And right now, it doesn't seem like there is the political will to do some sort of ground invasion that could potentially change that kind of new normal.
We've got Gillian Emanuel of Evercore still with us. Gillian, let's go through things year to date. We've had an 80 basis point move on a 2-year yield so far year to date, 80 plus basis points. On crude, we've had a move of, let's say, 45% on Brent year to date. We've had that shock through energy, that ripple through rates. Do you think we can avoid a growth scare? Because I don't see that in the equity market. The equal weight closed at an all-time high in yesterday. It's worth pointing that out. Do you see a growth scare on the horizon?
We actually don't, but this is a playing with fire concept. So just to level set, look, jobless claims last week were the lowest since 1969, when the population in the United States was 2/3 of what it is now. That tells you how strong the economy is. But the issue for oil is there are times when it doesn't matter and there are times when it does matter. And part of the tension around hyperscaler capex is due to the fact that oil price volatility is underpinning yield volatility. And that is the flow through on how the debt markets will be receptive for what is likely to be substantially more issuance over the next 6 to 12 months.
Does it make sense to you that the equal weight, that the more consumer-facing aspects of the equity market are outperforming during a time where there's increasing concern about oil volatility and higher yields?
Well, what it tells you is that in this environment, in this liquidity, in the strength of this economy, there's still lots of demand for equities. Okay, and it also tells you that investors are looking for more creative ways to find diversification from what has really become one gigantic AI trade, whether it's the bond markets or it's emerging markets. Everything's an AI trade. So in that environment, look, insurance stocks, part of our negative beta basket, they're like the new meme stocks. They're screaming they've made new all-time highs. Consumer stocks very strong. But again, it tells you the backdrop for investing and the appetite to own equities is still there.
Julian, it's good to see you. Thank you, buddy. Julian Emmanuel of Evercore, heading into earnings from Microsoft and Meta later on this afternoon. Before that, a Fed decision at 2 p.m. Eastern Time, 30 minutes after that news conference with Kevin Walsh, the Fed chair. The move we've seen in this equity market, we mentioned the equal weight closing at a record high. Check out the banks on the S&P. As a sector, the banks are up for 9 consecutive weeks. If we close out a week in positive territory, the longest weekly streak on record for the banks on the S&P. It's not just the major names, the regionals. The regional bank index up by close to 20% so far year to date. So what's going on in financials?
Fair to say this is not exactly a growth scare. This is quite the opposite. And this has come even as a result, or even as we see oil prices, or despite the fact that we're seeing oil prices rise and yields rise. How long can that continue? Well, Jonathan Krinsky, who actually got ahead of the semi move yesterday, put out a note where he was saying he wouldn't necessarily get all in, but maybe stop selling some of the semis. Now he's getting bearish in the equal weight. He's saying maybe that's going too far. So, you know, there's some discussion under the hood here.
Futures this morning, waking up to a positive story, up by 0.2 on the S&P. Up next, we'll catch up with Ted Morrison of Baird as Wall Street awaits a double dose of tech earnings. Plus, Yahira has your morning move as a check on SK Hynix ADRs. That stock is just about unchanged.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Every
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Equity futures stabilizing positive 0.25% on the S&P 500. The market cap S&P 500, the equal weight yesterday, record highs. The epicenter for this pain is in tech. Within tech, it's in semis. The Nasdaq 100 slided for 5 consecutive days, the longest run since the start of this year. On the semis, 4-day slide, the longest of the year so far. And that's where things have got a bit dicey. And even with fantastic earnings, we're failing to spark a rally in that particular sector. The next stage of the story is the double dose of Mag 7 earnings after the closing bell. Those names have been beaten up, and Bramo, you pointed that out. Those two names have been trading in a bear market. The bar for them should be lower. It should be lower. We'll see how low that bar is a little bit later.
And potentially the volatility that's been exported, as you point out, from South Korea may not affect them quite as much, given the fact that they seem to be focused in the semi-names. That said, CapEx still front and center with respect to the concerns. SK Hynix also exceeded expectations when it came to CapEx expectations. You might say that that's part of the story. If you do see an increase to capital expenditures without a pathway to pay for it with additional free cash flow, do they suffer the same fate as Google?
When you flip into negative free cash flow, you become dependent on this, the price of capital. And you turn to the bond market, 2s, 10s, and 30s, and you can't engineer a rally right now in the bond market, really, even with a 16% turn lower in crude in 3 days. 2s stood around 430, 10s around 460. There are plenty of reasons for that. We'll talk about a few of them in about 5 minutes' time. But one is the additional supply that's compromising the cost of capital here, there, and absolutely everywhere.
Yeah, and we saw that with some of the auctions this week, with a little bit of pushback, even with yields at the highest levels going back to 2024, at least in the 7-year yesterday. Look, this is coming amid also concerns about stickier inflation due to the incredible earnings from all of the other non-Mag 7, non-tech companies that we've been getting. Yes, I know you've been saying that the week starts on Wednesday. Nonetheless, we have been getting earnings from a whole host of different companies, and they have been beating expectations beyond the kinds of beats that we have seen in the post-pandemic era. They all are continuing to show resilience. So this speaks to a continued ongoing strength in the economy, despite what we're seeing in oil, and part of the reason why you're not seeing some of those oil price declines get priced into lower yields.
People are still spending. You see that in credit card companies. Still drinking sugar water. You see it over at Coca-Cola.
Yeah.
Still riding those cruise ships. You saw that earlier this week too.
You want me to do this again? Float in the boat with the Coke? I mean, this is essentially what we see, and we see it pretty much around the world with a huge asterisk of potentially the Middle East travel. But yeah, people are traveling. You look at Hilton, you look at Coke, you look
I was setting you up to do it again. I wanted to hear it.
You wanted to hear it again?
Yeah, just, you know.
I actually was trying to make a song with it last night, and I decided not to.
Okay,
because
you
it
just
might come out.
playing around with ChatGPT
Yeah, it was
again.
just like, you know.
Make a rhyme. Let's not do that, Bramo. No. Let's not do that.
Okay.
Maybe you wanted to do that, I don't know, but
I didn't really, but
I'm not interested this morning. Let's turn to crude. Brent and WTI. Brent crude this morning, this is your bounce. Look, 4 days of quiet, relative calm, and then you've got a spike. You're going to keep waking up to this kind of thing. This is the uncomfortable new normal. You'll have a series of talks, they'll break down. You'll have some unsustainable proposals, unworkable proposals, that'll break down too. And that'll all be punctuated with strikes, and that's where we are. So I don't want to overweight the strikes. I don't want to overweight the talks. I just want to observe that this is the new normal right now, and crude is still elevated.
It's purgatory. It's not full-out war, but it's certainly not peace. And on top of the fact that we have these strikes, you also have Iran rejecting this proposal from Oman to divide the control of the Strait of Hormuz. For them, it's all or nothing in terms of a toll and their physical handle on the Strait of Hormuz. Also, Saudi Arabia, according to our reporting, their state oil giant Aramco is preparing potentially for new selling price for oil. So you can potentially expect a step up when it comes to these products.
That's the cross-asset price action this morning. A few hours away from the opening bell. Make it 3. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start over in South Korea with SK Hynix. Shares falling 6.2%, but fell as much as 19% earlier over during that session as those leverage bets also unwind and exacerbate the selling. The company did post another record quarter, but still it was not enough to clear the high bar. Operating profit rose 557%, but still fell short of expectations due to those elevated expectations. Add to that higher CapEx spending projections that it announced, and you get the reaction that you're seeing over in South Korea. Turning to Ford, as Lisa was saying, good earnings and a good reaction here. Shares are up nearly 5% in the pre-market after the automaker raised its full-year profit outlook for the second time this year. It's being helped by strong demand for its SUVs and pickups, and that's helping to offset things like tariff pressures and weaker EV sales. And it's worth remembering that Ford also had a very high bar. Since May, shares have surged more than 40% on excitement over its energy business, which investors hope will hopefully supply batteries for AI data centers. And sticking with AI, we turn to Seagate. Those shares also up 5% after the company beat and issued a stronger than expected outlook. The stock is already up 160% so far this year as investors bet that AI will drive demand for storage, and that is something that the CEO confirms, saying that they see momentum continuing in 2027. John?
Yahara, thank you. Thanks for the update. Three of the movers, some of the movers in the pre-market this morning. On our radar this morning, our top story, the US intercepting a surprise Iranian attack on military bases in the Middle East, bringing an end to 4 days of calm. Officials saying US and Saudi forces carried out retaliatory strikes against Iran-backed militants in Iraq. Elsewhere, a Fed rate decision due at 2 p.m. Eastern Time, followed by a Fed Chair Kevin Walsh press conference 30 minutes later. Investors widely expecting policymakers to hold rates steady, but not ruling out the chance of a surprise hike. And finally, SK Hynix earmarking at least $31 billion in capex after reporting a 6-fold surge in profit in the second quarter and posting margins of more than 80%, still failing to spark a rally. The stock taking a beating, down more than 50% in a little more than a month.
I'm not sure what we can take away from this, considering that those shares are still up 120% so far this year. Is this more an issue of leveraged traders suddenly realizing that it doesn't only go in one way up? We've seen the South Korean stock market, the Kospi, become more volatile than Bitcoin this year. So you start looking at that and you start thinking, do any of these fundamental numbers actually matter? Because they didn't seem to matter on the way up, so they're not going to matter on the way down.
It's like the whipsaw that we just heard from Julian Emanuel talking about oil prices. That's what it's been like in Korea. But the fact that operating profit rose, as you mentioned earlier, 557%, and still wasn't enough to get it done, just goes what we've been saying all week. The bar is so high for these companies, and not only do you have to meet the bar, you really need to exceed it.
Price and positioning. That's what we're learning here. Price and positioning. And as for positioning, tons of leverage that needed to be washed out. And once you got that spark, once you had that spark, you were going to light fire very quickly to wash out that leverage in South Korea.
I love reading some of the stories, the anecdotes of people who talked every morning about stocks in Korea. They'd come in, they'd tell their friends how much money they'd made, how they invested in these leveraged ETFs, these leveraged funds. Now all of a sudden, everyone's quiet. They just sit there depressed, wearing all black.
That stock has been absolutely hammered. I don't think Dan Ives is wearing black yet, is he?
I doubt that.
It's still the second inning.
Come on, yeah. 10 a.m.
Give it a chance.
Lights are still off.
Without
Cops
a doubt.
Been called.
Right, something like that. A certain innings, and then a sports star.
Yeah, exactly. Yeah.
Massive capex concerns putting the AI trade on some shaky ground. Tech heavyweights Microsoft, Meta reporting after the bell. Ted Morrison of Baird remaining focused on funding, writing the $1.4 trillion capex estimate for 27 is viewed as stressing the system. The circular finance debate is back on the agenda with clients. Ted joins us now for more. Ted, welcome, buddy. It's good to see you.
Hi.
The cost of capital, the price of capital, is it going higher?
It certainly feels that to me. I mean, one of the biggest events this week was NVIDIA's requirement to provide a guarantee for OpenAI's Ohio facility. I think that's a game changer that you really need to focus on. But to your point, we're going to have to raise a ton of debt and equity to really fulfill the 2027 CapEx requirements going forward, and that's on top of sovereign debt. So we've got a lot of finance here, and I think when you look at the risk changing a bit on these models, the cost of capital goes up.
What do you mean the risk changing a bit? Is it just tied to the fact that suddenly they've got to borrow more than at certain times their free cash flow? Or are you talking about the competitive threat coming from open source models and cheaper technology emerging from China?
It's a combination of things, Lisa. Number one, I think the component increases, as well as the energy availability, the access to power, if you will, is now becoming an issue on the street. The component increases, if you look at memory's up almost 330%. Other components are up a good 25%. So if you're a project finance manager or doing project finance debt, your assumptions are kind of out the window. Number two is, from a structural standpoint, I look at the funding of this AI trade kind of as a football game in 4 quarters. The first quarter, we were financing essentially the frontier models. And if you look what's happening on open source models and token costs, and what Dr. Karp said interviews a month ago, the models seem to be changing. And with the proliferation of open source, I think that changes the models of AI in a way that it's not steady state like the frontier models would like to have it. It's not just going to be an OpenAI / Anthropic debate here. There are other players, whether it be China or the US. Look what NVIDIA did with Palantir. The deck chairs are being rearranged as we steam here.
Yeah, I love that you mentioned that, Ted, because it was interesting to see that NVIDIA and Palantir put out an open letter saying that open source is really important. And notably, it was not co-signed by OpenAI or Anthropic, which are suffering considerably in terms of their potential profitability. Do you see this world as shifting, where suddenly the pain in semiconductors isn't going to help hyperscalers, and pain in hyperscalers isn't going to help semis, and that ultimately you have to see both of these rally in tandem with potentially some losers like that frontier model cohort?
It's very dynamic right now, and I don't look at it from the macro perspective. I look at it from my client's perspective. My portfolio manager is getting hammered on the semi trade. If you were up, for example, almost 105% year to date at the peak, and now you're up 56%, and you decide to jump in the semi pool at the top, you're getting absolutely annihilated. So this is a game of attribution, and when you cannot predict the way the market is going, you tend to move to other sectors. And that's my biggest worry, that we drain the semi pool, and we drain kind of from a shoot, ready, aim perspective away from tech, and that's the wrong trade. But nonetheless, I really focus on my portfolio managers that are, in most cases, struggling just on attribution versus the benchmarks.
Ted, what do you think the right trade is right now?
I think the right trade is not to trade. I think it's to hold your core positions. There are some people, in the market that are de-risking their portfolios. You can see it in the longs being sold and the shorts being covered. I think the trade is, you just have to get this phase of initial disillusionment past us and really focus on the second half. From a seasonal standpoint, summer's always problematic. This time frame, August time frame, is always weak. And I think some of the portfolio managers may just be taking some, quote unquote, time off until we get to the end of September, where we get a real seasonal uptick in tech based upon not only enterprise spend, but this AI trade. So I think it's just time to take a deep breath and own the best names in the sectors.
And then we can talk about the midterms. Can't wait. Ted, thank you. Ted Morrison there of Ben. That's what Julian Emmanuel said to me in the green room this morning. First thing I walked in, and he said, a few months' time, what we'll be talking about. He was like, midterms, can we wait until the end of...
Talking about it now.
Like end of September. Let's wait until the end of September to deal with that.
Yeah, because right now we've got other things to deal with. I love that we've got portfolio managers and investors that come on, take a walk, take a deep breath.
Touch grass.
Touch grass. Maybe don't don't trade.
That's quite the year from Jim Zelter of Apollo so far,
Touch grass, take a walk.
Touch grass.
Yeah, I mean, I think that given the frenetic pace of news, I think that all of us feel like that would be a good advice.
Nasdaq futures this morning up a few tenths of 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. UBS shares gaining in Swiss trading. The bank launching a $3 billion buyback program after reporting a quarter in which wealth management assets beat estimates and trading revenue surged. South Korea planning to hold an emergency meeting to discuss the latest market rout that wiped billions of dollars from the Kospi. The meeting will be hosted by the country's finance minister and will involve all of the country's top financial authorities. China reportedly holding talks with Yemen's Houthis to discuss allowing its tankers to safely sail through the southern Red Sea. Reuters reporting Beijing asked for safe passage after the Iranian-backed militia pledged to block access to Saudi ports. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in the next hour in about 30 minutes' time. Up next on the programme, seeking clarity from the Federal Reserve.
The lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. We really have no idea how Kevin Warsh thinks about monetary policy.
Up next, Claudia Sam of New Century Advisors, live from New York City. You're watching Bloomberg TV.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
equity futures positive here by 0.2 on the S&P, on the Nasdaq by 0.13. It's a bounce back on tech this morning, at least for now, following 5 days of losses on the Nasdaq 100. In the bond market, going into this Fed decision later on this afternoon, overwhelmingly the consensus is no change. But just on the margin, there is a chance. And I'm telling you, there's a chance of a rate hike, and it's a low conviction consensus this morning.
Well, given the fact that we didn't have people necessarily coming out and voting for a hike last time, there were no dissents last time. At the same time, you did see a number of Fed officials say that they do expect a hike this year, and there are 8 basis points of hikes being priced in. It seems like it would be really, really strange for them to do it with a lower than 50% chance getting priced into Fed futures.
Twos this morning around 4:30, yields higher by 3 basis points. Under surveillance this morning, seeking clarity from the Federal Reserve.
The lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. We really have no idea how Kevin Warsh thinks about monetary policy. He doesn't have to give us any forward guidance, but we would know sort of how to weigh the incoming information.
So here's the latest this morning. Wall Street expecting Fed Chair Kevin Warsh to deliver a hawkish hold later on today. Some traders still preparing for the possibility of a surprise hike. Claudia Sam of New Century Advisors writing, Warsh has managed to make the Fed an even bigger focus of attention by saying less. Uncertainty around economic policy was already high. The last thing we need is the Fed adding to it. Claudia joins us now for more. Claudia, welcome to the program. Do you think that Chair Warsh is contributing to the kind of volatility that might be harmful?
So we are seeing that Chair Warsh is contributing to volatility. Now, where it's most clear is in the federal funds futures market, right? So coming in yesterday, there was still about a 30% chance of a rate hike today. That may not sound like much, but that is very high for that close to a meeting. The only time we have seen uncertainty like that in the past several years have been big moments like liftoff in 2015 or the first rate cut in 2024. There was a lot of economics going on and lots of disagreement on the committee. This time, the uncertainty, that comes from a chair who has gone really low information on how he's thinking about policy.
Low information on a range of things, and Claudia, you pointed out the difference. It's okay to stop providing forward guidance, but he's also failed to articulate his reaction function. What kind of questions do you have for this news conference?
I think one is just to ask Kevin Warsh about his own past words. When he worked on the Bank of England's communication review in 2014, he recommended that they give timely feedback on what the decision was, the rationale for the decision, and he even talked about the importance of a reaction function. So what's changed? That's been over a decade ago, and his thinking could have changed. But I agree with that Kevin Warsh about how he thinks about communication, and I'm having a hard time with it in this moment, though I will say we got all of that information by the time we got to the June FOMC minutes. So it may just be Kevin Warsh wants to change the format we get the information, not necessarily that we get less information. I think it'd be a really good idea to at least get it into the statement today if he doesn't want to say it in the press conference.
Claudia, what are you expecting in terms of the breakdown of dissents versus the majority opinion?
I expect that we probably will see some dissents today in favor of a hike. Lori Logan and Beth Hammack laid out very clear explanations for why they thought, if not right away, maybe sometime soon, it would be wise for the Fed to raise rates to bring inflation down. That doesn't mean that they're going to dissent, but I think they really set themselves up to have that, kind of weigh in that way, because dissents need to be meaningful. People do that when they really feel at odds with where the committee is standing at the moment. Another wild card to keep an eye on, we have seen dissents in recent past on how the statement itself was worded, like what kind of information is conveyed, this idea of do you get a reaction function, get any forward guidance. So I think the statement could be pretty interesting this afternoon in terms of learning where the committee as a whole is.
Do you think that right now inflation is a preeminent concern or excesses and volatility in tech sectors? And I'm wondering this because ultimately the wealth effect has been one of the biggest drivers of a lot of the sustainability and spending. So you can't disentangle these two. And you can hear it in some of the rhetoric from Fed officials over the past couple of weeks.
I would put what's happening with AI in the tech sector largely into risk that the Fed is monitoring. It has had some effect on inflation, so that is something very clear and direct to their mandate. I think I would use what's, the uneasiness in some of the tech sector as just another reason why the Fed doesn't need to be injecting more uncertainty and volatility into the situation. Like if market pricing of interest rates gets out of hand because we don't talk enough to the world, that could be really unfortunate and have effects on other sectors. So I think they're keeping a watchful eye on it, but I would put a lot of that into the kind of the risk bucket, as opposed to something the Fed is going to directly try to react to.
Well, we know they're going to directly try to react to data, but what about oil? What's the timeline on their reaction function to the whipsawing we're seeing in crude?
Right, so this, I think, is one where it really would be helpful to get more information from the Fed. In the minutes, they lumped together a whole set of reasons why inflation is elevated, including the conflict in the Middle East, but also the AI demand and tariffs. The thing is that historically the Fed has been very wise to look through swings in energy prices. There's a lot of volatility. I mean, we have seen that just in recent weeks, if not recent months. And so for the Fed to chase oil prices, it has proven to be a mistake. But if you watch like the futures pricing for the Fed, it's clear that markets are reacting to that. Like that piece of inflation, they think is something the Fed will be very reactive to. And I'm not so sure. It might be. This time is different. They're impatient with inflation and they react to that inflation. But that would be a bit off the playbook for them.
Claudia, it's always good to see you to get some clarity. Claudia Salm of New Century Advisors, some much needed clarity on this institution right now. Just working through the voting members going into this decision, where could the dissents come from? We talked a lot about Hammack of Cleveland, Logan of Dallas, maybe Kashkari of Minneapolis, maybe that's 3. It's the board that gets interesting for me. Never mind the regional Fed presidents, they are open to expressing their opinion. It's the board. Chris Waller, Fed governor, he offered us some data contingent guidance going into the last CPI print. And he effectively said, if it comes in hot, I'm going to vote to hike. Paraphrasing, but he went there. That came in soft. It would be a big surprise if we had the likes of Governor Waller voting for a hike later on this afternoon.
Yeah, although he has come out with rhetoric talking about his impatience with inflation being where it is and talking about concerns about the credibility of the Fed. And clearly he's clashing with Kevin Warsh, according to the Wall Street Journal reporting yesterday. So you put that together. And then you have, Schmidt, that's also a regional Fed president. But you've got these questions right now. Where is the focus at a time where a number of people have remained quiet? I'm thinking of the former Fed chair, Jay Powell. And you have other people who are keeping a higher profile, who are coming out with some pretty strong things to say.
Jay Powell keeping a low profile. Christopher Waller, what's so interesting about Governor Waller is he said, though, I think what everyone on the committee was thinking when it comes to these task force. Tell me who's leading them. I'll tell you what they're going to tell you.
More on the Federal Reserve in the next hour. Dan Suzuki of iCapital, General Karen Gibson of Academy Securities, Amy Gower of Morgan Stanley, and the former Kansas City Fed President, Esther George. The second hour of Bloomberg Surveillance just around the corner.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions.
a poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
The lack of consensus on what the Fed is going to do is exceptionally high right now.
We really have no idea how Kevin Warsh thinks about monetary policy.
He's hoping that he can sort of wait out this inflation.
I don't see the rationale for a rate hike.
This meeting puts them on a hold.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures bouncing back by 0.2% on the S&P. Yesterday, all-time high the equal weight. 5-day slide on the NASDAQ. The NASDAQ this morning up only a tenth. In the bond market, heading into the Federal Reserve decision later on this afternoon, 2s, 10s, and 30s look like this. Yields higher by 2 or 3 basis points on 2s to 431. In the commodity market, happen to drive that move, this bouncing crude. Here's the move. WTI and Brent higher by 5% this morning. 88 on Brent, 83 on WTI. Later this afternoon, a double dose of Mag 7 earnings. That comes after the closing bell. Before we get there to Microsoft and Meta, we have to deal with this at 2 p.m. Eastern Time, a Federal Reserve decision.
And they're coming at a time where the market's pricing in a greater chance of Fed rate hikes than they were at the June 17th meeting. You have about 8 basis points of rate hikes getting priced in. It would be hugely surprising for the FOMC to raise rates, given that you're not seeing a significantly above 50% chance of a rate hike being priced into the market. That said, they want to continue some of the anxiety that's going on because that can help suppress the inflation that so many of them are concerned about.
And this is going to be incredibly important because potentially we're going to get some dissent at this meeting. And then Missoula put out a note saying it's not about if the Fed is going to hike, it's about when. And potentially those dissents mean that potentially we could see a hike this year, even before what I think is interesting, midterm elections. Some people are saying it's September.
And that's the first risk event. And then we get a double dose of Mag 7 earnings later on this afternoon. And that is a risk event for those two names. Those two names have been trading in a bear market for much of the last month or so. And the bar for the others, the bar for the high-flying chip names, has been sky high. Intel, Samsung, now SK Hynix, tremendous numbers, failing to spark a rally.
Yeah, 80% margins, not good enough. 557% increase in operating profit, not enough. Ultimately, how much does this say more about positioning, as you said earlier, and less about the actual fundamentals? Interesting to see what the reaction is going to be in semis to the hyperscaler earnings. Let's say Meta and Microsoft announce CapEx plans that are bigger than expected, which is sort of the way of travel, the path of travel over the past couple of earnings seasons, and they sell off and the semis continue to sell off. What could potentially stymie some of the weakness that we've seen in both sides of a trade that until this year we're still firing on all cylinders?
We got a taste of that last week. Alphabet were punished for spending, Tesla was punished for spending, and semis rallied on the week by about 1%. Struggling to get off the map. So we've had a taste of that already. If that continues, then we're in a world of pain for the tech story, and for that matter, the index as well. At the index level right now, though, what are we? 3 and a bit? away from all-time highs, 3 percentage points plus. We haven't seen that damage at the index just yet.
And part of it is because the rest of the economy is doing so well, and you've seen the outperformance in name after name that's reported earnings. When you take a look at since that June 17th meeting, you've seen the tech sector, the NASDAQ composite, down almost 6%. You see actually the equal weight up on that time. You see the Russell 2000 up 0.5%. So this isn't coming from weakness in the broader economy, and as long as that can continue, it can offset some of the pain in some of the more momentum trades that are seeing the biggest downdraft that they've seen going back to 2009.
The banks haven't had a down week since the end of May. That's how great the run has been for the banks on Wall Street. Coming up this hour, we'll catch up with Dan Suzuki of iCapital as stocks regain footing ahead of big tech earnings. General Karen Gibson of Academy Securities as a surprise attack by Iran has crude spiking, and the former Kansas City Fed President Esther George expecting today's family fight to end in a hold. We begin this hour with stocks looking to build momentum heading into a blockbuster day for Wall Street. Dan Suzuki of iCapital writing, a robust macro backdrop should fuel a second straight quarter of 20% plus earnings growth. With tailwinds fading in the second half, this may be what peak growth looks like. Dan joins us now for more. Dan, good morning.
Good morning.
Welcome back, buddy, and congratulations on the new seat. It's good to see you.
Yeah, great to be with you guys. Love this show.
Let's draw a distinction between peak growth and peak markets. How wide is that distinction this morning?
It's clearly not very distinct, right? I think like in normal markets, it's really more about peak earnings than it is about peak growth. But I think when expectations get really high and the bar is set so high, peak growth is all it takes to sort of get expectations to be too high to meet. And that's kind of what you're seeing today in the AI trade.
Lisa talked about how high the bar is for the chips name. The likes of Intel, the likes of SK Hynix, the likes of Samsung. How high is the bar for the hyperscalers? A couple of names that have been beaten up quite a lot.
I mean, I think what you're seeing, this earnings season is that the bar is set too high for any stock associated with the AI trade, right? And it's not to say that the underlying fundamental story is not good, but the bar is just being set too high. So you can't see any stocks that are up on their earnings results. And I think the way to think about it now is the bar is set so high, the new beat is, call it a 10% beat on earnings and a lower CapEx guidance. I think that's the thing that's going to get stocks to rally.
So this is an area that's controversial. You think that if they underperform, or at least they lowball the CapEx plans and they come in lighter than expected, that would be a case for rally more than anything else. Is that correct?
I think that's part of the story. I think you want to see underlying strong fundamental trends, but also an eye toward monetization of all this investment spending that's happening. And this is something we've been talking about at iCapital for a while. I mean, we call it the AI CapEx vigilantes. And you're seeing the vigilantes are winning these days, right? And you're seeing everybody's waking up to this story, whether it's the hyperscalers, the semis now is a sort of second derivative of that. And I think that's really what's coming to play. So what the market wants to see, what the vigilantes want to see, is signs that there's an eye toward the monetization of that investment.
Do you want to get on the vigilante train and overweight some of the fixed income instruments that have leverage right now and not necessarily go to the equity side of the equation?
No, I think both sides, the reality of what's happening right now in markets is that the markets are waking up to the risks associated with the AI trade across the supply chain, right? And it's not to say that the underlying fundamental story is broken, but there's a lot of good things happening, but there are obviously a lot of risks. Moats are weak. Pricing power is weak, CapEx is very high, and when you get sort of price wars and price pressures and competitive environments in a hugely capital-intensive industry, that typically, causes a lot of shakeout and volatility in some of the names, and I think that's what you're seeing now.
Do you see any evidence that some of the AI trade is starting to move to other industries that are starting to use and adapt AI quicker?
Yes, absolutely. It's hard to find, I was just talking about this the other day, it's hard to find an area of the market that's not an AI trade, right? It used to be emerging markets, that's as far as you can go. Now emerging markets is an AI trade. Utilities are an AI trade. Real estate is an AI trade. I mean, where do you go that's not an AI trade? And that's what you're seeing that's up right now, right? You talked about since sort of the May highs, all this stuff is down, but look at all the stuff that's up double digit. That's sort of the other side of the seesaw, the anti-AI trade, if you will.
What are the banks? How would you describe that rally we've seen in the financials?
Yeah, that's part of the story. The underlying fundamentals for the banks are strong, but at the same time, this is kind of the rotation that Lisa was talking about. Like, there's other stuff putting up good growth and accelerating growth at a time when people are starting to think about the risks associated with AI. And I think financials are part of that, small caps are part of that, values are part of that. And I think people are just understanding that there's more to the world and to the markets.
Dan, that doesn't scream growth scare. And these are the rolling shocks we've been talking about through energy, through interest rates, through the bond market, but it hasn't materialized with a growth scare. Is that on the horizon? How avoidable do you think it is?
Growth scare, I mean, you have to help me define that, John, because I think one of the two other things that we highlight as risks for the second half of the year are sort of fading tailwinds to the consumer, and then also higher for longer interest rates. Both of those things are actually happening. And so I think that our base case is that growth does slow in the second half of the year. The real question is how much. And there are a lot of tailwinds that are mounting, and liquidity, we're probably past peak liquidity for the year. You know, this is not a great environment for accelerating growth.
Just sit on that point of tension just for one further beat. You can see a situation where the consumer tailwinds slow, but rates remain elevated.
Yeah.
Can you explain that?
Yeah, I mean, I think if you just look at the sheer amount of tailwinds that have been boosting the consumer, whether it's tax cuts or just the reopening of liquidity, there's been a lot that's gone into boosting the overall economy in the first half of the year. Just look at any measure for the second half of the year, right? We've already paid out the record, tax refunds. That's sort of in the rear view. They're still in their pockets, so they can still spend that. World Cup is now behind us, unfortunately. Liquidity is tightening up. So as you look at the second half of the year, it's more likely than not that growth is going to slow. But, inflation to me right now comes down to what's happening in Iran, right? And so whether or not the Fed hikes or whether or not inflation accelerates, to me, that's an oil story right now. Even though they say they're going to look through that, when you have tariffs and oil, two shocks, I think that makes the story a bit more difficult for them.
Putting oil aside for a second, if you do think that there's going to be a slowdown in growth heading into year end, are you expecting rates to go lower, at least the Fed funds rate, and potentially not glean a whole lot right now, but more by that going forward about Kevin Warsh?
This is why we had the base case that, we're going to have the Strait of Hormuz was going to open up, growth was going to slightly soften, and that was going to keep the Fed on hold for the rest of the year, and that's still our base case. But I think oil is the wild card, and that's going to really drive what happens with interest rates. If you take out what's happening in Hormuz, I think interest rates do fall into the end of the year. But if you reintroduce this story, I think you're seeing an increasing risk that at the September meeting and beyond, you start a hiking cycle. I think that's what the Fed is telling you. There's if you look at the Fed minutes, it was basically a scenario analysis of what they plan to do based on what happens with inflation, which is very much driven by oil.
Why wouldn't they look through it? I mean, we've been talking to one analyst after another about how they always look through oil, and actually that the inflation coming from other areas seems to be more prevalent, including capital markets, which seem to be slowing down, at least if you view what we're seeing in the wake of earnings. It's
just going on for too long, right? And inflation's too sticky for too long. He keeps hearkening back to the mistakes that were made after the 22 oil price spike and the inflation that we saw. Then, we're looking at it. Just listen to what the Fed, speakers are saying. They're saying, if this keeps going, I'm going to start hiking rates. I want to start hiking rates. And that's what they're telling us. That's what the minutes told us. And so, yes, in all else equal, they're going to look through tariffs. They're going to look through energy. But the more that this goes on, the more that bleeds into inflation expectations. And by the way, core PCE, what did that bottom 2 years ago? And that's been rising. I mean, these are not good trends for the Fed to sit on.
Dan, I've missed you. It's good to have you back. Thanks for being here.
Thanks for having me.
Thank you, buddy. Dan Suzuki there of iCapital on this market, heading into this Federal Reserve decision later on this afternoon. Equity futures right now positive by 0.2. Let's get you an update on news worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. BMW is cutting about 8,000 jobs globally. The car maker is offering voluntary severance packages to corporate and research staff. BMW aiming to streamline operations and cut management ranks to better compete with rivals from China. Porsche reporting earnings that beat expectations, anchored by the success of its high-margin 911 sports car. Operating profit jumped 34% to $1.5 billion, shrinking sales in China and U.S. tariffs continuing to weigh on the company. Meta CEO Mark Zuckerberg saying the U.S. administration shouldn't block Chinese AI models. In an interview with the Financial Times, Zuckerberg saying regulations pushed by leading American labs could stifle domestic competition. Zuckerberg adding that restricting the most advanced models is the wrong approach to cybersecurity. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later on this morning. Up next on the program, reigniting hostilities.
We're locked and loaded and ready to go, but we're talking to them. Honestly, they haven't seen anything yet. We've been nice. Every time they hit us, we're going to hit them 20.
Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
It's going to be a long one at 2 p.m. Eastern Time. We'll hear from the Federal Reserve. 30 minutes later, we'll hear from the man in charge. We'll hear from Kevin Walsh, the Fed chair. How much is he in charge right now is a notable question. After the closing bell, we'll hear from Microsoft. We'll hear from Meta. A double dose of Max 7 earnings after the closing bell. Into that, your scores look like this. Equity futures on the S&P 500 bouncing up 0.2%. The Nasdaq sliding for 5 consecutive days. Bouncing this morning by a third. Within the Nasdaq, the chip players really struggling, Lisa. 4 days of softer stock stories for the chips over the last week.
Yeah, part of this is a positioning story. Part of this is the China competition story with the potential for them to introduce a cheaper competitor to offset some of the incredible demand for memory chips. And some of this is a feeling that you cannot continue to have 80% margins for a very long time before somebody is going to try to disintermediate and compete with you. And ultimately, how much is their profit sort of a problem of their own making, as we heard Jason Thomas of Carlyle say yesterday.
Your margin is my opportunity.
Exactly.
Right, like if you're putting up 80% plus margins, hello competition. It's an invitation, isn't it?
And frankly, that's capitalism. And that's what actually should happen at this kind of point. And frankly, you're seeing the costs for CapEx go up so much for a lot of these hyperscalers because of the component costs from things like those memory
So you've got the threat of increased competition and capacity. You've seen evidence of stretched price and positioning. You can see that in the way the stocks have responded to fantastic earnings. And now you're starting to see this take place. We're starting to think more and more about the financing of the ecosystem and an increased cost of capital. In the bond market this morning, 2's around 430, 10's around 460. The cost of capital, not just for the Treasury, but also for the tech names. And maybe, you know, it's an odd world we live in now, where the Federal Reserve might be even more important now to the tech names, and the tech names might be even more important now to the bond market, which was something you mentioned a few days ago.
In some ways, the tech names are the big duration play right now. They've been borrowing a lot of money on the long end of the yield curve. They have expectations baked into their valuations that go out a decade or more, that they could potentially continue to have these types of profit margins and profit increases. And right now, there is a question about what they're doing to the economic growth. All of this coming together with Julian Emanuel saying, you know that you have a problem when stock investors start looking at credit default swaps of individual companies, and that is where we are.
And auctions, too.
And auctions.
You know, like, you know.
Well, you know, I think everyone
I track that on X when I start to see people post the headlines of the results of how much a particular maturity tailed and people freaking out and stuff like. Oh my goodness. When I see that on my radar and then I check the account and usually the hits are like all about equities, and then there's this one straight headline
2 basis point tail.
Right.
Yeah. I saw it.
Then you know that maybe things are a little bit stretched.
Well, people are looking for a narrative too, that this is sort of coming from those credit markets and whether maybe we're getting to the end of that or whether we're just beginning. I don't know. It's a new narrative. Freak out about credit and watch the auctions.
Freak out about Brent as well, up 5% this morning, 88 on Brent. Let's talk about the situation. Under surveillance this morning, reigniting hostilities.
We're locked and loaded and ready to go, but we're talking to them.
Every time they hit us, we're going to hit them 20.
When they hit, we hit. We use their language.
Honestly, they haven't seen anything yet.
We've been nice. We want to get it over with, and we want to do it right.
It's not over. Here's the latest this morning. Crews rising as fighting resumes across the Middle East. The U.S. intercepting surprise Iranian strikes on army bases in the region. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, new within the last hour, we're tracking closely whether the U.S. has resumed strikes against Iran this morning, as Iranian state media reports that a missile hit in the country's northwest near the border with Iraq. Now, we should say the U.S. has not confirmed this, but it does come after significant escalation overnight, with CENTCOM saying that it successfully intercepted multiple missiles fired by the IRGC at U.S. forces. And there is this renewed focus on Iraq as potentially another new front in the war after we saw U.S. and Saudi forces team up overnight to hit targets there after Saudi Arabia claimed that Iranian-backed proxies in the country fired drones. Washington has been trying to dilute Iran's influence over these proxy groups, with President Trump telling me earlier this week that the U.S. remains in constant contact with Saudi Arabia about the Houthis in Yemen as we continue to see disruptions to commercial shipping in the Red Sea. Pair that, of course, with now continued disruptions in the Strait of Hormuz amid very little indication that Iran is willing to let up its leverage when it comes to commercial shipping. And John, new overnight, we got this statement from Iran's foreign ministry appearing to reject a new proposal by Oman that was geared towards opening the strait. It would have utilized that so-called middle passage, giving both countries joint control. But Iran is saying that their country is only vying for what they said would be total control over any traffic transiting through.
Tyler Kendall in Washington, D.C. To add to this, General Karen Gibson of Academy Securities writing, we may see alternating periods of tension, strike and diplomatic activity in the weeks ahead. Even if tensions die down, they could create a persistent environment of elevated risk. General Gibson joins us now for more. General, what would it take, and welcome to the program, what would it take to break out of this uncomfortable new normal?
Well, you know, that's the big dilemma, Jonathan. I think settlement seems distant. That's very disappointing news that Taylor's just delivered regarding the Omani proposal for joint management of the Strait of Hormuz. There are simply no indications that Iran is willing to compromise at this time. Their priority is to gain recognition of control over the Strait of Hormuz. And there's no doubt that their economy is, which was already weak, is degrading. There are signs of some internal divisions, but let's be clear, it's the security state that's running the show. They don't want to return to full-scale warfare, but they seem comfortable with this current state of limbo. They're prepared to absorb additional U.S. strikes. They believe they're in a position of strength and have tremendous leverage over the president, and I think they think that time is on their side.
General, do you see a scenario where this administration capitulates on the Strait of Hormuz and allows Iran to just control it and everyone has to pay a toll?
Well, I'm not a domestic political analyst, and, you know, assessing our own administration's policymaking is not my forte, but certainly I think that is what Iran is angling for. And the extension or the ramped up strikes in Saudi Arabia are interesting from a couple of standpoints. I mean, it is proxies that are doing this, and proxies, particularly the Houthis, tend to act in their own interests, even when they're aligned with Iran. But it could perhaps be part of a broader strategy to raise the pressure on not only U.S. allies, but those who contribute to the oil markets to bring the U.S. to some kind of compromise that we had not previously considered. And I understood that the Omani proposal did, in fact, have regional backing. Our regional partners want to see an end to this. It's very difficult for them economically. It's also difficult for them from a security perspective. But their dilemma is that we can't end this with an Iran that is still powerful to continue to conduct these strikes against them. And I just don't see a ready solution to that in the near term.
Well, one regional partner entered the fight yesterday. How much do you think of what happened last night is about containing the militias in Iraq versus more of a strategy and showing of hand the fact that Saudi Arabia joining in with the United States on these strikes?
Yeah, that's a great question. You know, having proxies is a bit of a double-edged sword. On the one hand, it gives deniability of responsibility for actions that occur. But on the other, they aren't always fully an entity that can be controlled. The Houthis, for instance, are very willing to accept Iranian financing, Iranian lethal aid, particularly sophisticated weaponry, Iranian intelligence, but not always Iranian instruction. And so I was not surprised that the Houthis began to engage the Saudis. They have a long-running dispute. They've fought 2 wars together, even preceding the Houthis' alignment with Iran. The Iranian-aligned militia groups in Iraq are a different story. And I think in some ways more easy to direct. That was a bit more of a surprise. And I think, frankly, at some point could potentially backfire for Iran if, in fact, they continue to act up.
General, how far could the Saudi Arabian involvement go? I mean, do you expect further military action proactively by them?
Well, I'm surprised, a little surprised that the joint effort with the Saudis and the U.S. was directed into Iraq and not against the Houthis down in Yemen, which has been a persistent thorn in the side of the Saudis. You know, the Saudis, Iran is, again, another area where this may backfire. The Saudis had been working on rapprochement with Iran for years, and they're setting that back. As I understand, there's credible reporting that the Saudis are the ones that convinced the president to stop Operation Freedom after a single day because of potential threats to the East-West pipeline. So the Saudis, I think, you know, they're pushing hard potentially to get them to urge the United States to come to some kind of settlement, but they have to be careful not to push too hard, so hard that the Saudis also, you know, become more kinetically engaged.
General, it's good to see you. Thank you. General Karen Gibson there of Academy Securities. The last couple of lines there, I think reaction to your question, quite important. Surprised that the Saudis didn't hit the Houthis, which makes you wonder whether they're next.
Yeah, given the fact that they've had a long-standing conflict, they had some sort of ceasefire, believed to be sort of grease the wheels by payments from Saudi Arabia to the Houthis. Now you've seen the Houthis threaten the Red Sea. Does that start to change, considering the actual threat to their financial welfare?
It's all these militia groups. And when you have drones coming from Iraq into things like trying to target Abqaiq, which we've seen in the past, take out massive Saudi supply, they're going to have to do something in terms of setting deterrence.
Iranian forces have been increasingly provocative. We saw that even through the diplomatic phase, and I think the stories circulating stateside about U.S. stockpiles of ammunition are not helping America's cause right now at all.
Absolutely not. They're taking advantage of this moment right now, as well as the fact that it's ahead of a midterm election. They want to see a premium on crude.
Brent Crude at 88, live from New York. You're watching Bloomberg TV.
most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
So here's your bounce to the equity market on the S&P 500 up by 0.25% on the Nasdaq following a 5-day slide on the Nasdaq 100, the longest since the start of the year. We're higher by 0.3%. Within that, the semis down for 4 consecutive days. Haven't seen a run like that for the year so far. Elsewhere in South Korea, look at this for a range on the Kospi. At the lows, down by more than 12%. At the highs, up by more than 3%, down 6%. That is a crazy session in South Korea, and it's caught the attention of officials in South Korea as well, said to be having a meeting with the finance ministry.
Yeah, the Kospi is trading like a meme stock, and that's a real problem for them, considering the fact that it's more volatile than Bitcoin so far this year. A lot of leveraged funds that are involved with this, a lot of retail involvement. And it's led people to pull back from the overall index, because how do you price volatility like that? You can't, so you walk away, even if you have 557% increases in operating profit. This is the reason why regulators are getting involved, but this is also the reason why people are having a hard time understanding what some of these valuations are anchored to. Is it anchored to highly leveraged positioning, or is it anchored to something fundamental?
I suggest a lot of wealth also created in South Korea as well. We'd often talk about the stat to just how much Samsung accounts for South Korean GDP. I think the increase in wealth you would have seen off the back of this run-up in the stock market, that index, Samsung and SK Hynix alike. It's a lot of money at stake here too, and that market risk becomes an economic risk, which is something you touched on, Bramo, earlier this week with regards to the United States. We haven't got a real economy scare in America right now. We don't at all. I'm not going to go there. You can't see it. But the wealth channel is important here, and if you get a pronounced downturn in the equity market, we don't have one just now, but if you do, then you can have a problem in the economy as well. And maybe what's happening in South Korea right now might be a case study for things in the not-too-distant future.
You know, Fitch Ratings came out with a report earlier this week talking about how AI is increasingly a credit risk. And it kind of speaks to your point. You're talking about the wealth transmission, the idea that the wealth effect has really bolstered a lot of consumer spending. You're talking about just more broadly with the overall economic growth. You start to see a retracement in that. All of a sudden, you can see some fundamental issues percolate, not just here in the United States, but globally.
That's the equity story. Here's the bond market picture. 2s, 10s and 30s, yields creeping higher, up a few basis points, just anchored around 430 into the Fed meeting later on this afternoon, closing around 418, around mid-June, the last time the Fed met, by the close of day. So we've added 10 basis points plus to the 2-year and settled there. And we've anchored around the upper end of this new range, going into the Federal Reserve meeting later. And we're trading above the policy rate of the Fed by, let's call it 50 basis points. How much of that 50 basis points is because this market believes with conviction this Fed will hike? How much of it is just about baking in some risk that they might? Because we've got a new era at this Federal Reserve with limited forward guidance.
In some ways, Kevin Warsh's challenge is to keep market pricing here without doing anything. Because ultimately, this is not a Fed that wants to hike. That is quite clear in terms of the waffling and just the fact that they moved from an easing bias to a neutral bias at the last meeting. I mean, this is how far we'd be going if they actually did hike rates. But at the same time, the tightening that you're seeing is marginal enough to take some of the froth out of the market, and they should take comfort in that, but not necessarily take it too far.
The energy move is helping that bond market move this morning. The move in crude looks like this. Let's call it higher by 5% at the moment, up 5% on Brent at 88. WTI at 83.
We're back to strikes after a relative few days of calm. At the same time, the Strait of Hormuz remains closed. The Iranians are not playing ball with the Omanis on trying to open it up. Aramco is talking about potentially having to adjust prices. Neil Dutta wrote in, he said, for the Fed, this is fool me once, shame on you, fool me twice, shame on me, sending me the Brent and WTI links. Basically saying the Fed cannot look through this anymore. It's too rampant when it comes to what is going on in Iran.
The Iraqis weighing in on the strikes that took place in their territory, saying the following: they reject the use of Iraqi territory to launch attacks. Saudi-US attacks are unacceptable, a violation of sovereignty. Those headlines crossing just moments ago.
So, hey, Iran, stop using us through our proxies to shoot missiles.
Right.
Saudi Arabia, stop attacking us. Why are we the victim? They're saying, please keep us out of it. Good luck.
It's messy. It's still messy, and it doesn't matter if there are talks or if there are strikes. This is an uncomfortable new normal, toggling between one and the other, back and forth, back and forth. As we count you down to the open about a few hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Well, here's a clean story. We have Global Foundries, the chip maker, up 9% in the pre-market after landing a $300 million award from the U.S. government. The funding will be used for the company to develop technology that allows AI chips to communicate faster and more efficiently. But it's just the latest sign of Washington trying to bring that advanced chip supply chain here to the U.S. rather than relying on overseas suppliers like TSMC. Let's get to the earnings we've gotten this morning, because we've gotten quite a few. And we start with Humana. The health insurer is falling 7.7% in the pre-market after it beat on second quarter profit, but it left its full year guidance unchanged. And that was a problem for investors since shares had run up some 50% so far this year. It's just the latest sign of the market punishing companies unless you really beat across the board. And we get a check on the consumer with P&G, the company behind brands like Tide. It is down 3.4% after missing expectations and offering a cautious outlook. And that's largely because the company says it is no longer raising prices, afraid of customer pushback. And that's a problem because P&G is facing higher costs from things like raw materials and transportation. And that pressure is already showing up in the earnings. Earnings fell from a year ago for the first time since 2022, and all 5 of its business segments missed sales expectations. John?
Yahira, thank you. Thank you for the update. More from Yahira in our next hour. On our radar this morning, SK Hynix reporting a nearly 6-fold surge in quarterly profit that missed sky-high expectations. The next test for the AI trade on deck with Microsoft and Meta. They report after the closing bell. Samsung, Apple, Amazon due tomorrow. Elsewhere, NVIDIA CEO Jensen Huang meeting lawmakers on Capitol Hill in a bid for open-source AI models, calling them essential for safe adoption. OpenAI CEO Sam Altman is expected to make his way to Washington for similar discussions later this week. And finally, the Meta CEO, Mark Zuckerberg, saying the US should not ban Chinese AI models. Zuckerberg telling the Financial Times that US companies need access to their competitors in order to compete with Beijing.
They want to be able to keep up. It just strikes me that the users of these models want them cheaper, that the creators of the frontier models are like,
You shocked? Do you think there's book talking going on here?
And it's like at a certain point, you have to imagine that the hyperscalers and anyone adjacent to them want the costs of these models to come down. Open source helps do that. It gives them more optionality and, frankly, more access to more markets. Likely the frontier models are a little bit more hesitant to say that, and you're hearing that from some of the commentary from the likes of Anthropic.
Well, when you look at what Mark Zuckerberg said, it's not even just so much about China, and FT talked about this. Him warning about the risk that AI might become centralized in the hands of a few powerful groups appeared to be a broadside against his rivals, Anthropic and OpenAI. And this will be on full display this week, not just the fact that Jensen was there last week, but today, tomorrow, you're going to have Sam Altman there. And that's at a company that's also dealing with a huge risk right now when it comes to an agent getting out and going after actually another company, not just the one we heard about last week.
There's a lot of inside interest here, right? Meta does not have a model. They are potentially pivoting towards becoming somewhat of a neo-cloud maker, a neo-cloud provider. That bolt-on, it's been the talk of the last month or so. And maybe they're going to sell some hardware into China too with the Meta glasses. I don't know. Like, it's very difficult to listen to these people and not be cynical right now.
How can you not be? I mean, the fact that Meta, that NVIDIA, that Palantir are all saying, you know, we need to open the doors. Well, guess what? They benefit quite a bit. And then you got the people who stand the most to lose saying, regulatory issues, concern, distilling, etc.
You need to regulate us.
Yeah, please regulate us.
Right, of course, yeah. Meta and Microsoft reporting a little bit later. Let's talk about commodities. Gold remaining steady ahead of today's Fed rate decision. Amy Garrett of Morgan Stanley saying a hold could create a path for the precious metal to rebound back towards 44.50 by the fourth quarter. Amy joins us now for more. Amy, welcome to the program. Let's talk about what's held back gold. Let's start there. I think that's a good place to start. What is holding gold back so far after that massive run-up over the past few years?
Yeah, look, I think 2026 has obviously been a much more challenging year for gold than 2025. And I think, look, with the conflict, we've had two big headwinds for gold. So one, we had central bank gold sales. So you know, the last few years have been very much defined by large central bank purchases of gold. But we had particularly Turkey selling a lot of gold in the initial months of the conflict. And then two, we've had this big shift in interest rate expectations. So before the conflict, expecting 2.5 rate cuts to now the market pricing about 1.7 rate hikes by the end of this year. And so with that, you get ETF selling. ETFs tend to be very, very sensitive in exchange-traded funds to what the Fed is doing. So they've actually also been liquidating. So you had central banks selling and you've had exchange-traded funds selling. Now, I'd say at the moment, gold has started to find a bit of stability, and that's because the central banks have stepped back in. So Turkey, that selling has reduced dramatically from about 60 tons in a single month to about 2 tons the last month of data that we have. And actually others have started to buy quite aggressively. So China was buying about 1 ton a month before the conflict and bought 15 tons in June. So huge acceleration there. Poland, which was the largest buyer last year, buying ahead of where it was at this point last year. So we are getting a bit of underpinning, I think, from those central banks. But of course, the bigger question is going to be, will those exchange-traded funds switch from selling to buying? And that's where I think tonight and arguably the next few Fed meetings, the decision is very, very important.
Well, Amy, let's stay on the backdrop for rates. Interest rates, how important were they to gold on the way up? And what's that story look like now? And what's your outlook? And how do you factor in what's going to happen with the Fed?
Yeah, look, I think interest rates have been super important to gold. So we had kind of gold's first pivot was in 2022, where arguably gold should have fallen as interest rates were hiked through 2022 and 2023. But because the central bank stepped in to provide that physical support for gold, it sort of was able to stay fairly steady. And then last year, interest rates again played a big role. So central banks were buying, but the biggest swing was the exchange-traded funds, which bought nearly as much gold as the central banks. And the reason that they did that was because interest rates were coming down. So if interest rates are coming down, gold is a non-yielding asset. So lower interest rates makes gold more competitive in your portfolio. So a big part of the swing in demand that we had last year was due to that cutting cycle. So that does mean, you know, if we do see a hike today or in September, then you are going to get more pressure from exchange-traded funds selling gold. So I think it's very, very important. Our house view is for the Fed to stay on hold, and then there's a bit of runway before the September meeting to get more data that can give them reassurance that maybe inflation is coming under control and they can stay on hold. But of course, if there were to be a hike, I would expect gold to be under some pressure.
Amy, is copper, lithium, the likes of uranium, the new gold right now?
I think there's definitely elements of this, and I think we did see that last year where gold and copper, for example, were very, very correlated, and I think that was really around this fiat currency debasement fear where that was sort of driving investors towards real assets. What we've seen this year is a big breakdown in those correlations, and actually things like copper holding up far better than gold, and I think that also brings you to, you do need the sort of real physical demand to be working. Copper's looking very good right now in terms of you've got the US pulling in metal, you've got China also pulling in metal despite prices being pretty elevated. You've got demand from data centers, grid upgrades that we know are happening around the world. And then you've got a supply side that's very constrained with more risks to come as we have El Nino coming later this year that can bring disruptions in Chile, Zambia, etc. So copper certainly looks very, very good. I'd say lithium is maybe a bit more volatile to be sort of something to be sort of labeled as the new gold, and it does have sort of its own challenges around the supply side and very reactive supply to high prices. And then I'd say uranium does maybe have a bit more of that long-term store of value. There's a sort of a very long-term thesis. There's a sort of limited supply, but again, it's not quite behaved as gold. So copper's probably the one where investors would be looking most closely at the moment.
Amy, I know you also see some more upside room to run when it comes to silver. What's the thinking behind that?
Yeah, so silver has really lagged gold year to date. So since silver's peak in late January, the ratio gold to silver has steadily risen to about 70 times, which is about where we'd expect it to settle long term. But that has happened a bit ahead of our expectations. And similar to gold, silver has struggled with exchange-traded funds offloading physical silver, and that has put downward pressure on prices. We've also had headwinds from the solar sector, where solar installations have been slower, and then we've also seen some substitution from silver to copper. But I would say silver does have that sort of electrical exposure angle. So if we do have a rally in copper, that often pulls silver with it. And then if we do get the Fed on hold, similar to gold, we could get those exchange-traded funds re-engaging.
Amy, it's good to see you. Thanks for dropping by. Amy Gather of Morgan Stanley on the price of gold. Gold this morning, just north of 4K. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Firefighters in Spain and France are racing to contain wildfires before a fourth heat wave in just a few weeks blankets the area. France fears shifting winds and rising temperatures could fan the flames in the southwest. Spain is experiencing some relief from blazes near Madrid. The European Football Association is considering a boycott of FIFA events, including the World Cup. Sources telling us here at Bloomberg the association is upset with FIFA's plan to seek private investment, saying it could give them greater influence over member associations and their national clubs. The Senate confirming Jay Clayton as Director of National Intelligence. Clayton is a former top federal prosecutor in New York. He came under scrutiny during his confirmation hearing for declining to directly say that Joe Biden won the 2020 election. And that is your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update. More from Vonnie 30 minutes from now. Up next on the program, a hike versus a hold.
The market's not ruling out July, and honestly, neither are we.
This really is a live meeting. The risk that we do get a surprise is much, much higher.
I've got the Fed on hold for the rest of the year, but I have to say it's not high conviction.
Up next, we'll catch up with the former Kansas City Fed President Esther George, live from New York City. You're watching Bloomberg TV.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance.
flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Stocks are positive, up by 0.2% on the S&P. Some real event risk on the horizon. You'll hear from the Federal Reserve later on this afternoon. And you'll hear from Meta and Microsoft. The Nasdaq into that, up 0.25%. In the bond market, ahead of that Federal Reserve decision, twos anchored around 430. Yields higher by 2 basis points. Under surveillance this morning, a hike versus a hold.
The market's not ruling out July, and honestly, neither are we.
You need to do something, and we think 3 rate hikes is the way to start.
This really is a live meeting. The risk that we do get a surprise is much, much higher.
I think you would get at least 1% if Walsh keeps rates on hold.
I've got the Fed on hold for the rest of the year, but I have to say it's not high conviction.
So here's the latest this morning. The possibility of a surprise hike looming over today's decision. The former Kansas City Fed President Esther George expecting the Fed to stay on hold, writing, although the probabilities of a hike have risen, the outcome of the committee's family fight could well conclude that the cooler June inflation numbers allow them to wait. Esther joins us now for more. Esther, a warm welcome back to the program. We're in a whole new world. This is different. Typically, post-GFC, we're guided into the decision. We already know what the outcome will be. What do you make of that change, that we actually have just a little bit of two-way risk?
So I think it's a good move in the sense of not trying to forecast and lay the groundwork for upcoming moves. I think the market doing this work is probably an important development here. And at the same time, while you're going to stop short of giving forward guidance, I think it's always helpful to be clear about what you are looking for. So today, I think will be important to listen to what is the rationale, how is the committee thinking about the current state of the economy.
Esther, if you were in the family fight right now, today and heading into tomorrow, what would you be screaming about? What would you be sort of arguing for?
Well, Lisa, I've been concerned for some time about the duration of elevated inflation in the economy. And yes, we've had a number of one-offs, as we call them, coming, hitting the economy. But the truth is underlying inflation has remained well above the Fed's target. And so my own sense is the cuts last year really eased into something that was still a problem in terms of inflation. So I would continue and am continued to be concerned about elevated inflation.
Do you think that it would be appropriate for a number of dissents today? Do you think that that would be healthy, or does that indicate that maybe Kevin Warsh is losing clutch over the body?
Well, I'm not concerned that there'll be too many dissents. You know, the Fed chairman is going to make sure, I think, that his direction, his particular leaning on this is going to carry the day. So yes, I would expect there are dissents. I wouldn't be concerned about that. We've heard those in some sense already being communicated publicly about how people feel about inflation. So I'm not terribly concerned that he will be outnumbered in terms of a direction today.
The characteristics we're seeing in this kind of oil price spike, is this something that the Federal Reserve could look through?
Well, they have been looking through it more or less, but we know that the oil price shock is a salient price. It can feed into other things. And so while this has been moving around, again, we haven't seen clear direction that we are getting an underlying disinflationary trend. Yes, we had cooler numbers in June, and I think that causes the committee then to really weigh more carefully what might the trend be? What is the direction going to be? And how much of that is influenced by oil right now?
We are seeing some companies come out, Reckitt Benckiser apparently coming out and saying because of the move in crude, they're going to have to put some of that into their products. Is that the time then where you would see the Federal Reserve start to really take notice of what's going on in the oil market?
Well, it is a factor that I think has been present for some time, and that is trying to understand the pricing power that is associated with any one of these particular shocks. And I do think that is always the risk that it broadens out. The Fed has been able to rely on anchored inflation expectations, but that is always a risk. How much time can pass before there begins to be questions about the Fed's commitment? And so that is always the tension here. How much time can you buy and keep inflation expectations well anchored as these various factors are unfolding?
Esther, instead of throwing bread rolls today then, would you dissent?
Well, I wouldn't want to prejudge what information is coming out at that table, because you always learn something up until the time that you are voting on that interest rate. I have been concerned. I probably would put myself in the camp of thinking action is needed, that rates have not been restrictive as described in the past. So my leaning is to say inflation remains a problem. And the one instrument the Fed has to attack that is really its Fed funds rate.
Esther, it's always good to see you. Thank you. You were never the kind to throw bread rolls. Always welcoming, right? Always.
Wonderfully
Always.
so. Yeah.
The former Kansas City Fed president, Esther George, there on this Federal Reserve.
That's it. An expression, I imagine, does the trick for her. I'm sure she would look down and shake her head. Look, it's going to be a pretty robust discussion on the Federal Reserve, on the FOMC right now, because on one hand, you could argue they've had inflation above a certain level for a very long time. On the other hand, you could argue that a lot of these are one-time shocks and that some of the declines in the volatility that you're seeing in the tech sector are doing the work for them, that you're seeing some tightening in the policy rate. I don't know how much we're going to get clarity today, even with a press conference.
There is dissent in the ranks. And in that news conference, Chairman found it difficult to reflect the consensus of a divided committee. It's a hard task to do. I think for Kevin Walsh, it might be even more difficult. What I heard from Claudia Sahm earlier on this morning was to look for the statement. Look for the statement, because that's just about what they do agree on. And what they agree on right now wasn't a lot of text last time around. I don't anticipate it will be a lot of text this time around. I'll be going right to the bottom of that statement at 2 p.m. Eastern Time to look for the dissent. I'll be surprised if Beth Hammack's name's not there, given that going into the blackout period, we had that statement from her on LinkedIn. And then I'm waiting for later. And by later, I don't mean 2:30 for the news conference. I don't mean later on that day. I mean the next several days once the quiet period ends and they come out and tell us what they really think. Because we've said repeatedly on this program, Kevin Walsh, I think honorably, is trying to take this Federal Reserve into a new era. But his reluctance to provide guidance just opens the door for other people to fill the gap. And basically all you're doing right now is outsourcing guidance to everybody else. And this could be messy for some time to come.
I think it's going to be 125 words. I think it was 171 words.
Are we playing word guesses now?
I think that we can too.
We can do that later. I'm happy to do word guesses.
We
All
should
right.
definitely have a bingo card.
Give me a chance. Let me think about it. Okay. All right, come up with a number. We'll play some bets.
How about now?
Has Taushi got something running on there?
I don't know. Get on it.
I'm sure they do.
I'm sure they do.
Third hour of Bloomberg Surveillance. Up next.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of
making it seamless online to store.
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Tech is the future, but I think right now we're in an air pocket.
It's important to remember narrative follows price.
Anything that puts a dent on the perfection of the chip stocks or cause a market reaction. The mood is souring a little bit.
The fears of this gyrations in stocks, I think, will not slow down at all.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Keep it together, Bramo. Come on.
You're blaming me for this one.
No, I'm blaming you for that one.
Okay, all right, whatever. Moving right on.
Anne-Marie is too.
Oh my gosh.
All right. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your equity market looks like this. Equity futures positive by 0.2% on the S&P 500. On the NASDAQ, up by a quarter. Heading into two big earning reports later on this afternoon. Here's your bond market, 2s, 10s, and 30s. Yields just a little bit higher. 2s north of 430. 10s north of 460, yields up by 1 or 2 basis points this morning across the curve, heading into this later this afternoon, 2 p.m. Eastern Time. Fed Chair Kevin Walsh with his Federal Reserve decision. 30 minutes after that, a news conference with the man at the top.
Let's talk about the news conference. It's not necessarily a given that you always have a news conference after every Fed meeting, not under the Kevin Walsh Federal Reserve, but he announced that he was going to have a press conference, and he said previously he would only have a press conference when he had something to say. Can he afford to come out and have nothing to say at a press conference that he already put as optional, had the option of actually doing it, and now actually is getting before everybody? What does he have to tell us? 1, his reaction function, and 2, how he views both oil prices and AI-related inflation. If there are no indications of that, expect the volatility to continue in a sense that possibly the vacuum could be taken up by the other Fed officials.
And potentially has to come out and talk about the family fight. If we have dissents right there in black and white, he's going to have to come out and explain what the committee discussed And what was the arguments for those individuals that decided we don't want to hold rates, which they're likely to do, and actually we think there needs to be a hike?
So I've called it a divided Fed, it is, but I don't think the differences right now are that great. There were plenty of reasons to vote for a hike last time around, no one did. We've had a softer print CPI, softer PPI since then. Chris Waller, Fed governor, very outspoken, set the bar for his view, and inflation came in softer than expected. So what are we talking about here? We're talking about maybe someone says like 25, and everyone else says, okay, hold. What do I want from this? Tell us the range of views on the committee. Give us a decent idea of how you respond to the incoming information. I don't want guidance. I don't expect it. No one does. But we've moved on from that. I think most people in the press pack and the news conference have moved on from that too. We're not looking for guidance. We just want to understand your reaction function. How will you respond to incoming information? I think Waller did a decent job of that in his speech. He wasn't providing guidance either. He just said, okay, this is how I think about the decision. If the data does this, I'll do that. And if it doesn't, I'll do the other thing. And isn't that what the Federal Reserve should tell you? Isn't there some value in that? And if he doesn't want to provide that information, I'd ask a different question. What is the value of not providing that information? Why do you believe it's important to withhold that from markets, from individuals? What do you think the benefit of all that actually is?
I'm channeling Kevin Warsh right now.
No, please do.
Okay. I'm waiting for the task forces to come back to deliver their conclusions before coming up with the appropriate reaction function for a modern Fed. How long can he buy time by saying task forces? And ultimately, that is what it has become. It has become buying time to give the market exactly that type of information. Forward guidance never was working at a certain point because the market didn't believe it. The market said, we're following the information, not necessarily what the Fed is saying. Forward guidance is different from a reaction function.
So we're task force dependent.
And that's what it was last time. Task force was the response to every single question.
Then what's the point of his job? Then just outsource the entire thing to the task force. He's the Fed chair. He has to come out and explain something.
I'm not that fired up about Kevin Warsh. I mean, I know other people are. I think everyone around this table are just, give him a chance and see what he does with this committee. But the reluctance to really talk about the economy, I just find slightly bizarre. I think it's kind of weird, strange.
Well, it partly reflects the fraught position he is in, because he was nominated and appointed to the Federal Reserve by this president to cut rates. We've heard that repeatedly. And he clearly is facing off with a Fed that has an inflation problem and that is completely divided. And as for his personal views, he previously was an incredibly hawkish individual who actually argued for rate hikes and for not using the balance sheet. So how do you square that Kevin Warsh with this Kevin Warsh, who is a task force beholder?
We could talk all day about this, but also...
We will.
We will. Forget the president. We've demonstrated in the last 12 months that these guys at this institution aren't fireable, right? We've demonstrated that. We'll carry on pursuing it, but so far we've demonstrated that. In some ways, then, Kevin Warsh is basically untouchable. If they want to hike rates, they'll hike rates. I don't really put much weight on that right now at all. And for that matter, my opinion is not worth much. The market doesn't either, based on market-based inflation expectations. It makes it even stranger with that in mind that he's not willing to talk about the economy much and how he thinks about things.
Maybe he sees ambiguity as a positive for him, that introduces a degree of volatility that tightens policy without having to move the Fed funds rate.
Yeah, give us a little bit of that.
Yeah, and give a sense of that.
What are the benefits?
Right, and that, I think, is a benefit.
We're burying that post-GFC hand-holding. I'm on board with that, whatever my opinion's worth. I'm on board with that. Let's get away from that. That's good.
A lot of people are.
Okay, so what are the benefits of moving away from that? Just describe that a little bit more. And of course, people are going to be unhappy with this. I expect journalists to be unhappy with this because they want more information. You were talking about this the other day. Yeah, sure. I expect economists on Wall Street to be unhappy with this as well. It's so much easier to do your job if someone tells you what they're going to do ahead of time, right? I expect everyone to complain about this, and we'll slowly get over it. But in the meantime, help yourself a little bit. Talk about the economy.
If he doesn't talk about the economy, I think people can accuse him of political interference that much more, because you can attribute whatever motivations you want to what ultimately ends up happening. And clarity and transparency does end up creating the credibility of an organization that has been threatened by the lack of inflation stability, by the lack of inflation being closer to their 2% target for more than 5 years. So now is a question of how do you regain that in a different kind of way economically.
You've got this, Kev. T30.
You're hyping him up. You're hyping him up. The Fed, I do know a lot of people at the Fed watch this show in the morning, and I feel like you're giving them a little bit of a hype. You're the hype man today.
Good morning, guys. Best of luck. All right. Coming up this hour, we'll catch up with Sarah Malik of Nuveen ahead of a pivotal day on Wall Street. Gil Luria of D.A. Davidson looking ahead to earnings from Meta and Microsoft. Plus, Kay Hay of Goldman Sachs saying markets can handle less guidance from the Federal Reserve. We begin this hour with stocks inching higher following 5 down days on the Nasdaq, heading into a big day for mega cap tech. Sarah Malik of Nuveen looking ahead to big tech earnings, writing capex increases may lead to negative market reaction due to questions around ROI on $750 billion of expected hyperscaler spending this year. Sarah, welcome to the program. It's good to see you. Is there a sweet spot for capex and the way you communicate capex, given the experience of Alphabet just last week?
Well, it's unclear because the stocks have been reacting quite negatively to a very strong earnings seasons, and that's for 3 reasons. First is questions over the amount of money we're spending on artificial intelligence. Second is the Middle Eastern war, and third, of course, the Fed meeting. So looking at these AI stocks, the question is, can these companies come out and print higher spending on artificial intelligence without disappointing the markets? So far, not so good in that sense. You know, what we're watching for is are they going to talk about monetization of this spending and what kind of productivity returns that we're seeing on it? And that's really the question mark for the markets. Stocks down 5 days in a row, really poor returns in Korea for the past couple of nights. I think we're going to remain in a choppy market for tech stocks. If you look at the volumes yesterday, there were some signs of capitulation in terms of NASDAQ volumes versus the S&P 500, but we're likely still catching a falling knife here. What I'm watching for is some of these stocks that print earnings and actually get a positive reaction. We haven't seen that yet.
Sarah, you talk about a choppy market. It's been choppy, but we're hanging in just a percentage point or 2 or 3 away from all-time highs. And it's been a kind of a rolling ball of money going from one sector to another, looking for the next hot trade. What would it take for the rolling ball of money to become a ball that's shrinking, people that are actually taking their chips out of the equity space?
Well, first of all, what we normally see is earnings and the stock market follow positive earnings growth. And this quarter is a great quarter for earnings. We're seeing over 25% earnings growth, 85% of companies beating earnings. All of that should be positive for the markets, but it's not. And that's mostly because people are not only worried about AI spending, but also the Middle Eastern war and oil prices. What does that mean for inflation going forward? And then everyone has been cautious for the last number of days because of this Fed meeting. Because we're not getting any forward guidance out of the Fed, or that's not likely, what we're going to have is more noise and less signal and a lot of uncertainty around the decision today. My view is that we do not get a hike today. We stay in the pause camp, and the Fed communication is going to be around what's happening with this five task force, and also that they're going to be depending on incoming data in terms of inflation. And with the Middle East war going on and volatility in oil prices, it's very uncertain in terms of where inflation is going to go from here.
Do you think that the lack of forward guidance, and not just forward guidance, but the lack of an understanding of the reaction function of the Federal Reserve has been responsible for some of the volatility and the chop that we're seeing in markets of late?
It's been responsible for a little bit of it, but I think that what's been overshadowing and taking all of the volatility and all of that volume is the AI and what's going on with earnings. People are very concerned that we spent, it's $750 billion on hyperscaler capex so far this year for all of 2026 likely. And are we going to see the return from that in terms of productivity and in terms of monetization of that artificial intelligence spending? That's the question mark. That's taking up a lot of the market volatility. And secondarily, the Middle Eastern war, the ceasefire, whether we have one, whether we don't, what that means for oil prices. And then thirdly, I think, is the Fed and whether we see a hike today or a pause. If we see a pause, we'd likely move forward. But some volatility, if we see a hike, I think that'll be more negative for the markets.
Do investors need a resolution in the Middle East in order to remain bullish? What if we just live in this purgatory for the next 6 months?
I think that what we want, it would be a short-term positive for the markets if we get a resolution in the Middle East. But what we really need to see is continued strong earnings growth and a better market function reaction to those earnings, especially in the tech space. We came into this year positive on technology stocks, but at the middle of this year, we moved to a broader stance. We think the rest of this year is not going to be all about tech stocks. Broader market sectors are going to participate, like energy and material stock, where there's also strong earnings growth. The good news for markets is that when earnings grow at over 10%, markets tend to be up 10 out of 11 years. We are seeing that this year, but we are still up already 8.5% on the S&P 500 year to date. If you look at midterm years where we have midterm elections, for the 3 months before the midterm election, market returns tend to be zero. So we're in that phase right now. So I think first half was easy money. Second half is going to be more challenging money. third quarter of the year may be the most challenging quarter of 2026.
Attempting to avoid the midterms, at least right now. Holding on to July, Sarah. Thank you, Sarah Malik there of Nuveen. I just know that we get closer to September and this becomes more and more of a thing, but trying to avoid it for now.
Yeah, well, we've got enough to handle. I mean, ultimately, we've got enough unknowns. It's sort of how many unknowns can you spin on your plate at one time? Too many. I'm sorry.
The tech will be part of the conversation too.
100%.
For the midterms, without a doubt. It's going to become a bigger and bigger issue. It is one already.
Absolutely. People don't want data centers in their backyard. People don't want electricity prices going up. People are concerned about AI potentially taking their jobs. I'll give you till after Labor Day.
After Labor Day?
You can hold on to the summer until then. After Labor Day, that's it.
I like stretching my summer deep into September, you know that.
I know you do that because of the weather, but I'm sorry.
You can't do Happy New
late
Year.
September?
September 7th.
6 days, but you got the summer
Everyone
that
needs
lasts
rules,
until
Bremo.
November. Yeah, except by you. Come on.
Summer until the end of September. What's wrong with that? The weather's
September
great.
8th, I'm starting the show. Midterm countdown.
The weather's beautiful in New York in September.
It is. I'm just telling you what people are going to be talking about right after Labor Day.
Okay.
So I'm giving you
Shut
until
it
Labor
down.
Day.
You knew that was coming, didn't you? Shut it down. Let's get you an update on News Worldwide this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. The U.S. military says it intercepted a so-called surprise Iranian ballistic missile attack on American bases in the Middle East. An Iranian state-run news agency says the Revolutionary Guard launched the missiles in response to recent U.S. aggression. More than 1,000 employees across leading AI firms signed a petition urging the U.S. government to support measures that could slow the pace of AI development. The letter warning that AI may be advancing faster than humans can control. Dr. Anthony Fauci is set to testify before the Senate Homeland Security Committee today on the origins of COVID-19 virus. The hearing comes after Senator Rand Paul released more than 1,100 pages of Fauci's private diary as part of his investigation into whether the virus leaked from a Chinese lab. And that's your Bloomberg Brief. John.
Vonnie, thank you. Thanks for the update. I just can't relate to people who get excited about putting sweaters on. You know, there's people.
Yeah.
Gets to September and they're excited.
That's me.
You're excited for the sweater on. Are you? Are you really?
Pumpkin spice lattes.
100%. No, I don't do that.
But it's those people.
The basic. Those people.
I like seasons.
It's so weird.
So sue me. I like seasons. It's wonderful.
I like a nice boot.
Good to know.
Thanks.
Up next, the Morning Calls Plus, Gil Luria of D.A. Davidson on why Microsoft earnings are the key report to watch this season. That conversation up next, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I think the right trade is not to trade. I think it's to hold your core positions. Some of the portfolio managers may just be taking some, quote unquote, time off until we get to the end of September, where we get a real seasonal uptick in tech. I think it's just time to take a deep breath and own the best names in the sectors.
Ted Mortensen of Baird, no time off, no days off, no breaks, no summer break at all. Just volatility in energy. I want to bring up crude, Brent and WTI, and you'll just notice they've ticked higher again. On Brent, on WTI, on Brent right now, up close to 7%, closing it on 90. Just one simple headline from the president moments ago, speaking to an American broadcaster, enough to shift this market once again.
He said we'll be hitting Iran hard. This comes after an evening where the United States, alongside Saudi Arabia, went after Iranian-backed militias in Iraq. This comes after you have the Iranians going after U.S. military forces in the region. And it comes as the Iranians are basically telling the Omanis, we're not playing ball, we're not going to sign up for a new deal when it comes to the Strait of Hormuz. And the president basically telling the market, we're going back to strikes.
You take that move in crude, you add a basis point to the sell-off in treasuries, yields higher by, let's call it 3 basis points now at 432. You see that move in the bond market, 2s out to 30s. Push it through equities. Equities turn negative. They were positive, just like that. This is the issue right now. You're just not getting out of this, Bramo. It's just back and forth, back and forth. It's endless. Unfortunately, this is the uncomfortable new normal in the Middle East.
Touch grass, go for a walk. I mean, ultimately, how do you price this in? Because this type of volatility is something that is exhausting and yet not ignorable. And I think that's what we feel from a lot of different traders, every day being whipsawed by this. At a certain point, the volatility begets its own price action, which is, if this is the new normal, suddenly it will be that much more pernicious in a whole host of ways.
Equity futures slightly negative on the S&P 500. The open about 1 hour and 12 minutes away. Let's get you some morning calls. First up, Baird downgrading Caterpillar to neutral, citing government data center pushback as a headwind. The stock is down by 4.5%. Your second call from Wells Fargo, raising its price target on Snowflake to a street high, noting that investors are, quote, underappreciating its upside potential from AI. And finally, Bank of America reiterating its buy rating on Apple, saying its new leasing program may drive faster upgrades. That stock close to all-time highs, going into an earnings report a day away. The stock is up this morning by a tenth. Let's stick with tech. Earnings from Meta and Microsoft due after the closing bell. All eyes on plans for capital spending. Bloomberg's Ed Ludlow has more. Good morning, Ed.
Good morning, John. It's another CapEx test, particularly after Alphabet, but this time the market will want to see Microsoft and Meta justify growth in CapEx going forward. The key watch for Microsoft is its Azure Cloud Computing Unit. Expectations are beyond 40% top-line growth. But if you think about where Microsoft will end its fiscal year, CapEx of around $147 billion in fiscal 26, the street expects them to tell us that CapEx will guide us towards a trajectory on CapEx that is $230 billion for the next fiscal year. So the dynamic now is that CapEx growth is far exceeding the current pace of top-line growth in the key cloud computing unit. Similar with Meta, 26% top-line growth. Capital expenditures for the year, $136 billion to $145 billion. If that number is sort of indicated to go much higher, well, where's the growth to keep up with it? And it's a simple calculus. We've gone from show us the spending to justify the spending.
Big 24 hours for Ed Ludlow and the team at Bloomberg Tech. Looking forward to the show, Ed. Thank you, buddy. Gil Luria of D.A. Davidson staying bullish on Microsoft going into the results and writing Microsoft will be the key earnings report of the entire season. CapEx guidance for fiscal 27 will determine the direction of the market. Gil joins us now for more. Gil, key question then. Why is this the key one? Why this one name? Why is it so important?
For a couple of reasons. One, this is Microsoft's fiscal year end, so they're going to guide for 12 months for a full year, and they'll give us a hard number. So we'll be able to pin down how fast that CapEx growth, to Ed's point, is it growing even faster than Azure, or is it growing slower than Azure will be the key question. And the other reason is Microsoft has been the responsible adult in the room around CapEx for the last couple of years. It was about a year and a half ago that when we were worried about the direction of AI, that they actually did step back CapEx a little bit. So that's why investors are looking to them to see if they're going to blink. They're more likely than Google, Amazon, Meta, et cetera, to blink. And that's why investors are trepidatious walking into this earning, is if Microsoft says they're reining in CapEx, that's going to be tough for the AI trade. We don't think they're going to say that.
Do you think that increasingly as CapEx has to go up, regardless of some of the pushback that you're seeing in capital markets, do you think that the better investment thesis is shifting to the bond space, to the credit space, and away from, say, buying the equity?
Well, to the extent that the bonds for these mighty companies, Amazon, Microsoft, and Google, are starting to trade at a discount, that does seem like a relatively safe bet here, because these companies are incredibly credit worthy and they all have the ability to stop CapEx on a dime. They could go to a fraction of their current run rate and still grow their business. They just believe, and they're trying to show us evidence that this investment is showing a return. But if at some point they decided it's not, they'll scale back CapEx and their cash flows will skyrocket. That's why these companies are more creditworthy than almost every country in the world. It's because their flow of cash is very reliable. It's almost like a global tax that these big companies have. Therefore, any discount to their debt is probably attractive.
Does it help them that you're seeing dislocation in some of the semiconductor names and pushback potential competitive pressures coming from elsewhere when it comes to manufacturing some of the components?
It gives them a little bit more operating leverage vis-a-vis the chip companies. But realistically speaking, none of these companies is going to buy chips from China. And if that's the concern about competition, that's not that much of a leverage point against NVIDIA, Broadcom, Micron, et cetera. Those companies will continue to get the 75% gross margins as long as we continue to ramp the data center build out. But they'll certainly try.
Gil, it's good to see you. Looking forward to your reaction in the next 48 hours. Gil Luria of D.A. Davidson. It's Microsoft and Meta first, and then it's Apple and Amazon. We've learned a lot about price and positioning. We've repeated that over the last few weeks. When you get great numbers from the likes of Intel and a stock sells off, or SK Hynix, phenomenal numbers, and a stock sells off, you've learned something about how much that stock price has run and how well positioned people are for that. We've also learned a lot about leverage in places like South Korea. We've washed out a lot of that leverage with these massive swings, down more than 12% of the lows in today's session, up by more than 3% of the highs. That is a very wide range. That volatility prompted a meeting a little bit earlier on in South Korea at the finance ministry between officials, and they've just put out a statement just moments ago about curbing retail exposure to leveraged ETFs. That's been a major feature of the market in South Korea on the way up and certainly on the way down.
Yeah, they just put out a commentary after this meeting with the finance ministry, at the finance ministry, talking about how they are going to take more steps to stabilize their stock market. This has been a real point of concern, and you've put this well, John, when you say that they've been exporting volatility to the rest of the world. How much is that going to rein in some of the huge whipsaw swings that have really exceeded what we've seen in Bitcoin and bring people back to the market, convince them that these valuations are real versus just some sort of fiction of leveraged ETFs?
Typically, that would be the kind of headline in an emerging market that would be isolated to that emerging market. But that's a global headline this morning, given how much impact, how much input they've had on the stock story worldwide.
SK Hynix and Samsung are two of the biggest memory chip producers out there. They are the key input that have been increasing dramatically in terms of price for the hyperscalers that are trying to perpetuate the AI story. You put this together, they're very global companies, and this is a global issue.
And that's the latest on South Korea. Here's the latest in this market, turning negative on the S&P 500 just moments ago. Crude higher, Brent and WTI spiking higher off the back of a pretty punchy headline from the president promising to hit Iran hard and using some choice language to make that statement. More on that in just a moment.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Stocks turning lower. We're down by about 0.1% on the S&P 500. We are negative by 0.2 on the Nasdaq this morning. The Nasdaq got a 5-day slide so far. Chips on a 4-day drop. 4 days of struggling chip prices, the longest streak we've seen so far this year. In the bond market, yields just a bit higher in the last 15 minutes or so, up 3 basis points. Twos, let's call this 431, 432, off the back of this move in crude. Crude up on Brent and on WTI by more than 7% now on Brent crude, $90 a barrel. Now, you'll often hear me say things like language matters. Language does matter. So I'm going to read you a headline that's dropped with regards to the president. And I'm going to just say that I'm paraphrasing here. The president says that he's going to hit Iran hard, but that's not the language he used. The headline, according to Fox News, which is who he spoke to earlier on this morning, was laced with profanity.
Right, and we've seen this president lean into profanity in the past, especially when he's frustrated, and he did so to Fox News, saying he's going to beat the effing something out of them, meaning the Iranian regime. AKA, a message is very clear right now to the market. We had strikes last night. It sounds like the president is leaning back into having strikes again after having a brief period of a pause.
Lisa, crude back in the 90s.
What do people do with these headlines?
What can you do?
I mean, it's one day to another, just whipsaw up, down, depending on the language, depending on potential strikes that have occurred. You just wonder at what point the duration matters. We keep going back to that, but if we remain within this $90 to $100 a barrel range, because of this tit for tat, the new normal, as you called it, does that in and of itself create a new investing paradigm that the Fed has to consider and that a lot of investors do too?
That is the only assumption I can make this morning, Lisa. I've said earlier on this morning, we all have. I don't want to overweight the headlines about attacks. I also don't want to overweight the headlines about diplomacy either. Just observe that this is the new normal. It's an uncomfortable new normal. You're going to have days where there are talks and days when there are strikes. You're going to have days when there are unworkable proposals that come from the White House that won't last 24 hours, and we've seen that in the last month too. And you'll see Iran continuously testing the president's patience when there is relative calm, and we've seen that in the last 24 hours as well. But what does the new normal mean, the uncomfortable new normal for crude? It means you'll have days where energy is going through the Strait, traffic's starting to pick up, and days when it's not. And you're going to have an elevated price relative to what we would have otherwise had if we didn't have this situation. And it's not just the likes of the Middle East, it's also Russia now too, where crude product is becoming a bigger and bigger problem.
What's the bigger takeaway for overall economic trajectory going forward? Supply chains are going to be more prone to disruption, and there's going to be more volatility there. Raw material prices are going to remain elevated because of potential frictions within respect to how they get transported. And potentially, a lot of governments are going to have to pay a lot more to support their defense operations in order to prevent these types of things, which pressure the fiscal side of things. You put those pictures together, that's what everyone's grappling with, and the reason why borrowing costs are just inching a bit higher.
And the geopolitical risk premium's not going away, and you see Aramco potentially having to change some of their pricing that's going to Asia. You also see China stepping in, increasing some of their imports. You bring up a great point, what's going on in Russia, what's going on in terms of Ukraine hitting some vessels in the Caspian Sea. The problem we have now, and no one knows this, is when does it actually end? When is there a negotiation that's fruitful that actually ends this? And I don't see that happening with this regime before the midterm elections. So this is going to be the course, at minimum, I imagine, conventional thinking until November.
We should always be open-minded. Things can change. Just based on the experience of the last 5 months, things aren't changing anytime soon. We need to talk about South Korea as well. Wild swings on the Kospi once again. It's one of those markets now which is on the list, top 5 of the things you look at when you wake up in the morning. How does South Korea trade? And the Kospi was wild. It was down at the lows by more than 12%, up at the highs by more than 3%, and closed down 6%. And there is a concern now amongst South Korean officials, and I think we've seen that concern build and build and build more recently, about the amount of leverage building up in the system, the exposure of retail to that leverage. And officials met earlier on today at the finance ministry. They had that meeting and they put out a statement in the last 15 minutes or so, and they're looking to curb exposure to those leveraged exchange traded fund products that we've been talking about, and looking to cap their access to them with higher trading costs. Now, how quickly they can do that, what that looks like in practice, I don't know, but you can see that's becoming a bigger and bigger issue for them and everyone else.
If they take more steps to stabilize this market and they potentially curb the leverage used, does that mean that all of the leverage has already been washed out, or is there a lot more to go? In other words, how much more downside is there before there is more stability in this key market?
Hard to keep up this morning, isn't it? This is before we even get to the Federal Reserve and the earnings later on this afternoon.
How about this year? How about this month? How about this week? I mean, the week did not start today.
Can't wait to watch.
I was saying to a guest earlier on this morning, Q1 felt like a decade. Like, it really did. It just dragged and dragged and dragged. Then Q2 over, and Q3 is flying by as well. It's exhausting.
It is exhausting, which is a reason why when you bring up midterms, I'm not there. Really?
I'm not doing midterms.
I'm sorry.
I'm not even covering them. Just refuse.
Oh, really? News to me.
Yeah, but you're extra earnings.
Just shut it down.
Exactly.
I'll have no choice. As we count you down to the opening bell, 1 hour away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the most actively traded stock in the U.S. in the pre-market this morning, and that is SoFi. Shares are down nearly 6%, even after the company posted solid results. It beat on earnings and member growth and even raised its full-year revenue outlook. Investors, though, are focusing on a few blemishes in the report, including higher than expected expenses. So just another sign of the high bar for earnings, and you get punished if you don't beat across the board. Meanwhile, not getting punished is Bloom Energy. Those shares up 8.8%. This is a company powering the AI build out. It posted results and more than doubled its earnings estimates, raised its full year outlook, and it's the third time this year the company increases its sales forecast, as it says that customers just keep coming in and arriving faster than ever. And if that's a sign of AI demand growing, Caterpillar and some sell-side action highlights one of the main risks, especially during an election year. I know you guys don't want to talk about midterms, but that is happening. Shares are falling nearly 5% after Baird downgraded the stock. They say that growing pushback against new data center construction could become a headwind for this company, especially in a key area that it's been banking on. John?
Yeah, Harry, you get a pass. You always get a pass. Thank you. We appreciate it. Counting you down to that Fed decision at 2 p.m. Eastern Time, this moment is different. We're not used to this. If your only experience of Wall Street is the post-GFC world, you're very, very used to the hand-holding. Typically, going into any decision, you know ahead of time what's going to happen. And if you don't, then make sure you know. This is different. Overwhelmingly, the consensus on Wall Street is no change of hold later on this afternoon. But there is an appreciation. There is a small risk they might do something different because we have a new Fed chair that is not willing to provide quite the same guidance. Mike McKee has more from Washington, D.C. Good morning, Mike.
Good morning, John. There's 19 members of the Open Market Committee, and 12 of them vote, but only one matters today, and that is the new chair, Kevin Warsh. What he thinks will probably carry the day. As you mentioned, the economist community is pretty much overwhelmingly convinced they will stay on hold, although Wall Street still gives it a 35% chance that they surprise us with an increase. Last time they did that, June of 2022, with that 75 basis point hike. There are no economic forecasts or dot plot today, so we'll all be listening for what Mr. Warsh has to say. Now, it's not unusual that he could surprise us. The history of new Fed chairs is that they tend to raise rates very quickly after taking office. Paul Volcker did it a month, 2 months into his term. Actually, the only one of the last four who did not was Janet Yellen, who inherited us the middle of the great financial crisis recovery, and it took 22 months before they raised rates. But everybody else was willing to raise rates right at the beginning of their term. So the questions going into this afternoon are, will there be any dissents, and will the statement recognize any dissents? Last time, the statement didn't mention the individual votes, just the vote total. How will Warsh explain the decision? Either way, what will he say about what other members of the committee thought? What are he and his colleagues watching? This is maybe the most important question, because it gets at the idea of what's their inflation framework, what's their reaction function, things that he has been reluctant to discuss. And that leaves us with the question of, will September be priced in post-meeting? It is priced in right now. Economists and market participants think that there is a better than 100% chance that we're going to see a rate increase on September 18th. The question is, where do we end up when the Warsh press conference is over? It is very different. And of course, John, you have to shake your head when you see oil prices this morning, just when they started to go back down, and maybe help Warsh make the comment, make the case for keeping rates unchanged. Here we go again.
Of course, we don't know where it's going to be 5 hours from now, either, for that matter, Mike. It is a change. Can I just ask you, as a journalist who's in that room and has sat in front of central bank chief after central bank chief over the last several decades, Mike, how your approach is going to change to the kind of questions that you ask this Fed chair? No one wants to be on the receiving end of a 2-word answer, or any answer that involves task force. How is your approach different to this moment too, Mike?
Well, I think we're going to be looking for people to ask specific questions about specific thoughts, as opposed to more general questions along the lines of, what is your reaction function? Because that could be easily parried. But how he looks at the oil price increases that we've seen recently, does he think they're inflationary, or is it time to look through them? And what is it that he thinks the task forces should accomplish? When you look at the Wall Street Journal story from yesterday, the anecdote about Chris Waller saying it's not like anybody hasn't thought of this stuff before. What does he think of that?
Can read it out to him, Mike. Looking forward to it. Michael McKee with the latest down in Washington, D.C. Stephen Stanley of Santander expecting the Fed to hold rates today, but hike twice later this year, writing the Fed has entered a brave new world. It's been many years since there's been this degree of uncertainty about whether the Fed would change policy or not in the lead up to a meeting. Stephen joins us now for more. Stephen, good morning.
Good morning.
Is it a welcome change?
I think it is. It gives the Fed flexibility. The complaint that Warsh has had is that basically the Fed would lock itself in with forward guidance. So I think, I think back to, okay, what would this period be like if we still had kind of the old regime in place? And I think my guess is they would have been kind of looking toward a September rate hike, and they would have already started to signal that in June. So they would essentially already be kind of locked in. Well, what if things change, right? What if the inflation numbers are all of a sudden, we got the softer June CPI, what if you get a string of those? They've already kind of locked in for September move. That's why I think Warsh wants to invoke more uncertainty to allow the Fed to have flexibility.
Why is it valuable to hike in September and not now? Why is there so much value, in your view, to sequencing things in that way?
Yeah, well, I think this is an example where you can make a strong case in either direction. So I'll make the case for holding off. As I mentioned, the last inflation reading that we have in our hand is the June CPI, much softer than expected. So is that a one-off? Is that a fluke? Or is it the beginning of a trend? Is something moving around with regard to inflation? I think there's specific reasons why we would learn a lot by getting 2 more rounds of monthly data, which we'll get between the July and September meetings. One, we're still trying to figure out where we are with regard to tariff pass-through. Fed keeps telling us we're toward the end of it, and there's evidence of that, but we're not quite sure. Secondly, and I think more importantly, we're really in the early stages, or maybe the midst of energy price pass-through. So we've seen energy prices go up, we've seen airfares go up, all the obvious stuff, but you haven't seen it bleeding into everything else. You haven't seen food prices go up on the back of transportation costs. You haven't seen firms raising their prices because their energy costs are higher. Does that mean that's not coming, or does it mean we just haven't seen it yet? Again, 2 more months, maybe gives you some insight into that.
Do you think that the Fed has any responsibility for why inflation has remained above its target rate over the past, not only just 5 years, but in particular in the past year and a half?
Absolutely. I'm a big believer in what Warsh says. The Fed controls inflation ultimately, and they have the tools to bring it back to 2%, and they haven't done so.
So what do you make of people who argue that ultimately this is one-time supply shocks and that that's the reason why they've been facing this? It has nothing to do with monetary policy, and it wasn't in their control anyway because this seems like a more rate-insensitive economy.
So my response to that would be, and I think I'm going to be channeling the chairman a little bit here, so the Fed controls the amount of liquidity in the economy. So if we think about an energy price shock, for example, if energy prices go up, gasoline prices go up, the Fed doesn't have control over that. But if the Fed injects liquidity to offset that so that consumers are made whole, then the overall inflation rate will go up. If the Fed doesn't, then household budgets will get squeezed, the demand for other things will go down, and other prices will have to go down while gasoline prices go up. The overall inflation level stays the same. So this goes all the way back to the 70s. It's this issue of, do you accommodate an energy price shock or don't you? And in essence, what I would argue is that the Fed, you can say, well, this wasn't really our doing, supply shocks and energy prices and all the rest, and that's fair enough. But policy at the end of the day has been too easy, and that's why inflation has stayed high and hasn't come down.
That will be part of the debate later on this afternoon, no doubt, in that news conference. Stephen, thank you, sir. Stephen Stanley there of Santander. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump says the U.S. will hit Iran hard after a recent attack that targeted a base in Jordan. In an interview with Fox News, the president saying, quote, they're going to get a beating. Trump's comments sending oil to session highs. More than 1,000 employees across leading AI firms signed a petition urging U.S. government to support measures that could slow the pace of AI development. The letter warns AI may be advancing faster than humans can control. A massive new data center coming to Kentucky. Brookfield and NextEra Energy are teaming up on a more than $100 billion project that will turn a former uranium enrichment facility into a 2-gigawatt data center campus. It's expected to create 8,000 construction jobs and 600 permanent positions. That's your Bloomberg brief. John.
Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. What a 24 hours we've got coming up. Plus, we'll touch base with Kai Hay of Goldman Sachs, saying markets can adjust to a new regime.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
The bar is set too high for any stock associated with the AI trade, right? And it's not to say that the underlying fundamental story is not good, but the bar is just being set too high. The new beat is, call it a 10% beat on earnings and a lower CapEx guidance. I think that's the thing that's going to get stocks to rally.
That right there is the sweet spot, according to Dan Suzuki of iCapital, heading into those earnings later on this afternoon from Meta and Microsoft. In the market right now, stocks and bonds a little changed ahead of this afternoon's Fed decision. Kai Hay, global head of fixed income at Goldman Sachs Asset Management, writing, more important than the decision itself might be the messaging. Markets can tolerate less forward guidance, but they struggle when the policy framework itself is unclear. Kai joins us now for more. Kai, good morning. Good to see you.
Good morning.
How unclear is that framework this morning?
Well, we're going to find out. I mean, the market tells you something. The pricing of 30% is a kind of unusual pricing going into a Fed meeting. By now, you would have thought the market had settled. So it gives you an indication of what the market is looking for, and that is a little bit more clarity around the reaction function.
Two-year yields right now, and for the last several months trading comfortably above the policy rate.
Yeah.
When you look at that, I think framing matters here too. Do you see that as a bet on hikes or the risk of hikes baked into the yield curve?
Good question. So I think the first point is it's important not to confuse a lack of forward guidance with there being less clarity about the reaction function of the Fed. So hopefully the reaction function, we're going to get more clarity as the day goes on, and that would be great. The market would like it. The second point is, look, the statement at the last meeting, the focus on inflation really dampened a little bit the volatility at the longer end of the curve and moved the volatility down the yield structure. So you're gonna get more volatility at the short end. That's consistent with a focus on inflation, with being data dependent and less forward guidance.
If you get a hold that isn't as hawkish as people expect, do you think that reintroduces volatility to the long end of the yield curve?
It depends how it's framed, right? So, when you say not as hawkish as people expect.
In a sense.
Yeah. I think that would introduce a little bit more uncertainty around the longer end of the curve. But look, we've got another meeting in September. The market right now prices a hike, and I think, that volatility is probably short-lived because the market will look towards that meeting very, very quickly.
Why do you think we don't have more information about the reaction function of this Federal Reserve?
Well, because it does look at first sight that there's going to be some changes, right? We've got the task forces, we had the communication, the market is trying to figure out what a new kind of governor is going to bring to the table. So it's not unusual that the market is trying to wait and see and look what it can glean from communication today.
Kai, you said something important about bringing volatility in.
Yeah.
Bring it to the front end of the curve and it dampening yields at the long end of the curve. It makes me think whether this is all by design. Do you think it is by design? Is that the objective here?
Well, good question. Like, design for what, right? I mean, your question might refer to the fact that it's by design to kind of cheapen the long end a little bit. Maybe that's it. But I think it's consistent with a data-dependent Fed, and I think it's consistent with a Fed that's going to be less focused on forward guidance. So the market then has to figure things out. And we've come out of a very unusual period, right? That's another thing to kind of keep in mind. Like, what's our base here? Our base is really a kind of post-QE. We've been used to there being a lot of clarity. We've been used to having Fed meetings that were well advertised. That's a recent phenomenon. If inflation, what's happening to growth, what's happening to the propagation mechanism. You're going to get much more differentiation between different central banks as well, right? Not everybody is going to be doing a very similar thing. So this week we've got Bank of England, we've got Bank of Japan, and we expect very different communication from them. So what are the implications? Look, macro matters more, fundamentals matter more, data matters more, and you're going to get way more differentiation in markets.
Does that mean that you have different outlooks when you look across DM sovereign bonds right now? Can you give us an idea of where you're constructive and where you're less so?
So yes, it does mean we have different outlooks. We'd probably be much less constructive in terms of kind of yields going down in places like Japan. I think you're going to look at the UK and you're going to be a little bit more kind of data dependent, and you will see that kind of differentiation. That's at the short end. Then add onto that the long end implication, right? So there's issuance at the long end. There's kind of pressure of coming from fiscal in places like continental Europe. So absolutely much more differentiation.
So much has changed in fixed income. The communication shifting markedly at central banks like the Federal Reserve. Forward guidance is over. Then you've been dependent on the other anchors in fixed income going away too. So you could have been dependent on fiscal prudence in Germany, that's over. In Japan, disinflation, that's done. Now got inflation. Everything's changing in fixed income in the space of a couple of years.
The era of financial repression is over.
Big time.
And guess what? There's yield and there's uncertainty. And for a debt investor, actually, this is pretty great, especially if you don't have hyperscalers sucking all the oxygen out of the room, because suddenly you're getting leverage and you're getting yield. People said that bond vigilantes were dead. They're alive and kicking, and frankly, they're out there capitalizing on that. And that's what you see in terms of yields at some of the highest levels that we've seen going back years.
Talking about Kai, is it a good moment to be in the bond market?
It's very exciting. I mean, look at today. We're all talking about the Fed. That hasn't happened in a long time. So.
It's been boring for a while, hasn't it? Kai Hay there of Goldman Sachs. Kai, it's good to see you.
Thank you.
Thank you for being here. Appreciate it. It's just a massive shift. I think we've all stated that going into this Fed decision. Yeah, at 2 p.m. Eastern time, I might sit here and say, unchanged, couple of dissents, and it might sound boring. But just the very fact that you don't know, and there's this small margin of risk, and that small margin of risk is now in the market pricing as well, is a different world.
It's something of a mystery why inflation has been so far above the Fed's target for more than 5 years and why it has persisted. People can make their arguments. Going forward, it really sets up a new trajectory for this Fed.
Surprise appearance later?
No, I'm gonna be watching with popcorn, with bated breath. Can't wait to see you guys do extra innings.
Okay. Maybe we'll dial you in. Maybe.
We'll put a little figurine
Maybe.
here.
Special programming, 1:30 Eastern time. On Bloomberg Surveillance, the Fed decides. From New York City this morning, good morning. Looking forward to covering the Fed with you later on this afternoon. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for for my team, for my sponsors. As I look back, I'm proud of that.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years when I first became a congressman. It takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It is going to be a busy day from earnings to a Fed decision. 30 minutes until we start your trading day. I'm Danny Berger. Matt Miller is still off. Bloomberg Open Interest starts right now. Coming up on today's show, SK Hynix sets the stage for a big day for tech earnings. Microsoft and Meta take the spotlight next. To hike or to hold, markets see a growing chance of a surprise from the Federal Reserve today. And Middle East tensions flare up again. Oil jumps as President Trump threatens Iran with new strikes. So maybe we're a little bit more tepid with what tech stocks are going to do today ahead of the earnings. Microsoft and Meta, they will have less of a high bar maybe because they have sold off over the past month. Still, it's clear that expectations are really high in general. Higher AI spending is going to be closely watched, and often that's met with disappointment on Wall Street. SK Hynix, the perfect example of this. Shares are down after reporting a six-fold jump in profit. However, they also hiked their spending plans by 50%. Let's discuss with Bloomberg Tech host Ed Ludlow. Ed, this really feels like the nature of things now, that you can report a more than 550% surge in profits from the year prior, and yet your shares get beat up.
Well, the profit number was still seen as a little bit disappointing, which shows you the severity of the memory bottleneck and the pricing situation on the DRAM side, but also takes into account that SK Hynix has 60% market share in HBM going into data centers. So maybe there were those even more bullish on the street that felt they could have done better. What's interesting is the CapEx commitment, right? It's being interpreted. The ADRs are not actually that much lower relative to South Korean trade. But there are loads in the market that say, is that not a really robust signal of confidence in future demand from a player in an industry that has, for a very long time, been super conservative about investing into cycles? So it's a real mixed bag.
Even so, isn't that quite instructive, both from the reaction of SK Hynix and what we got from Alphabet last week to what we're likely to see from a market reaction from Microsoft and Amazon today?
Yeah, so the calculus is, there's an expectation the quarter was really strong from Microsoft and Meta, but after Alphabet, you have to justify future CapEx expansion. Microsoft's probably the most tangible case study of that, right? Azure, the cloud computing unit, will likely grow beyond 40% in the quarter gone. Microsoft will close the book on its fiscal year and give us a real guide on CapEx for the next fiscal year. But if CapEx jumps from $147 billion to $230 billion as the street thinks, that would represent pace of CapEx growth far outpacing top-line growth on Azure. Azure growth 40% odd, CapEx growth maybe 50 to 60%. And that's the worry, that they need to show much more ROI in the near term and a better guide long term.
Ed, just elsewhere in the tech world that I'm sure you're going to cover on Bloomberg Tech today is learning more details of the OpenAI hack on Hugging Face, that it first accessed a customer cloud account before it launched this attack. Just the skeptic in me is kind of like, is this just good marketing for OpenAI to be like, look how great our models are, that they're basically so advanced they can escape from the sandbox and wreak all this havoc?
So in the first instance, this is kind of a separate case study of the same models behaving that way. And again, in aggregate, the industry kind of cheered how OpenAI communicated on this. It's not a scandal. You want the frontier labs to be testing cyber capabilities, but see that there's a procedure in place to catch it. With the modal situation, think of it as modal. The OpenAI models are the attacker, and they found somebody's unlocked computer to use. So basically, this didn't compromise the modal platform itself. Within modal, a specific customer had a sandboxed environment that it made publicly accessible. So all the OpenAI models were able to do was get into that sandbox or closed testing environment, and then basically treat it as a staging point. They could work with code within the sandbox, but nothing outside of it. And again, like the companies now are communicating about it, it is the latest example that AI being an attacker in the cyber context is real. And that has been an endless conversation for 7 to 10 days.
Ed, again, really looking forward to Bloomberg Tech, 11 a.m. every weekday. Bloomberg Tech host Ed Ludlow. Elsewhere in earnings, Ford is raising its profit outlook for the second time this year. The automaker cashing in on resilient demand for SUVs and pickups. Joining us now is Bloomberg auto reporter Keith Naughton in Detroit. Keith, great to see you. So is this just the really expensive stuff from Ford is being bought? Is that what it is, the upper-end consumer?
Yeah, it really is, and it's the Bronco SUV had a record first half, and the Explorer SUV is doing really well. And it's not just the regular mainstream models. Customers are buying the fully tricked out models with the off-road performance packages, and those are very high margin.
Well, it's that, and then I also wonder how the rest of its business is doing, Keith. Besides the high margin, what about just the more everyday vehicles that they offer?
Yeah, well, the big one to watch is the F-Series pickup, their top-selling model, and that has been down because of the fires it had at the aluminum supplier Novelis last year. That's starting to come back, and momentum is beginning to shift on the stock. Mike Ward of Citi today raised the stock to a buy from neutral, and he sees 28% growth in F-Series sales in the second half of the year, which he says will be a profit tailwind.
We've also seen Ford rally in recent days sort of on the AI hype and some of what they're doing to provide some battery purposes, kind of like retooling EV battery plants for energy storage and helping sort of the AI ecosystem. How is that business going for Ford?
Yeah, it's really driven the stock way up this year. They had their best month in May in 17 years. It's a very promising business for them, high margin. They're building it out. They have one customer already. Jim Farley, the CEO, says there's a lot of interest from hyperscalers, from data centers. Energy storage is a growth business, and Ford is right in the middle of it.
Hey, Keith, thank you so much for joining on those Ford earnings. That's Bloomberg's Keith Naughton in Detroit. We also, in terms of events we need to get through today, before all of the big tech earnings, we're going to have the Fed. And rates are expected to stay on hold this afternoon, but there are some in this market bracing for the possibility of a surprise hike. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. So, Mike, about just over 1 in 3 odds that we hike. Bank of America points out that should the Fed hike, it would be unprecedented since at least 1994 that you haven't had a Fed hike when the market is this uncertain about it.
Yeah, this is the most live, if you want to put it that way, meeting that I can remember in a very long time, because you can argue it either way. You can make a case for raising rates, you can make a case for holding. And if you divide up the members of the Open Market Committee who will vote today, you can come up with a pretty much a tie vote there, because among those who have said that they would raise rates now, or they would consider raising rates if inflation was still going up, if oil prices were still going up, you got 6 votes. On the other side, the people who have said they're not interested or who have not talked since then, there's 6 votes there, and the guy on the bottom right is the one that is most important, because he'll try to frame the decision and get people to do what he thinks is best, and we'll see how that all turns out. Of course, economists overwhelmingly see a hold today, and you do have that market probability of about a 35% chance of an increase. We haven't had any kind of surprise, really, since June of 2022, when they raised rates 75 basis points, and the surprise was in the amount of the increase, not the increase itself. But we also don't get any dot plot or new economic forecast today, so not much to build your case for what goes on next time. We'll be looking to see what Kevin Warsh says. We'll be looking to see if there are any dissents and if the statement recognizes those dissents. How's he going to explain any dissents? How's he going to explain the decision? And what are he and his colleagues watching going forward? Right now, we have a September meeting priced in for a rate increase. Will it still be the same at 3:30 this afternoon when Kevin Warsh is done speaking?
Given that this is a Fed chair who doesn't want to give any guidance going forward, as you pointed out, Michael McKee, it's a dynamic that Nick Timmeros over at the Journal has been writing about, this idea that usually you can reach compromise with other FOMC members by changing the statement, a dovish tweak or a hawkish tweak there, maybe kind of indicating what you might do at the next meeting to sate all of the different opinions. If Chair Warsh doesn't have that ability, because he doesn't want to do that, does it make it that much harder to corral opinion at the FOMC?
Well, it makes it a little bit harder. I don't think it's determinative in the sense that there are people who would like to raise rates now, but the two who vote, Hammack and Logan this time, who want to raise rates, that's only 2 of the 12. The others have said if the economy started to look like it was suffering from higher oil prices or the war effects, they would be interested in raising rates. So right now, he can make the case that, well, oil prices until today had been coming down again, and we have a lot more inflation data between now and September, so why don't we wait? I think that's probably going to carry the day today, but if Kevin Warsh wanted to signal anything, maybe he'd tell people to look at the color of what you're wearing, Danny.
I've already had one person message me saying, oh no, not red, but maybe we can kind of adopt a more Chinese outlook today and say, hey, red's the color of luck, McKee. So that's what I'm sending out there to everybody today. Good luck on a very busy day. You too, Michael McKee. And don't miss Mike and the surveillance team's special Fed coverage of the Fed decision. That will kick off at 1:30 p.m. New York time. Let's get a check on your markets. I'm sorry I'm kind of matching markets and what they're doing this morning, but come on, barely. We're only down 0.1% for the S&P and for the NASDAQ. By the way, yesterday, the equal-weighted S&P reached another all-time high. It was spared from the stress of the rest of this market, and that was another sell-off in semiconductors that started in Asia. Again, not as bad today, but we are just waiting for earnings and a Fed decision. Ahead of that Fed decision, oil rises again with the president speaking on Fox about hitting Iran hard. Brent crude goes up nearly 7% to just under $90 a barrel, while 10-year yields up 2 basis points. Let's look at some of the individual movers this morning. With that is Nora Melinda. Hey, Nora.
3 stocks on my radar for you this morning, Danny. Let's start with Procter & Gamble. Shares down about 4.2% in the pre-market trade. We saw second quarter results that missed expectations. The company giving a conservative outlook for the year with consumers searching for value. We did see that P&G has been really struggling to win market share from its competitors as expenses climb and the company does its best to avoid some of those price hikes. From there, we're going to turn for a look at the commodity trading house Glencore. The company up about 3.6% before the opening bell and reporting $3 billion in profit for the first half of the year. The Iran war is sending energy prices soaring and the company on track for one of its best years ever as the war and AI infrastructure impact metal prices. Last up, we're looking at Next Era teaming up with Brookfield, the company up about 0.6% right now. The company teaming up with Brookfield to convert a Cold War uranium enrichment facility in Kentucky into an $100 billion data center campus. That's by 2031. The project will create about 8,000 construction jobs and 600 permanent positions. Shares of the company still higher before the opening bell. Those are your morning movers. Danny?
Nora, thank you so much. Coming up on the show, Brent crude moves higher as President Trump ramps up pressure on Iran again. That's after this break, right here on Open Interest.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's get you some high-interest stories. A look at what's making headlines around the world. South Korean stocks plunged 16% in 2 days as retail investors dumped shares, sending the Kospi into a record monthly decline. AI worries deepened after weak SK Hynix results, triggering a second straight circuit breaker. By the way, the results themselves were really strong, but expectations were just that high. Officials are holding an emergency meeting to consider market support. Already, they've addressed limiting the ability of retail to buy leveraged ETFs. U.S. banks are pulling further ahead of their European rivals in trading. Goldman Sachs and J.P. Morgan posted record equities revenue as market volatility fueled client action. UBS, Barclays, and BNP also delivered strong gains, but investors are holding them to Wall Street's much higher standards. And President Trump says Iran will be, quote, hit hard after Iran launched missiles at a U.S. base in Jordan. The Pentagon says the missiles were intercepted while the U.S. and Saudi Arabia hit Iran-backed militias in Iraq. The renewed fighting is pushing oil prices higher and raising fears that the conflict could spread. Here joining us with the latest is Bloomberg Washington correspondent Tyler Kendall. Tyler?
Hey, Danny. Well, there's a lot of fast-moving updates this morning as President Trump is now renewing this threat to hit Iran hard after CENTCOM confirmed that the U.S. successfully intercepted that surprise attack on U.S. forces in the region, which was considered to be a pretty massive escalation since we had been amid what was this lull in the fighting in a bid to give diplomacy a better chance. But now instead we're seeing a renewed focus on Iraq. As you mentioned, the U.S. and Saudi Arabia forces had teamed up to hit some sites in the country there after Saudi Arabia claimed that Iranian-backed proxy militia groups in the country had taken aim at them with drones. We got a little bit more insight on this operation from President Trump in remarks earlier today from Fox News, saying that the attacks in Iraq were coordinated with the Iraqi government, but it appears officials there are now disputing that account. We got this new statement within the last hour or so from the Iraqi president, saying that these attacks were unacceptable and a violation of sovereignty. Danny, we know that this White House has been working to dilute the power and influence Iran has over its proxy groups. President Trump had just hosted the Iraqi prime minister here in Washington a few weeks ago. President Trump told me on Air Force One earlier this week that the U.S. is in constant contact with Saudi Arabia when it comes to the Houthis in Yemen, because we are still seeing those shipping disruptions there. And new this morning, a new report from Reuters is adding to the heightened tensions, saying that the Houthis are reportedly considering adding fees for any ships trying to transit through the Red Sea.
Tyler, this is a president who also, when asked about the possibility of continuing talks, said, we're going to let them keep talking. But these attacks, does it just underscore how far away we are from diplomacy? Is there any attempts at diplomacy still happening in the background that we know of?
I mean, Danny, last night President Trump said that he really wanted to opt for that that renewed diplomatic effort. It had been our understanding that talks were happening, according to some senior U.S. officials, at both the technical level as well as the leadership level. As of now, we'll have to see how they develop from here, because we know, importantly, talks had to happen about reopening the Strait of Hormuz before we can even consider those negotiations turning towards what potential curbs on Iran's nuclear program would look like. And new overnight, we didn't really get encouraging information on that front. Iran's foreign ministry coming out with a statement saying that the country had rejected the latest proposal from Oman when it comes to reopening the Strait of Hormuz. Oman had proposed that they would utilize that so-called middle passage in the strait, giving both countries equal and joint control. But Iran is saying that their country is vying for sole control of any ships that are transiting through, and that no doubt is going to add to the escalation and hinder those diplomatic efforts, because you need the strait to be open in order for the talks to continue.
Hey, Tyler, thank you so much for that update. Bloomberg's Tyler Kendall in Washington, D.C. Coming up, Visa and SoFi beat Wall Street estimates, but both are falling in the pre-market. We're going to get more into corporate earnings coming up next. This is Bloomberg Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Today, the Fed decides.
Share wars just around the corner, setting the stage for a real debate. Is this meeting live or not?
Our number one objective is getting policy right. And if we get policy right, we can deliver lower prices.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis.
The sum of this is real GDP and the inflation piled on top of it.
That's going to cause inflation that does come into consumer goods in other ways.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Visa beat earnings estimates, but shares are down 2%. The company disclosing a $563 million charge tied to job cuts, which we learned about yesterday. We learned that with our Bloomberg Consumer Finance reporter, Paige Smith, who joins us yet again. Paige, good to see you. A busy 2 days for you. Is this the reason why shares are selling off? Is it just that charge specifically tied to that 2,600 people's worth of layoffs they're doing?
Yeah, if you think of sort of the rest of the metrics that the firm reported, it really was a positive. It was a positive quarter for the payments firm. I mean, you think about consumers are still spending, businesses are still spending. There are still high growth opportunities for the company, but certainly there was that job cut news yesterday. And it was interesting. We got a little bit more, we got some more color on just exactly the kinds of jobs that were being targeted in that action on the call last night. Specifically, the product development teams are essentially going to be made more nimble. So they described teams of 10 or more that were maybe going to be pared back to around 2 to 4 people.
Okay, that's a sizable cut for some of these companies. I mean, some of these teams. What about the more sort of traditional consumer business? I mean, just on a more macro scale, there is this confusion about how the consumer is. How did things shape up for that part of Visa's business?
Well, if you think about how Visa functions as an entity, essentially any time a transaction is made, Visa gets a cut, or a sort of payment processor of some kind gets a cut. So as long as spending continues in some capacity, firms will profit off of that. But at the same time, there is this confusion about how the consumer is doing, and also a lot of confusion about there is a lot of geopolitical uncertainty underlying major corporate decisions that also contribute to Visa's success and other payment firms' success.
Just real quick, because we also had SoFi earnings. Same thing here, just like expenses being a problem for them?
Yes, we saw expenses were up a little bit. And just to sort of step back for payments and fintech generally, SoFi reported earnings today. We also have Robinhood aftermarket. Something to watch too, because similar areas, they all play in similar
areas. Does Robinhood do well for the same reason the banks did well, that there's a lot of volatility and a lot more trading, and that's good for them?
There's a lot of volatility, but one thing to actually watch on Robinhood is going to be the prediction markets revenue, which is people are watching closely to see if it will properly eclipse crypto revenue for the first time. So that's a metric to watch. It feels
like such a sign of the times. That prediction markets are more, that like it used to be crypto being the hot thing for them, and now it's that everything is a casino.
And it could come back. We'll see.
Yeah, true. It's a good point. It's not dead. Paige, thank you so much for joining. Great to see you again. Bloomberg's Paige Smith, and catch the SoFi CEO Anthony Nato on Bloomberg Tech. That will be at 11:30 a.m. New York time today. Let's get a check on markets. Less than 5 minutes to go until your opening bell. And we're going a whole lot of nowhere after a sell-off in tech yesterday, but the equal-weighted S&P reaching a new record. Yields move higher alongside the price of oil. So just 4 minutes until your opening bell. We begin your trading day with JP Morgan's Sitara Sundar. That's coming up next. This is Bloomberg Open Interest. World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Moments away from the start of trading, you're watching Bloomberg Open Interest. I'm Danny Berger. Matt Miller still on paternity leave, and we're gearing up for a really busy day. Most of it will happen closer to the close. So we have a Fed decision at 2, followed by a presser at 2:30. Then we have earnings from Microsoft and Amazon, followed by more hyperscalers tomorrow. And ahead of that, going a whole lot of nowhere. It was tech that underperformed yesterday. Most equities did well yesterday, despite semiconductors, but that did drag us down a little bit. Opening the bell at the NASDAQ. It's a New York Stock Exchange, rather. It's a nonprofit called Accor. I think it's around clean energy. Gosh, the New York Stock Exchange have had so many nonprofits and various charities ringing the opening bell. Interesting, because we're in the midst of a lot of IPOs. Maybe more of them are happening at the NASDAQ. We have I believe this is a cloud computing company, Cumulus AI, like a cloud. If only I could read properly. Ringing the opening bell down at the NASDAQ with some adorable children up at the front. I always gotta bring our kids to ring the opening bell, a once-in-a-lifetime experience. Here's how the big tech players are shaping up in this morning's trade. So you have Microsoft and Meta, both of them are slightly down about 0.5% in the case of Meta. They're going to have a high bar when they report earnings after the bell, with higher AI spending met with disappointment on Wall Street. So that's actually a good correction. I think I said Amazon is reporting. It is Meta after the bell today. SK Hynix, though, the perhaps perfect example of what we might see. Shares are down, even though they reported a 6-fold jump in profit and a 50% rise in planned capital investments. Let's bring in JP Morgan Private Bank Head of Alternative Investment Strategy, Sitara Sundar. Sitara, great to see you. And I wonder if that just is what we need to expect from this earnings season. The bar is so high that even if you meet it or slightly exceed it, it's not good enough, that shares will sell off.
Yeah, look, the hurdle rate is higher, and part of that reason is we need to take into account where we've been. We're 3 years plus into the cycle. During that period of time, S&P has annualized 20%, semiconductors have annualized 50% plus, NASDAQ is up 30% plus annualized during that period of time. It's a meaningful amount of price appreciation to the extent that we haven't seen in multiple decades. So what I think, there are two questions I think the market is trying to answer at this point in time right now. Is the investment that we're making within the build-out of artificial intelligence infrastructure, whether that's the power side, whether that's the semiconductor side, whether that's the memory side, are we finally going to see the payoff of that? Is it finally going to come to a point in time where we're in the year of ROI? Show me the productivity benefits, show me what the long-term potential of it is so I can justify the spending. And then two, who the ultimate winners of this cycle are going to be. We're in a meaningful digestion period within artificial intelligence where some of the biggest infrastructure winners are taking a bit of a breather, and the ultimate question is what is going to increase adoption? And even within the frontier models in the LLM landscape, who is going to be the winner there? Is it going to be closed models? Is it going to be open source? Like, how are we thinking about that? And that is, I think, the two questions that the market is trying to digest, which means that everyone is very attuned to the folks who have won so far, and the hyperscalers are one of those players.
And then I guess the chip makers are too, because if you can report an 86% rise in revenue, that seems to be a good place to be. But has something changed for this market, given that, I guess, digestion period that you explained that we're in? Is that no longer kind of like a safe, cushy place to hide out just because of the remarkable volatility, even though there's been really robust year-to-date gains?
Yeah, there's this near-term, long-term tension. For the longest time, the right place to be has been investing in the folks who are trying to relieve the bottlenecks in the AI ecosystem right now. Power, compute, semiconductor players are a big part of that, memory too, and we've seen some kind of cyclical technical rotation within that. But the second part of it too is, I think, a refocus on what the long-term potential of this is. What does the integration of artificial intelligence into the real economy look like? So I think what you're likely going to see, not just in this week, but even longer term, is both of those trades playing out at the same time. Some people taking some chips off the table on the winners of the past 3 years and thinking through what the future winners could look like, whether that's the services business, whether it's like financials, whether it's industrials, whether it's healthcare-oriented businesses. You're even seeing that in what you mentioned earlier on the S&P equal weight actually starting to rally, trying to think through investing in the opportunities of not the businesses and the companies that have built and invested in the AI infrastructure, but those that will benefit from integrating that technology into their day-to-day businesses without having to front the CapEx.
This is something that Mike Wilson has talked about, that you will start to see the companies who've been integrating AI start to pay off. I wonder how you're looking at this on the private market side of things, because every day you hear of a multiple billion-dollar data center project. Today, it's NextEra in Brookfield in Kentucky, $100 billion, which is quite a chunky chunk of change, if that makes any sense at all. Again, a lot of this is happening on the private capital side of things. Yes. How are you directing your clients when you don't have a mark-to-market sort of environment to take bets on what makes sense and what might look like an overspend?
Yeah, so I think the number one thing to think about, especially if you're going to lock up your money for at least 5, 7, 10-year type of time horizon is what is a durable trend that I can get behind. Point number one is that despite all of the build that we're seeing within data centers, despite all the build that we're seeing on the power side, we are still in a meaningful supply-demand imbalance in terms of the demand that is needed for power and energy, not just within artificial intelligence, but general electrification of the economy. We're still in a massive supply-demand imbalance within the U.S., but definitely globally. The U.S. actually might end up in a situation where the amount of demand is going to far outreach the supply even by the end of this decade. So we're still compute constrained, we're still in a supply-demand imbalance, which means infrastructure and private infrastructure and these like public-private partnerships that you're starting to see play out is a durable trend in our opinion moving forward. So infrastructure and private infrastructure has given our client portfolios and client conversations two benefits. One, you have access to this secular theme, but in a more durable way, because at the end of the day, these returns are based on multi-year contractual cash flow, so you have visibility into the cash flow profile. But then two, the other thing that we haven't talked about yet is inflation volatility and what's going on in terms of either the geopolitical tensions that we're seeing so far this year, but what has really been persistent inflation volatility over the past 5 years, given the amount of supply side related shocks that we've seen on a rolling basis. And whether it's infrastructure or whether it's real assets or in real estate, you're starting to see this pickup in client demand, and even for us from a long-term investment perspective, because you get to a certain extent inflation resilient income. And that's a necessary complement because core fixed income always has a role to play in terms of a defensive ballast within a larger portfolio. but it tends to have a more difficult time in protecting an inflation-oriented environment.
This is really interesting because this is an argument that Akhil Bansal of Carlyle, who heads up infrastructure there, came on to make in a new paper. He heads up ABF, to be more specific, but obviously a lot of infrastructure, saying, I mean, it benefited him, this argument, and he said as much. I know I'm talking my book, but it's true. This idea that traditional fixed income is less appealing because of inflation volatility. And then on the other side of things, corporate credit, just so many tech players have been issuing new debt that it actually looks a lot like equity. So for portfolios, is traditional fixed income just less attractive, or its use has just changed in terms of a diversifier to equities, let's say?
Yeah, I think for the longest time, post-global financial crisis to pre-2022, the entire conversation was around where can I get carry? Because fixed income wasn't giving me the same amount because we were in a near zero rate environment. We're in a different environment right now, regardless of what the Fed may or may not do later today. We're in an environment right now where rates are higher. So therefore, there are actually pockets of public fixed income that are starting to look a little bit more competitive, primarily because your carry is higher than it has been in the past. But on the flip side of it, the conversation around what that 40 part of your portfolio and what those diversifiers mean has just fundamentally shifted from where can I get the best yield to where can I get the best yield that will either defend me in a higher inflation volatility environment, which is where not just the real assets, but we're constructive on asset-backed finance as well, but then two, even thinking about ways to lean into less correlated return streams. And that, despite the volatility that we've seen so far this year within the hedge fund landscape, hedge funds are starting to get brought up in conversations, and we're more constructive on that too.
But aren't they really concentrated too? And I think about that, Sitar, just quickly, because we're almost out of time. There was a story that Wall Street banks have been pushing hedge funds, kind of being like, you need to start putting up more collateral just because we're worried about the concentration risk you have in AI.
Yeah, I think it depends on which hedge fund you're invested in. There's like some areas within long short that have been very levered to the AI trading that are feeling some of the heat from the momentum unwind that we've seen so far this month. But there are other areas that lean into less correlated return streams, whether that's macro, whether that's relative value on a longer term basis, where you can better capitalize on these intra-asset classes and intra-geographies, market mispricings that you're able to generate not just less correlated return streams, but higher alpha generation at the end of the day too. But the biggest thing that we talk about is hedge funds are an industry, not an asset class, and who you pick matters.
Very well said. Sitara, thank you so much for joining. Such a pleasure to have you on JP Morgan's Sitara Sundar. Let's get a check on your equity market over 10 minutes into your trading day. And we are hanging tight, down about 0.1%. Pretty even split between winners and losers. A lot of winners yesterday, despite an S&P that finished more or less flat, not too much of a gain. In the gainer side, we have a lot of the energy players, given the price of oil is higher today with President Trump threatening to hit Iran hard. Exxon is up there. Apple, just in terms of points, is one of the top gainers. Yesterday, it closed just below $5 trillion, so we'll see if we can get through that level today. Coca-Cola is up after reporting earnings yesterday. Seagate reported earnings today, and that was a beat for the hardware company. On the downside, you have a lot of the big cap tech. NVIDIA, Microsoft, Amazon are down. SK Hynix reported earnings, and those shares are falling. P&G also reporting earnings that miss expectations. So again, the consumer clearly is uneven, from Ford doing well to P&G not doing well. In terms of your sectors, energy is the standout just because the price of oil is moving higher today. So energy up 2.5%. Industrials, materials, infotech, those round out your bottom sectors. Coming up, semiconductor stocks under pressure as investors take a harder look at the AI trade. We're going to have more with Mandeep Singh. That's coming up next.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Time now for your top calls. Here is Nora with some of the analyst action this morning. Nora.
Well, let's dive right in. First up, I'm looking at Caterpillar shares dropping to April lows. The company getting a downgrade at Baird. Analysts over there saying that growing restrictions on data centers can not only slow down AI spending, but also hurt future equipment demand. That's not going to be good for Caterpillar if it plays out that way. Next up, Danny, I hope you're hungry because I am. Morgan Stanley upgrading the Cheesecake Factory to equal weight from underweight. Analysts say that sales can pick up in the second half. New menu items, stronger marketing, and its loyalty program expected to send more foot traffic through those restaurant doors. I need a slice of cheesecake. Last up, Texas Instruments getting an upgrade at Arete. Arete saying the AI boom could keep the analog chip market tight for the next 2 to 3 years. That's certainly a perk for Texas Instruments. Shares up about 0.6% right now. Seems like that AI demand just isn't slowing down, Danny.
Girl, can I just say it is 9:40 a.m. and you want a slice of cheesecake?
Why not? We can always have a slice of cheesecake.
Live your life. I love it. Nora, thank you so much. We'll catch up with you later in the next hour. SK Hynix elsewhere reporting a surge in quarterly profit as demand soars, but that wasn't enough to impress Wall Street. It raised its spending plans by 50% to $31 billion. It originally sent shares lower. Now we're up by 1.1%. Let's discuss with Bloomberg Intelligence head of global tech coverage, Mandeep Singh. Mandeep, I was so ready to be like, oh, it doesn't matter if you have like a 500% increase in profits. The market wants more, and we're kind of up today. So, okay, let's scrap that narrative. What was your overall takeaway of SK Hynix?
That right now these memory companies are showing, 40, 50% quarter-over-quarter growth because pricing has been so strong. I think what they referred to in the earnings call is, look, we're looking to sign more long-term agreements. That's what Micron said, and that's what these guys are doing. They want to enter into 4 or 5 year agreements with all their big customers where they cap the pricing, but they also have the visibility that, customers are going to buy from them, and it's not going to be spot pricing driven, which is how the memory market
Does that mean that we need to get away from the world where we are trading at 8, 9 times multiples, that it should be higher because they're not cyclical anymore if they have these longer term contracts?
I think that's harder to change given the nature of the memory market, and a lot of it is driven by the fact that demand is really strong on the HBM side, but all the pricing growth is coming from the conventional DRAM side. And that's where companies like Apple have complained. They want to qualify, Chinese CXMT for use in their devices because they don't need HBM. They just need the conventional DRAM where they have to pay, 30–40% higher memory prices. And that's where these companies are walking a kind of a tough line in terms of making sure they don't really, have a rough time with one of their main customers, which is Apple in this case.
Right. Well, I believe it was Micron that came out in their earnings and essentially said when prices were at rock bottom, we tried to negotiate with the company. I think it was implicit that it was Apple saying, no, we need to charge you a higher price in order to keep investing. And they weren't able to do that. I wonder if that argument now is compelling to an Apple, or should prices start to fall, they're just going to be like, hey, that's the nature of the business. We're not paying you as much.
Yeah, look, SK Hynix said they have LTAs with 10 of their customers. I'm guessing 10 could possibly include someone like Apple, but again, they want to make sure they have a broad suite of products that includes DRAM, HBM, and other things, NAND. And so from that perspective, if there is an agreement that encapsulates everything, that will be a lot more palatable to a potential customer.
So does all this mean that we've basically reached the peak of pricing power? And if we have, is that not good news for the hyperscalers that we're freaking out about how much they're spending on CapEx? Doesn't that start to come in if they don't need to spend as much on things like DRAM?
I think so. You bring up a good point that a lot of the CapEx increases that we saw from Google last week was likely because of memory price increases, and I expect the same for Microsoft and Meta. When they report, they have to pay up at least for this year. And then going forward, if they're in an LTA, then actually it's good news from that perspective. At least you're not paying for component memory pricing. And yes, you still want to expand your capacity, but you don't have to pay up for, the components.
All right, Mandeep, thank you so much for joining. Appreciate your time. That is Mandeep Singh gearing up for a busy day of earnings both today and tomorrow. Elsewhere in earnings, P&G results falling short as consumers pull back on spending. We'll break down those results with Red Brown coming up next. This is Bloomberg Open Interest.
The latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. Let's get a check on your equity market 20 minutes into your trading day as we await both a Fed decision and earnings from big tech. NASDAQ falls 0.5%. The S&P down 1/3, following on from yet another day of selling and circuit breakers in South Korea after SK Hynix reporting earnings. Dow is also down by 1%. 10-year yields, though, are moving higher by 1 basis point. We're at 462 as the price of Brent crude moves higher alongside it, given the president's threats to Iran on hitting them back even harder. In terms of individual stocks, Micron, you can see they're down 2%. NVIDIA down. Humana also lower. Visa is higher after they reported earnings. They did have higher expenses after letting about 2,600 employees go, or at least announcing plans to do so. Even so, the rest of the results looking pretty strong, so shares are moving higher. Ford, another read on the consumer, up 7.5%. Strong sales for their most expensive cars, for SUVs, for trucks, so shares going up 7.25%. Also, their energy battery business doing well too, which has started to apply to AI. And then P&G, Procter & Gamble, down nearly 7%. A tepid outlook. Quarterly results miss estimates. Let's dig into the details. Joining us now is Bloomberg consumer reporter Red Brown. Red, what were those details?
Yeah, I think the details that kind of emerged from this call is that P&G and other consumer companies are in a really kind of complicated position, right? They have the cost inflations that we're seeing kind of across the supply chain, resulting from obviously the Middle East conflict, but at the same time, they're not able to kind of offset those costs in their business because consumers just have no capacity for this after so many years of inflation. So they're in this really sort of
higher because of what's happening in the Strait of Hormuz. Is it all of the above?
It's all the above. So the company reiterated its outlook for cost inflation to be $1 billion in the coming year, but they really emphasized the fact that a lot of it's coming from these non-commodity inputs as well. So it's things like cost of shipping. They've had to change their suppliers as well, as some of them are in areas where they can, maybe not operate at the capacity that the company needs. So it's all of these things sort of filtering in. And right now the company is expecting that to hit earlier in the fiscal year for them and resulting in a 5% drop in their earnings. So we kind of see how this is really hitting in the near term with hopefully plans that P&G is purporting to be put in place will hopefully get them back into the growth towards the end of the fiscal year.
Just with all of this and the state of the consumer, because we have seen data that suggests the consumer is still spending. Visa, for example, posts earnings today and it shows that the consumer is resilient. People are buying expensive Ford trucks. Is the difference with P&G just that sure, the consumer is spending, but they're not willing to accept higher prices, and that's where it becomes an issue for them?
Yeah, exactly, because people, it becomes difficult for the company to grow its sales when they're not able to kind of push the prices through that they were able to when volumes are so kind of flat, right? So people aren't overspending. They're not buying more than what they need. They're buying exactly what they need, making what they have stretch, squeezing every last bit of toothpaste out of the tube, things like that. So it does make it a little bit more difficult for them to, find that growth when the consumer is, resilient. We've heard terms of, kind of stable or muted. So the sort of language around how the consumer is doing is sort of shifting a little bit. But yeah, that does make it kind of complicated for a company like P&G.
P&G obviously has a lot of different types of consumer products. Well, what about the breakdown of different segments within it? Like, are things like beauty still robust, or is this kind of an across-the-board problem they're having?
I think it's a bit of an across-the-board problem. If you look across their 5 main markets, all of them disappointed this quarter. So they all came in under expectations. So it's also a regional thing. It seems like the U.S. and European markets are where some of these problems are showing up a little more. The company was kind of touting the progress they're making in China, but a lot of this is innovation driven. So this will be the way that the company gets out. They're gonna have to kind of spend their way through this. Again, deal with a little bit of this kind of short-term pain for hopefully long-term gain.
Right.
But obviously that remains to be seen.
All right, Red, thank you once again for joining us. Loved having you on every day this week. This is so great. Red Brown from our Bloomberg consumer team. Coming up in the next hour, we're gonna speak with Goldman's chief U.S. economist, David Miracle, about the Fed and data to come. We also talk AI investing with Battery Ventures general partner Jamesh Thakur, and Logitech CEO discusses gaming hardware and more. This is Bloomberg Open Interest, your hour 2, right after this break.
say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers, and it's hard to pick the winners and losers now. And certainly, a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
As some predicted it would be, the Senate Homeland Security Committee's questioning of Dr. Anthony Fauci had a lot of drama, beginning with Fauci's own statement.
Under the advice of my attorneys, I will invoke my right under the Fifth Amendment of the Constitution to refrain from answering your questions.
Fauci was subpoenaed by Senator Rand Paul, who at one point told Fauci's attorney to stop speaking on his behalf.
I said, sit quietly, you are not recognized. Another word and you're gone.
Well, the attorney kept talking, so Rand directed.
Security, please remove him from the room.
The Capitol Police did remove him, as some in the hearing applauded. U.S. forces in the Middle East on high alert after a surprise attack by Iran on Jordan, where CENTCOM is located. The 5 missiles launched were all intercepted. However, says ABC's Rachel Scott at the White House,
this goes against everything the president has been saying for days. He has insisted that Iran badly wants to make a deal. Sources tell me he even put off a major escalation in this conflict to give way for diplomacy. But Iran is clearly not interested in that, launching another attempted attack overnight.
The search for survivors after the Japanese earthquake continues. ABC's James Longman has more.
Shoppers seen running. An explosion 90 minutes later, part of the second floor collapsing, and now thousands of emergency personnel have been deployed to assist in rescue and aid efforts. The quake's epicenter was located on the southwestern island of Kyushu. 300,000 people have been told to evacuate to safety. Fires broke out throughout the area. Tourists witnessed the famous stone wall of Kumamoto Castle crumbling to the ground.
300,000 people have been told to evacuate because of aftershocks. Former FBI Director James Comey has moved to dismiss the Seychelles case against him, saying he was exercising his First Amendment rights. Federal prosecutors are trying to prove his 8647 message was a legitimate threat. This is ABC News. Someday science will come up with a way to manufacture synthetic blood.
In the meantime, the only source of blood for medical procedures is humans.
We need people to step up.
Matt Trotter is with the American Red Cross, which has declared a national blood supply emergency.
If 3 more people came to every Red Cross blood drive over the next month, we would be out of this crisis.
The nonprofit has been hit from both sides, a seasonal increase in demand for blood products and a precipitous decline in donors. Jim Ryan, ABC News.
Along party lines, the Senate confirming Jay Clayton to be the next director of national intelligence.
At a hearing this month, Clayton repeatedly refused to say that Joe Biden won the 2020 election, saying only the election was certified.
Who won the 2020 election?
I think I've answered the question. We can keep doing this.
Well, we're going to keep doing it because you're not being honest and forthright.
I'm not going to engage in the theater.
Clayton inherits an intelligence agency that's being downsized. The acting director he's replacing announced yesterday a 30% staff reduction from just weeks ago. Lawmakers are now requesting details about those cuts.
ABC's Sophie Flay. Irish singer-songwriter Glenn Hansard, who won an Academy Award for the 2007 film Once, has died in a motorcycle crash in Ireland. He got his start as a busker on the streets of Dublin and sang a rousing rendition of the Pogues' Fairy Tale of New York at Shane MacGowan's funeral in 2023. Irish Prime Minister Michael Martin says he is deeply saddened at Hansard's passing. Sherry Preston, ABC News.
If you haven't switched to Pure Talk because...
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube and streaming live at Bloomberg.com as well. It is Scarlett Fu, Paul Sweeney. This is the Bloomberg Intelligence Program. Coming up, we have selling in the marketplace today. It is Fed Day. We got lots of earnings after the close. We're going to kick this off. We'll talk to Mandeep Singh in just a moment. He's Global Head of Tech Research for Bloomberg Intelligence. Get a preview of some of the big tech earnings that are coming out over the next couple of days. Jeffrey Cleveland, Chief Economist at Payton & Regal, to discuss his outlook for the U.S. economy and for this Fed. Anthony Hughes, Bloomberg U.S. Equity Capital Markets reporter, is going to join us and talk to us about the Jersey Mike IPO, more than 10 times oversubscribed. How about that? Kirsten Fontenrose, Senior Fellow at the Atlantic Council. We'll give the latest on the Middle East. Tensions flaring again, which is pushing oil up 6 to 7% here this morning. Tim Craighead, Bloomberg Intelligence Chief Content Officer. He's going to talk to us about one of the big research pieces coming out of BI about what Europe needs to kind of rearm and rebuild power and their grid. Big dollars are needed there. So we got a lot coming up over the next couple of hours. Let's kick it all off with John Tucker and a Bloomberg Business Flash.
All right, guys, good morning. This Bloomberg Business Flash brought to you by IBKR. For the past 3 years, Interactive Brokers' individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. Stocks are lower, oil is higher, bond yields are higher, and of course the Fed mystery that's getting cleared up at 2 p.m. Wall Street time today. Energy, best performing major industry group in the S&P 500 as Brent crude goes back above $90 a barrel. Industrials and information technology, they are the worst performers and ahead of the earnings after the close. Shares of Microsoft and Meta were both down about 0.7%. And again, the NASDAQ 100 down about 10% from its June high. Best performing stock in the S&P 500, Garmin, up 17%. The GPS-enabled products maker boosting its earnings per share guidance. And meantime, Julian Emanuel at Evercore ISI says, you know what, the recent tech sell-off may not be as bad as it seems.
If you're a tech stock investor, you have to be comfortable with higher volatility. And frankly, if you had told me that Korea would have been down, whatever the number is, 33, 35% from the top, and the NASDAQ barely down that 10% threshold, I would say that's probably not a bad result.
Right now, the S&P 500, 35 points lower, down 0.5%, 73.93 on the index. The Dow down 701 points, 52,046. The NASDAQ 100, 156 points lower, That's down 0.5% right now. Well, you can get in on this. The New York City Department of Transportation putting for auction the first of the Champions Way street signs that were hung along the ticker tape parade route for the Knicks. The bidding's underway. Started this morning at $100, ends on August 12th. Just about everything with the team's image has been pretty high demand.
Yeah.
Remember the executive director at J.P. Morgan Chase was hired. She was caught trying to steal a commemorative
garbage can.
Knicks garbage can
Yes.
during the parade. Don't steal garbage cans.
The New York Post had a field day with that one.
Yeah. Oh, you have a job, a big job at J.P. Morgan Chase. You get fired for stealing a garbage can.
Yep.
Okay, kids. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube as well. As John was just reporting, got a sell-off in the market today. Let's take a look at some of the stocks on the move. We can do that with Christina Aquino, managing editor for Markets Live, joining us here in the studio. What are you looking at, Christine?
All right, Paul, let's start with Meta because we're going to get those earnings after the bell later today. So ticker META, those shares trending just slightly lower, down about 0.4% here. And so really a few things that investors are going to be looking out for those second quarter results. A lot of focus on their efforts to build a cloud business because potentially that opens up a new revenue stream. It could help offset their aggressive spending on artificial intelligence. Now, of course, CapEx very much a big focus as well for a lot of these hyperscalers and big tech companies. So they guided for CapEx to increase to as much as $145 billion during their last earnings report. So we'll see what that number looks like for the second quarter. And of course, we know that Bloomberg News reported earlier this month that Meta was developing plans to sell access to its AI computing power. So investors are going to want to know how they plan to monetize that from this set of results as well.
And it's not just Meta because Microsoft will be reporting after the close today, and we'll be all over that on Bloomberg Business Week this afternoon. What are people saying about Microsoft?
Well, Scarlett, yeah, very much the focus as well. As you say, earnings also due after the bell today. So ticker MSFT, those shares a little bit flat to trending just slightly lower today. But, you know, a lot of expectations in terms of their revenue. Analysts are expecting a 15% increase from a year earlier. And of course, Azure, which is their cloud unit and is the source of much of their AI-related sales, that's forecast to increase in terms of sales to about 40%. So we'll see if those expectations are either met or exceeded. And again, CapEx, right, is going to be the focus. Microsoft's saying that it will spend about $190 billion this year. So is that number going to rise? Is that number going to fall slightly? We know what happened to Alphabet, of course, when they increased their CapEx figure to $205 billion versus $190 billion. It was punished very much in the markets in the reaction the following day. And of course, that also came with its first negative quarterly cash flow for the first time since it went public. So is Microsoft going to go the same way? We'll find out.
Lastly, Seagate.
Let's take a look at Seagate. So ticker STX, that's doing really well today, up almost 5% now at the moment. So really roaring from its opening gains. It's a computer hardware and storage company, reported fourth quarter results earlier today, beating expectations. Revenue at $3.63 billion versus estimates of $3.49. That's up 48% year on year. So very much riding that high of demand for storage at the moment. And their first quarter forecast for revenue also looking more rosy than expected, $4 billion to $4.2 versus an estimate of $3.79. Their CEO and chair Dave Mosley saying that the performance is really being driven by robust cloud data center demand and disciplined execution.
All right, good stuff. Thank you so much. Christina Aquino is our managing editor for Markets Live coverage, and you can check out her work on MLive Go on the Bloomberg Terminal. And for more conversations like this, subscribe to our Stock Movers Reports, 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, Christine was just telling us about two of the big earnings that are coming out after the closing bell, Meta and Microsoft. Let's bring in Mandeep Singh, our global head of tech research here at Bloomberg Intelligence, for more on the tech trade and how sentiment has really turned, it feels like. And you can see that most dramatically in Korea, where the market has plunged for 2 straight days. The regulators there are now saying that they regret, and they've been saying this for a while, allowing these leveraged ETFs, and they want to now limit retail involvement in leveraged ETFs. Are the same dynamics in Korea spilling over into the U.S., or is the U.S. kind of stoking what's happening in Korea?
I mean, the surprising part is the fundamentals of their companies tied to these leverage ETFs are very strong. Even with SK Hynix, 50% quarter-over-quarter growth, it's phenomenal. And, when a company is going, 250% year-over-year, these sort of things, I'm surprised when the stock reaction is negative, and that's partly because how people are positioned in terms of these margin calls that they're getting. And so fundamentally, nothing seems to be weak over there, other than the fact that all these memory makers are looking to sign more longer-term agreements. They don't want exposure to spot pricing because that's where the boom and bust effect is very pronounced. So they are signing like 5-year deals with 10 of their largest customers just to lock in the pricing so that
they have visibility.
And I would assume it's going to be a lot of the data center players that are doing the CapEx. They're all customers of SK Hynix, and it limits the pricing growth. So out of the 50% quarter-over-quarter, 30% was ASP growth. You're not going to see that going forward because of these LTAs, but still it's very healthy if the demand growth is 20% plus, they are investing in supply. These are very healthy trends.
Meta, after the close, what if you were the IR investor relations person, what would you tell your management team that Street wants to hear?
I think the Street wants to hear the ROI aspect of Meta more than anyone else. And in the case of, Microsoft, it's going to be the cloud business, same thing with Google. With Meta, yes, the ads business is growing remarkably well, like mid 20% growth is phenomenal for a $200 billion business. World Cup probably helped Meta in the quarter, but at the end of the day, we're talking about $150 billion in CapEx. What's your long-term plan, 2-3 years out in terms of a separate line of business? How is it going to...
So what are they investing that money in? Because they're an advertising company at the end of the day.
Yeah, so they are setting up AI data centers very similar to Alphabet.
Okay.
And they're using it all internally. In the case of Alphabet, Alphabet is using about 50% of that AI data center capacity internally for their family of apps. But Meta is using the entire 100% internally. And their ad pricing has gone up. But this is not the type of returns you want to see because it's all incremental. They don't have a separate chatbot offering like Alphabet has with Gemini. And the standalone apps haven't really taken off. So the real question here is you don't have a separate cloud business. You don't have a standalone app like ChatGPT or Gemini. What is it that I can see, as a return for this incremental $150 billion CapEx spend every year? I don't think it's as bad as the metaverse. So this is not going to have that type of ending. But the scale of it, like we're talking maybe $1 trillion in CapEx just from Meta through 2030.
How much faith do you have in Mark Zuckerberg's ability to execute on these things? I mean, you mentioned the metaverse. That was a wrong turn. And Meta has, I feel like, chased a lot of the trends that the rest of the tech industry has kind of set out. Do you have faith in his ability to, make Meta a leader in this?
That's the beauty of this business is it generates so much free cash flow that you can afford to be wrong for a year or two. And even if, what's the worst thing that could happen? They invested, $500 billion in CapEx. Yeah, they couldn't go anywhere. They end up using an open source model or an OpenAI or Anthropic model. And they end up using their cloud, their AI data center capacity with others' models. Still, the business will keep generating $100 billion plus in free cash flow because of all the engagement they have. So until the core business is impaired, you're not going to see that.
Mandeep, awesome. Appreciate it. As always, you'll be busy after the close today. And for those earnings this afternoon, Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. Participate in our wall-to-wall coverage of earnings today at 4 p.m. Eastern by submitting questions for our analysts and experts to answer live on air. Subscribers can go to Bloomberg.com/AskRadio to send in questions. Then listen on Bloomberg Radio and Bloomberg Originals.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Well, ahead of the earnings after the close of regular trading today from Microsoft and Meta, major stock averages, they are pushing lower. Meta is down 0.8%. Microsoft right now, 0.3% lower. And as you just heard, I mean, the big focus, of course, is going to be on CapEx and when the heck all that is going to pay off. Paul, you're going to have to explain to the class why you're laughing.
Now I'm just getting lost in something.
Oil is higher, and ahead of the Fed decision, 2 p.m. Wall Street time, yields are higher. The more policy-reactive 2-year yield, 2 basis points higher at 4.30%. Quick look at Ford, raising its profit outlook for the second time this year. Consumers continue to snap up the automaker's high-margin sport utility vehicles. I see the Ford Bronco like everywhere.
Everywhere.
And they're outfitted with these really expensive off-road, you know, whatever you call it.
It looks great.
Wait, you're seeing this on the streets of New Jersey, so no one's actually doing this.
So you can off-road, I don't know, to the food town and pick up whatever. Anyway, S&P 500, 42 points lower. That's down 0.6%, 73.84 in the index. The Dow down 717 points. That's down 1.4%. And the NASDAQ 100 down about, let's say, 10% from its peak. Right now, 230 points lower. That is down 0.8%. And we were talking about in the break, Hermes, the luxury brand, those shares fell sharply. That's because sales in China disappointed investors. Now, the CEO says if you want to get an idea when they're going to rebound, watch pork. Because pork's eaten particularly during banquets and at celebrations and at restaurants.
But everyone eats pork, and not everyone gets Hermes.
In particular in China. So
yes,
he says it's a good indicator of the desire to celebrate.
I don't think so. Pork is mass. It's for the mass consumer.
You're really massacring my story here.
I'm sorry.
I was laughing at the beginning. Now she's contradicting. What's going on here?
The CEO of Hermes says when pork prices rise in China, that will be a good indicator of optimism.
I take issue with the CEO of Hermes.
Anyway, we check the market. We try to check the markets and other stuff.
Boy.
Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
Very good. John Tucker, we apologize. We'll be better to behave next time. Scarlett Fu, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. It is Fed Day. 2 o'clock, we get the statement. 2:30, we get the press conference. And at 1:30 p.m. Wall Street time, the surveillance folks, Tom Keene and the gang, will bring you full coverage there. Jeffrey Cleveland joins us here, chief economist at Payton & Regal. He's out there in L.A. Jeffrey, what's your thoughts here? I mean, we got some people out there that I think are pretty credible saying, don't be surprised if we get a hike today.
Well, first of all, hello. I feel nostalgic because I think this harkens back to the forward guidance days. I think you have to go back to a time before Bernanke was Fed chair and think about those meetings, and nobody knows what's going to happen. Anything's possible here, Paul, including a rate hike. I think that's possible. Maybe under priced by the markets for today, but I definitely think it's possible. And the reason why is just you have to put yourselves in the shoes of a policymaker right now. And you're looking out and you're thinking about where inflation is going to be at year end. And if you can make a credible argument, it's still going to be above 3%, then what are we doing? We're 5+ years of missing our inflation target in the U.S. So it's time to take action. That's how I would frame the decision today.
Okay, and of course the Fed has a dual mandate to maximize employment and to keep a lid on inflation. It's got that 2% target, and we're nowhere close to that right now. But the latest data prints, June CPI, for instance, show things moving in the right direction. Was that a fluke, or do we wait to see that confirmed by more data, even though oil prices have been all over the place?
Yeah, my gut is that the June CPI reading was a fluke. It was very soft, on pretty much all aspects of the report. We like to look at median CPI, the Cleveland Fed's tabulated median CPI. For the month of June, Scarlett, that was up 0.2% month over month, which it's good, but it's a more moderate pace of inflation, not flat
or negative reading. So I wouldn't put too much. Also, I think if you're not to belabor a point, but I will. If you're missing your inflation target for 5 years and you have one good month, that's not enough. You need 5-6 months of those 0.2, those soft readings month by month to really be confident that inflation is going to get back to the 2% target on a reasonable time frame. And I just don't see that.
Jeffrey, can you define what is the neutral rate and where are we relative to that these days?
Nobody knows, Paul.
I like the honesty.
Yeah, it's hard. It's really hard in real time to get an assessment of that. I think arguably in real time, people are underestimating where that rate is right now. Why do I say that? Well, I don't think you can build a credible case that monetary policy is tight based on current settings. You can look at financial conditions, look quite easy. You can look at inflation still running above target. You can look at the labor market. As Scarlett said, the Fed has that dual mandate, but the labor market, it doesn't look great, but it doesn't look like it's deteriorating. So I don't think you can say we're at restrictive policy setting right now. So the neutral rate is probably a bit higher than where it is right now. And then we can have a great debate where exactly that will settle in. But, I would say at least 2 or 3 basis points, 2 or 3 rate hikes above current setting on the Fed funds rate. So,
Jeffrey, what do you expect to learn from Kevin Warsh this afternoon? He doesn't want to offer forward guidance. He doesn't want to say too much. He doesn't want to submit dots. So it seems like his whole aura is, I'm not going to tell you too much. You guys go figure it out on your own.
Yeah, like I said, that's the pre-Bernanke nostalgia. I kind of like that. As a Fed watcher, though, we like to we like more information because we can dissect that and we can comment on it. So I'm actually not sure I'm going to learn much from him. Where we're learning more right now, I think the most credible voice in recent weeks has been Christopher Waller, his speech from 2 weeks ago in New York. And, he just talked about the Fed with inflation above target. You can't just sternly stare at inflation and expect it to go back to target. You have to actually take some action. So I think that's more of a clear message. I'm not sure we're going to get any improvement on that message from the Fed chair.
Is the inflation rate, is it structurally higher than the 2% that the Fed likes? I mean, make America great again, bringing manufacturing back here, maybe limiting immigration, which could push wages higher. Structurally, is it even possible to get down to that 2%, do you think?
I think so. I do. I think you got to ask yourself maybe a slightly different question, Paul. What has been providing the stickiness on core inflation in the last 6 months or so? In our view, there's been a big wild card there, which is the tech sector. Some of the pricing for accessories and software has fed through into core inflation. So that's really been the surprise. It's not really a story of immigration restriction, I don't think. The tariffs, they were an effect in 2025, not a big effect this year. So, you could argue you've had a series of these shocks that have hit. If those dissipate over time, if you don't keep bidding up the price on your gaming PC, Paul, I don't know what you're doing, pushing up those retail prices, then those price pressures will fade over time. And I think the 2% is achievable, but not in the next 6 months.
Okay, all right. So sit tight for now. Jeffrey Cleveland, chief economist at Payton and Regal, joining us from Los Angeles ahead of the Fed decision today at 2 p.m. Our Fed special will begin at 1:30 p.m., right, Paul?
Yes,
okay.
Tom and the surveillance
Tom and
team.
the surveillance team. All right, so be sure to tune into Bloomberg Radio for that. Also happening later today is the pricing of Jersey Mike's Subs IPO, yet another Jersey name cited here on Bloomberg Intelligence. So we want to bring in Anthony Hughes. He is our U.S. equity capital markets reporter, covers all the IPOs. Anthony, what do we know so far about demand for this IPO?
Well, all of the indications so far, and this IPO has been on the road for about a week, that there's a lot of demand for this IPO, and we've reported that there's double digits or more than 10 times demand, and I believe it's somewhere a bit more than that now. So it's quite strong demand, but the IPO market's having a bit of a hangover after SpaceX, and the indications we're getting from investors is that there's a little bit of a concern that the valuation here is pretty aggressive, and even though I think this is a really strongly performing company, the sponsor here, Blackstone, is going for a valuation which is, it appears to be a premium to some of the comps, names like Wingstop, And on that basis, it could be that the pricing of the IPO comes in a little bit like, in range or something like that. But it doesn't look like it's going to price really aggressively based on the demand that we're seeing, based on the interest, yeah.
So who's selling stock in this deal? Is the private equity ownership, was BlackRock, Blackstone, whatever?
Yeah, so it's an interesting point here is that Blackstone really only took control of Jersey Mike's in early 2025. That's when they closed the deal. And in this case, they're moving pretty quickly, and they are selling a lot of this offering is secondary. They're selling a big chunk of shares, and so is one of their co-investors. But obviously Blackstone this year has talked about this year as being the year of the IPO, and they have a number of businesses that they're looking to monetize or
exit, basically.
Well, partially exit, at least monetize to an extent. I mean, they'll be a very large ongoing shareholder, so it's not like it's a complete sellout in this situation. But I think that the business has done well in recent years, and they're able to cash in of some of their shares at this point. But it's also a franchise-based business. So when we look at businesses like this and their need for capital, when its growth is really underpinned by franchising, then
asset light, right?
Yes, they don't really need a lot of capital as well.
So what's interesting here is that this has almost zero to do with AI. There's got no connection to AI or tech. It's more about the consumer. And there's another IPO that's pricing today as well that's also tied to the consumer. Tell us about Reformation.
Yeah, well, so Reformation is I mean, maybe you know better than I, but it's a fairly premium type women's fashion retailer or fashion maker. And
you don't shop there, clearly.
Yes, but that deal, it is unusual because there's been very few consumer IPOs this year, and actually few consumer IPOs in recent years, and really a lot more of the focus this year has been on the AI trade. But I think the bankers have been conscious that the AI trade, they've sort of anticipated, I think, to some extent, that the AI trade was going to come off here after a huge run. And the sort of companies that they've been looking to take public here are not really AI related, and that's really been sort of, I don't know, it seems to be part of the plan here. If we look at the second half here, that we may see Anthropic, which obviously there's going to be a lot of interest in that, but a lot of the other deals may not be AI related as they've been in the past.
All right, the Lara silk dress on the Reformation site, $398. You flirt. The Lara silk dress is a sleeveless racerback maxi dress with a V neckline in case of keeping up appearances.
Is that a good price?
It seems kind of high to me, but I like my bargains. So.
Cocktail dress?
Can you eat Jersey Mike's?
While wearing said dress, exactly.
I like how you combine those two together,
exactly right. All right, Anthony, thanks so much for joining us. Anthony Hughes, Equity Capital Markets reporter for Bloomberg News, joining us in our studio here. Jersey Mike's, again, founded in Point Pleasant, New Jersey, on the Jersey Shore.
Pricing this afternoon.
Yeah, after the it closed, and we'll see how that thing trades. Because you're right, Scarlett, I mean, it's non-AI. This is
no AI.
Bricks and mortar kind of fast food kind of thing, or
just
fast
give me a
casual,
sub.
as it's called. And Mike Halen from Bloomberg Intelligence says this is a really good company. You look at same-store sales and margins and things like that. So we'll see how it goes. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. For the major averages, they are lower today. Another sell-off in chip makers dragging the S&P 500 down. It is down 60 points, 73.68. The Dow also down today, 827 points lower. That's a decline of 1.6%. The Nasdaq Composite Index down 293 points. That's a decline of 1.2%. So Bloomberg Economics says the Fed today is going to stay on hold with interest rates. That decision to Wall Street time ahead of that two-year Treasury. The yield about 2 basis points higher, but that might be more of a reflection of the fact that oil prices are higher with Brent up right now, $6.09 a barrel at 90.18. And, of course, Microsoft and Meta upcoming earnings test investors, diminishing patience for massive AI investments. Ted Morrison at Bayer is among those worried about all the spending on AI.
We're going to have to raise a ton of debt and equity to really fulfill the 2027 CapEx requirements going forward.
I want to do Apple shares because, they're firmly in the $5 trillion, only the second company to reach a valuation of $5 trillion. The share is up 0.4% right now, 341.47. You know, for a growing number of youngsters quitting their regular job to become a social media influencer, becoming a little more plausible. Really? You don't have to have a huge audience. A small but loyal audience can now generate enough income to rival a mid-level salary. Brands increasingly moving money toward the so-called micro-influencers. These are the smaller online personalities who have less than 100,000 followers. So, for instance, a TikTok partnership with a creator who has about 50,000 followers, that can run a brand more than $3,500 for a single post.
You've got to have a lot of those partnerships, though, to make that work. And if you're an influencer, you got to hustle. I mean, you got to create content daily. Can't take breaks. Can't go on vacation. You got to do it from wherever you are.
Did you take negative pills today?
No. I'm just saying.
You're poo-pooing another story of mine.
Someone close to me suggested I quit my job and that I become a podcast host talking about stuff from my childhood, like things in the 80s, like ribbon berets.
I would definitely subscribe to that. Yeah.
I was kind of like, I don't see how this works, but
then you'd have to leave us, which we're not willing to put up
or
with.
we can talk about 80s things here on Bloomberg Radio as part of our other stuff mandate.
We could. Yep. Anyway, we check the markets. Stuff from the 80s. What was in the 80s? I don't even remember the 80s.
Flashdance sweatshirts, those crop sweatshirts.
I'd rather forget that.
Ribbon
anyway.
berets.
Good. Right here on
Gordon Gekko.
Bloomberg Radio. Scarlett and Paul, back to you.
Thank you, John. Appreciate that. Scarlett Fu and Paul Sweeney live here on our Bloomberg.
I think I started working here in the 80s.
Yes, in the 80s. There you go. See, that's something good. Hey, the top red story on the Bloomberg terminal here is about geopolitics. Trump says U.S. will strike Iran hard as war escalates again. What happens when that happens? Oil goes up by 7%. Stocks go down. Yields go higher. The dollar rallies. We've seen this play before on both sides of the equation. Kristen Fontenrose joins us. She's a senior fellow at the Atlantic Council down there in D.C. Kirsten, thanks so much for joining us here. Again, the rhetoric coming out of the White House seems to be flip-flopping all over the place depending upon the day here. Do you see any strategy for the U.S. getting out of this situation here?
The administration is running two lanes at one time. They're running both speaking sort of softly through diplomatic channels and mostly through mediators, and then also carrying that big stick that is a recent military buildup that we've seen. Remember that there was a pause in U.S. hostile actions and U.S. kinetic actions for about 3 days, and then Iran pulled a strike on a Qatari LNG tanker, and then again, struck tankers this morning, and they've sent ballistic missiles into Jordan. So the U.S. has really been on a defensive, retaliatory foot for the last several days, and Iran's the one kind of taking the more aggressive stance. So the U.S. strategy is we're open to talks. We don't really think they're serious about them. We think they're just trying to prolong these talks to give them the opportunity to build up these capabilities and strike more of our assets. And we're also going to pre-position weaponry that could be used to attack either Pickaxe Mountain, another nuclear facility, or to hit some of the bunkers that we know the IRGC leadership is hiding out in.
So that sounds like there's no real end in sight. I mean, this can go on for a long time, as anyone who's watched conflict in the Middle East knows. What's the next concrete thing that either side could try to accomplish here?
Well, if you're the U.S., you've got the legal ground, you've got congressional authority right now, and you've got the military assets in place to make some pretty major moves militarily, if you want to. But you can also kind of take the other foot, because you can say nobody was killed in the IRGC ballistic missile strikes on Jordan last night, and that does give the U.S. president an off-ramp if he wants one. It looks to me like the leadership in Iran assesses that conducting these kinds of strikes increases their leverage in talks. That's just a misread of Washington, and neither side is known for reading each other very well. You could also say this was a moment in time that Iran chose to make a statement during the visit of Prime Minister Benjamin Netanyahu to Washington. These strikes only happened a few hours after his meeting with Trump. So it could be a signaling measure as well. And you're also seeing Iran say, okay, our strategy is changing. We're now relying more strongly on some of our proxies. You've seen action against Saudi Arabia out of both their militias inside Iraq and from the Houthis to the south of Saudi. So they've changed their strategy. The U.S.'s strategy has changed a little bit from taking out the capabilities that are immediately striking ships in the Strait to saying we want to do more long-term damage. We want to remove their ability in terms of logistics and supply chains to present like a medium-term or even longer-term threat to that shipping. So every time Iran fires something at a U.S. or partner asset, it gives U.S. legal authorities domestically and by international law to take out as much of that supply chain as they can in a single sortie, a single volley. So we're seeing both say we want a deal, but neither side looks like they're moving toward one. But I would say, and I know this sounds biased, but truly that the U.S. is doing more of a signaling that they're willing to have these conversations, since we're seeing Iran generally be the one to restart kinetics.
Kirsten, is there any evidence anywhere that anybody in the U.S. administration is thinking strategically at all, i.e., it doesn't look like there's going to be a regime change, which was a key goal, I think. There doesn't seem to be any opportunity to get to their enriched uranium, what it appears to be. So what are we doing? I mean, is anybody asking that question? What are we doing here? We're just tit for tat?
Of course they're asking that question. And just remember that, strategies aren't always unclassified in general. But remember that the regime change was a statement by the president, but was never in CENTCOM's plan. So it was never actually a part of the strategic plans for the operation. That was only about degrading Iran's conventional military capabilities and making sure they could not weaponize their nuclear program. So if you're CENTCOM, you're thinking, we've checked these boxes off. You're telling the administration, we're kind of good here. It really comes down to how you, the executive branch, feel about the pressure the international community is placing on you to open the Strait. We can leave the naval blockade on for a long time. It's squeezing Iran economically in pretty meaningful ways. But the pressure from the international community and from...
Oh, I think we might have lost her.
Yeah, technological issues.
Okay. Yeah, interesting. So that's interesting from the point she's making about regime change was never part of the CENTCOM business, I guess, battle plan or war plan. But it certainly was part of President Trump's thinking at the time. So I guess
there are a lot of things part of President Trump's thinking. At one point, it felt like he was clutching for straws and, kind of brought up everything as the justification for this conflict.
Yeah, if you're CENTCOM, it's kind of, you do what the president tells you to do. But if he wants regime change, I don't care if it's in your business plan or your war plan or not. I'm not sure how that goes. So again, uncertainty here continues, and again, with the attacks overnight, we see it in the financial markets immediately. And I guess where we look first here is WTI crude oil, which is up, 7.5% here, almost $6 a barrel, back now to $85 a barrel. And again, we closed last night's trading below 80.
It's a reminder to the Fed policymakers who are meeting today that, you can't count out what's happening geopolitically when you're looking at inflation as they deliberate over what to do for, not just the Fed policy today, but going forward.
Yep, so we'll have to see. That's a volatile part of inflation. That's why they do it with energy. So keep an eye on that. This is Bloomberg.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Great piece of research coming out of Bloomberg Intelligence in Europe. How about this? Europe needs to spend about 14 trillion euros on power, defense, technology, and critical sectors after a long period in which it benefited from cheap Russian energy, readily available American security, and low-cost Chinese goods. That's a big number. Let's check in with Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence. Tim, that's a big number. What are you and the BI analysts over in London, how are you guys approaching that?
So, Paul, it's interesting. You take a step back and you think along the lines of what you set this up. Europe's stuck in the middle, or it's between a rock and a hard place, or whatever cliche you want to use, whether it's geopolitics, whether it's economics, security, energy, etc., between the growing U.S. dominance, a competitive threat coming from China, and what we set out as a task is it's hard to think about Europe being totally self-sufficient or autonomous, if you want to think about it, self-reliant. But how far could we go over the next 10 years, and what would it cost in terms of investment to make this happen? And not from a top-down macro perspective. That's been done. Mario Draghi had a great report a couple of years ago setting out a trajectory or a goal. But this is bottom up, industry by industry, what legitimately can be done if the money is spent. And that's how we came up with that 14 trillion euro number.
Putting aside where the $14 trillion is going to come from for a moment here, which parts of Europe stand to benefit the most? Which specific industries, which specific companies for that matter?
Yeah, so, we certainly get into that in this report. I think there are a couple of key areas. Number one, certainly defense is high on everybody's radar screen, no pun intended. Whether it's Rheinmetall, BAE Systems, Saab, those are all defense contractors that if Europe can do a common coordinated plan and not be too nationalistic country by country, then there can be more of a very big sum that needs to be spent. The target is 3.5% of everybody's GDP to drive more Europe-reliant defense. And that's an example. We can go through energy, where the focus is more on building out renewable energy. Think about RWE as a case in point. Continuing to extend oil and gas production as much as possible in the North Sea. That would be a company like Equinor. Or renewable power, and here you've got Vestas in the wind area. So think defense, think energy. The other big area, I think, is in industrials. Not only Europe needs its own energy and electricity power supply, but it's a global growth business as well. And Europe is actually quite strong in that area. Think Schneider Electric, Siemens, ABB are all really big in that area. There's other spaces, but those are three big topics.
In terms of paying for it, i.e. the 3.5% of GDP, I think, when I've spoken to some folks, they've kind of feel like, all right, Germany can get there. Poland is probably incented to get there given their proximity to Russia and their history with Russia. But boy, outside of those two, Spain, Italy, Portugal, what are those guys going to do?
So it's interesting, Paul. Poland actually is above 4% already. Okay. To note that they are at the sharp end of that spear. Yep. The 14 trillion certainly is well beyond the 750 billion euros a year in defense. There's a big chunk in technology, in defense, in energy, in various other critical inputs that come up to the 14 trillion. And importantly, it cannot rely purely on government financing. This isn't look for, some federal or pan-regional government to start ponying up. There is no budget for it. This has to be some element of private company, corporation investment, along with government incentive, policy incentives. Interesting, we get into this in the report as well. There's 11 trillion euros of deposits sitting around in people's bank accounts. Europe is not very forward when it comes to risk investment. Most people's biggest chunk of savings across many European countries is in bank deposits. So if that can be marshaled with more coordinated, open, unified markets across Europe, so it's not 20 plus individual markets, it's one uniform common market when it comes to putting forward risk capital, that's a big source of potential private investment that can be steered into profitable investment that can then generate growth. The economists in the report also have a really interesting chart looking at the current trajectory of divergence versus the U.S., which is really daunting, and how it can turn into convergence. So a lot of opportunity.
All right, Tim, great stuff. Great report. Check it out on the Bloomberg Terminal. Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence. Europe needs $14 trillion reset to build power, defense, technology. Check it out on the Bloomberg Terminal. For our listeners in the U.S., a reminder, you can listen to us on satellite radio on Sirius XM Channel 121. Access the world's only global audio business and network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business App.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and John Tucker. We have the Fed decision coming out at 2 p.m. later today. We're going to get into all of that. We're going to talk about earnings as well. On the agenda for this hour, Andrea Felstead, our Bloomberg Opinion columnist, will talk to us about how Hermes and Kering, the owner of Gucci, are moving in opposite directions, divergent paths for these luxury goods companies. Visa reported results, so we're going to check in with Diksha Gera, our global fintech and payments analyst. Brian Whalen is, going to provide our regular check-in on the fixed income markets, especially with big tech issuing a ton of debt. He's the CIO and generalist portfolio manager at TCW's fixed income group. Craig Trudell, who covers our global autos sector, will look at Ford and BMW's latest news. Ford, of course, coming out with the results. BMW firing 8,000 workers. And Danielle Booth, she is formerly with the Dallas Fed, will join us to preview that Fed decision coming up later today. But first, let's get to John Tucker with your Bloomberg Business Flash.
All right, Scarlett, thanks. Sinking technology stocks dragging Wall Street lower again. This comes ahead of the Federal Reserve decision, 2 o'clock today. Energy, best performing major industry group in the S&P 500 as oil pushes higher. Then you have the information technology, materials, and industrials, worst performing major industry groups in the S&P 500. The Philadelphia Stock Exchange Semiconductor Index down today. It is down right now close to 3%. What did you say earlier? Since it's
26%.
26%, well, almost 27%.
Yep.
And that was the high only in mid-June. So that's quite a fall there. Anyway, helping to limit the stock market losses today. Apple, you'll recall they got a lot of grief earlier this year for not investing that much in AI. Maybe they look like They look like a bunch of geniuses. Shares up 0.2%. Yeah, they're in the $5 trillion club, only the second company to be in that stratosphere. Meta and Microsoft, of course, reporting after the close, and Morgan Stanley's Mike Wilson says spending on AI will, yes, be the key.
The market has been sending a very direct signal to the hyperscalers, and that is, if you spend more money, your stock is going down.
Right now, the S&P 500, 53 points lower, down 0.7%, 73.75 of the index. The Dow down 800 points, a decline of 1.5%. And the NASDAQ 100, 270 points lower, that is down just about 1%. And yet another reason for me to be annoyed. DoorDash gaining the necessary approvals to operate their own drones. The company gaining the, I don't know what it's called, Part 135 air carrier certification from the FAA to commercially operate a drone delivery service. So DoorDash plans to launch the drone deliveries in the fall. So
I'm still waiting for the Amazon drones that Jeff Bezos was talking about.
It's not going to be
I only saw them on commercials. I never saw them in person.
Yeah, me neither.
They'll be crashing into my house at 2 a.m.
Hold on. Didn't New Jersey have a whole issue with drones?
Supposedly. Never.
No, you're talking about like a couple of, was it last year?
Yeah.
People would spot drones
Yes.
in the middle of the night
Yes.
over New Jersey.
Right.
And like,
your neck of the
were
woods.
the UFOs?
Right. Now we're going to add DoorDash drones to that?
Yes.
Anyway, well, at least they'll be carrying like pizza, so that's good.
So they're welcome drones, friendly drones.
Not in my house. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live at Bloomberg.com as well. As John was just reporting, we got some selling out there, folks. Let's take a look at some of the stocks that are on the move. We do that with Christine Aquino. She's in our studio. Christine, what are you looking at this hour?
All right, Paul, let's take a look at Ford. That is not being sold today. It's actually gaining. So ticker F, and those shares are up more than 4% at the moment, pairing some of its opening gains, but still a healthy clip. And of course, we know that they had second quarter earnings out earlier. Ford raised its profit outlook for the second time this year, thanks to consumers continuing to buy its high margin SUVs. Adjusted EPS was given guidance at 42 cents versus 36 cents, which was the estimate. And then they also upgraded their EBIT guidance for this year to $11 billion from $8.5 to $10.5 billion previously. Now, the company, as we know, is also investing in a new energy storage business, and they're also going to overhaul its electric vehicle strategy to focus on less expensive models. A lot of interest in that new energy storage business, of course, because it relates to being able to supply power for all of this data center AI-driven demand. But investors, of course, wondering whether that's going to be a sustainable revenue stream for Ford. So keep an eye out for that.
I tell you, Ford is doing the right thing. We're just focusing on profits. Where do we make our profits? Trucks and SUVs. If you want to go electric, you can go electric. Our responsibility is to our shareholders.
Where do you go for electric then? You go to Tesla with their old stale lineup?
I mean, they'll still have, everybody's going to have some. But you're just scaling it back because they're not getting paid for it. I totally agree with their strategy.
All right, next stock.
All right, let's take a look at Caterpillar. Yes, CAT, so ticker CAT. That is not doing too well. It's actually extending opening declines down now more than 5%. And that is because we did get a downgrade from Baird. Analysts there cutting the recommendation to neutral from outperform previously. And they also cut the price target to 900 from a previous recommendation of 1,200. And currently it's trading around 791. So analysts are citing a growing trend of state and local government actions targeting data centers, and the analysts are potentially saying that that could impact future orders and backlog progression, and it really just could be a limiting factor for growth that could contribute to Caterpillar's future outlook. And so, yeah, not looking very optimistic there in terms of data center regulation and the implications for a company like Caterpillar.
And Skyworks?
Skyworks. So Skyworks, ticker SWKS, they are a semiconductor device company. We know that they're a supplier to Apple. They actually derive 67% of their revenue from Apple. We got their fourth quarter earnings today. That's not looking too hot, and so the shares are down now just over 2%, bearing some of those opening declines that we saw earlier. And that is primarily because of a weaker than expected outlook for the fourth quarter. Bloomberg Intelligence weighing in and saying that, there are a lot of headwinds for handset makers because of rising memory prices and also constrained supply, and that really could limit significant upside for Skyworks in the second half of this year.
All right, Christina Aquino, thank you so much. Christina Aquino with our Stock Movers Reports. Listen for 5-minute audio reports on the biggest and winners and losers in the stock market when you subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. It's all about earnings, and I know that we've got a whole slew of big tech earnings today and tomorrow, but over in Europe, they're focusing on their leading industry, which is luxury. And the luxury guys are kind of going in different directions these days.
Yeah, Hermes and the Gucci folks over there at Kering, I don't think there's a read-through there. I don't know.
Yeah, it certainly says something about China. It certainly says something about inflation. Let's bring in Andrea Felstead. She's our Bloomberg opinion columnist, writing on both. Andrea, just give us an overview here. We had heard from LVMH. Now we're hearing from Hermes and Kering, and I think I mispronounced Hermes because...
No, that's how I go.
Is that how you go? Not Hermes.
In any Hermes case, is Federated Hermes in Pittsburgh.
Okay, thank you.
Yes.
This is a dumb American question. Anyway, yes. Andrea, walk us through how the tide seems to be turning here for Hermes and Kering. They're going in different directions than they were before.
Absolutely. So Hermes seems to have spooked the market by talking about China and saying that China has stabilized, but it's not yet recovered. And I mean, this isn't really that different from what everyone else has been saying. But he talked, the CEO Axel Dumas talked about the pork price, and he said that obviously we know about the property market, but he said the pork price is low, and so that's an indication of less confidence. So the market's really taken this badly. I'm worried about Hermes. Now, at the same time, on the backdrop of Hermes, you've also just had this sense that the Birkin, the Kelly aren't quite as hot as they used to be. Chanel has got a new design, and he's been bringing out some bags that are really, really in demand. So the Hermes and the Birkin and the Kelly, typically you can't just go into a store and buy one. You have to put your name on a wait list. There's all sort of, hurdles that you get one or not. And so most people buy them in the secondary market where they cost more. And the premium to the retail price has been falling. So that's seen as maybe not a great thing for Hermes. But what's the other thing that's happened in the last few weeks is that all the footballers have been carrying these, giant Hermes bags, the giant Birkins, the hack, which isn't a Birkin but looks very much like a Birkin, and I really do think that's actually given Hermes a new lease of life, because the Birkin was looking a bit tired, and suddenly you've got Erling Haaland carrying his giant Hermes bag, and I think it has helped them, but obviously that's not going to come through in these numbers.
Andrea, just so you know, in this radio studio, we are not buying that pork as a leading indicator issue.
Okay.
We're just not buying it. But
wait, I bought it.
So, Andrea, what do we know about the geographic element here? Are certain parts of the world doing better than others?
Absolutely. The US is really, really on fire when it comes to luxury. The stock market wealth, up to now anyway, the AI wealth, the US demand is very correlated with a stock market performance. Now, what is really interesting is that the people that are enjoying all this wealth, it's natural when you get a big windfall, you want to treat yourself. And that seems to favor like watches and jewelry rather than a handbag. Maybe you want something that lasts, you want a memento of this, of this wonderful windfall. It's really helping jewelry rather than leather goods. And that's a problem because obviously for brands like LVMH, Kering, although LVMH has Tiffany, and it really, its bread and butter is leather goods. So, and they're very profitable. So you really want handbags to come back. But the fact that the US is doing well, that's making up for the shortfall while China's sort of in the doldrums.
Very quickly before we let you go, Andrea, when LVMH reported results, it was really the U.S. that was the bright spot. Is that the same for Hermes and Kering?
Absolutely. It's been right across the board, with the jewelers really shining the brightest.
Very, very good, Andrea. Thank you so much for joining us. Always appreciate getting a few minutes of your time. Andrea Felsted, she's a columnist for Bloomberg Opinion, joining us from London here. Staying on the earnings beat, Visa, our good friends at Visa, they beat estimates, but they took a $563 million charge on job cuts there. Let's get the latest on what's going on with Visa. Diksha Gera, Bloomberg Intelligence Global FinTech and Payments Analyst, joins us here. So what's the takeaway from Visa from your perspective, Diksha?
Yeah, hi there. Nice to be here again. I think it was a good set of numbers, modest beat on both top line and bottom line for the fiscal third quarter for Visa. Adjusted EPS was about 2.7% ahead of estimates. But I think what was really notable is all the underlying trends were pretty resilient. So 18% volume gains, 34% services revenue gain. I think, and all of that puts Visa in a very comfortable spot to basically meet their raised full year 2026 guidance, which they have raised to low end of mid-teens for EPS growth. I think what I'd highlight is it really was firing all engines. Value-added services was $3.8 billion revenue in third quarter, and Visa Direct, which is their consumer direct point-to-point money flows, their transactions climbed 21%, and new use cases and partnerships are kind of key tailwinds there. Sorry, one thing if I'd be remiss to not point out is the World Cup. It did really well for Visa's third quarter numbers, and management cited very strong volume gains across all categories. So all the US host cities, total card present spend accelerated, transactions were up 20%. You have to understand, like when people are visiting, and this is all cross-border spend, which is some of the most lucrative or higher margin business for the card network. Tap to pay transactions where people are going and using transit, so you just tap your card and move on. Your entertainment, your restaurant spend, all of that got a nice kicker. And the banks launched a lot of programs along as well to kind of bring in more consumers who were traveling for the World Cup.
Diksha, this is a dumb question, but are those buy now, pay later companies like Klarna competition for Visa? Are they friends or foes?
So here's how I put it, Scarlett. When I was covering banks, I actually thought the card networks are done with just because of all the alternative payment rails that were coming, direct fund, like bank-to-bank transfers were happening, and now BNPL is kind of growing. But if you pay attention, all the buy now, pay later companies, and I cover the sector, their best-selling product is actually a card. So the card networks have very beautifully managed to embed themselves into the buy now, pay later ecosystem as well. So while you go to an Amazon.com and spend on, say, a firm there, Affirm is now giving you a card that you can go and swipe at a restaurant for your buy now, pay later product.
So I'm looking at these stocks, Diksha, Visa, MasterCard, Affirm. I mean, on a trailing 12-month basis, they're all kind of flattish. What's the story in the payment space here?
I think the sector overall is beaten down overall. And I think if you just look at the card networks, they're somewhere in the middle of that range. The B2B processors are the worst hit. But I think the overall sector has kind of been doing poorly in that regard. That said, Visa and MasterCard are steady as they go. Like these are the most resilient, solid cash flow businesses along the sector that I cover. One thing, Paul, I would highlight though, and we've been getting a lot of questions around that, is the 7% job cuts that Visa announced yesterday. Yep. And people are like, is that a distress signal? Like what's going on? They're doing well, then why are they kind of letting people go? I would highlight that that's not Visa in distress. I would read it as modern corporate portfolio management.
Got it.
Visa's portfolio workforce actually tripled over the last decade. And what CEO Ryan McInerney is doing today, he's trimming product overhead and monetizing their AI investments.
All right, very good. Diksha, thank you so much. Appreciate it. As always, Diksha Guerra, Senior FinTech and Payments Analyst at Bloomberg Intelligence. She's based out there in San Francisco. Remember, folks, a lot of earnings after the close today. And for those tech earnings this afternoon, Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. Participate in our wall-to-wall coverage of earnings today at 4 p.m. Eastern Time by submitting questions for our analysts and experts to answer live on air. Subscribers can go to Bloomberg.com/AskRadio to send in questions. Then listen on Bloomberg Radio and watch on Bloomberg Originals and YouTube at 4 p.m. Eastern. So lots of good stuff going on there. We got some smart people. You can ask them questions directly, and they'll do their best to answer.
I got questions.
Oh, yeah, I got questions.
Not about this.
Man deep, I got a lot of questions for that fella.
Don't filter you out, John Tucker.
Exactly. We've got I think the kids say block. We'll block John Tucker.
Right.
More coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Ahead of the Fed decision this afternoon and ahead of the earnings from Microsoft and Meta Platforms after the close, the major averages, they are lower right now. S&P 500, 59 points lower. That's down 0.8%. 7370 on the index. The Dow is down 818 points. That's a decline of 1.5%. The Nasdaq 100, 341 points lower. That is down 1.2%. Of course, with the earnings, CapEx is going to be one of the big focuses, especially for Meta. You can argue, actually, Paul, that I guess Alphabet set the tone when they reported.
Yes.
They had what, negative free cash flow.
Yep.
Some analysts are saying that they expect Microsoft possibly to have negative free cash flow later this year, I guess the fourth quarter. As we look at yields right now, the more policy reactive 2-year is up 3 basis points, 432. Less to do with the Fed decision at 2 o'clock, but probably more reflective of oil. Brent right now up 672 a barrel at $90.81. No AI here, at least I don't think so. Cheesecake Factory, ticker symbol CAKE, up 11%. The restaurant company reporting better than expected traffic growth, raising the full year forecast. Best performing stock in the S&P 500, Garmin, an all-time high, up 17%. So they make the the GPS-enabled products, and
All most cars have GPS, and don't you have Google Maps? And I don't understand that.
They make up other stuff connected to that, but the earnings per share guidance for the full year, they lifted that. Since you bring it up, I'll geek out. With GPS and Garmin, anybody using GPS, with the satellites, you have to take into account Einstein's space-time.
Oh, no.
Because satellites in space, they operate on a different time.
No.
Time speeds up in space.
Space-time continuum, sure. Okay.
As opposed to Earth. No, it's exactly the clocks tick faster in space.
All right.
So we age more slowly.
I just keep daylight savings time. That's all I want.
We check the markets for you all day long, no bites. Right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Scarlett and Ball.
All right, John, thanks so much. Appreciate it. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well today. All right, it is Fed Day today. That Bloomberg coverage starts on Bloomberg Radio and TV at 1:30 p.m. Wall Street time. Tom Keene and the surveillance team will bring all that to you. The statement at 2 o'clock, the press conference at 2:30, all that kind of, if there is a press conference, I don't know. Brian Whalen joins us. He'll be paying attention. Why? Because he's the Chief Investment Officer at Fixed Income at TCW, based out there in L.A. Brian, a lot of folks are saying this is going to be kind of a unique, a little bit different Fed day here and press conference. We're just not sure what we're going to get from the Fed in terms of decision and in terms of commentary. How are you guys reading it?
Yeah, I'd say the market's more uncertain about this one than it's been in a long time. We've obviously had a change in the leadership at the Fed, and in June, Warsh came out, came a little bit more hawkish than the market was expecting. Obviously, we've had this conflict going on for the better part of the year. Oil prices are bopping around here. People are concerned about pass-through to kind of broader, inflation metrics, although we haven't seen that to date. So, our view is that more likely than not, they're not going to go. We don't see any real kind of fundamental justification for it, just going based upon what they said last June. And ever since then, we've had 2 inflation reports that have kind of come in much lower than feared. We had a softer labor market data come out in early July. And so, the only reason we could see them going today would be that, if Warsh wants to continue to kind of, beef up his anti-inflation fighting credentials. But, given we're only a few months away from the November election, and what we think is kind of a dove in hawk's clothing with regards to Warsh, we expect they're not going to do a thing today.
Explain what you mean by that, a dove in hawk's clothing. What does that mean in terms of how he expresses himself when he chooses to the market?
Sure. Yeah, he look, let's go back to, when the market was underwriting a whole bunch of candidates, including Warsh, and, he's been pretty public about his thoughts that, long-term productivity gains from AI should pull down on inflation metrics. He's talked about the necessity of central bankers to look through supply disruptions, particularly in energy, and it's what we have at the moment. He's been vocal about, over the long term, wanting a smaller balance sheet, which is restrictive in nature, which means he's also, supportive of lower interest rates. So that's who we have. So I think over the long term, he expects, our interpretation of what he believes, he expects the data to support, inflation continuing to come back down toward 2% or below. And if so, he probably views interest rates at their current level as moderately restrictive. That said, he was the new guy, the new chairman coming in June, and at that point in time, over the course of the 4 to 5 months, the market went from expecting 2 cuts from the Fed to almost 2 hikes. And so we came to that podium for the first time. The market was already expecting hikes, and so it was kind of a free option for him to kind of stay up and just kind of reiterate what the market expected. And then he got good press for that. He kind of earned a lot of credibility. And he also did it without, disappointing the market. So if we're Warsh and we think what his mindset is like, if I believe the data will support no hikes and maybe cuts in the future, I'm just going to sit back. We'll let the data play out. And if it reiterates what I expect, then we won't hike and maybe we'll cut down the road. If not, we can pivot.
Brian, I also want to get your take on credit because there's definitely been some more nervousness on the equity side. Investors are noticeably less patient in July 2026 than previous earnings seasons as companies announce their CapEx plans. When it comes to issuance, demand is starting to slow down. Bubble concerns are growing, and it feels like issuances are now becoming harder and more expensive to get completed. Is this the beginning of a real sea change? I mean, are we going to see spreads widen out a lot more than where we are now?
Yeah, look, the bond market, the corporate bond market in particular, the phrase channeling Roberto Duran, for those who remember, no mas. There is just so much supply coming to the market. It can't handle it. I just heard, the prior conversation was about, cash flow at the big hyperscalers going from a positive $250 billion a year to now negative. And it's just inundating and flooding the corporate bond market with so much supply. And at first, in the beginning part of the year, was able to handle it. These were high quality issuers with fortress balance sheets, and the market wanted to kind of put that money to work, but it can only take so much. And the interesting dynamic here is that you're getting issuance from companies who, they believe in this AI story and the long-term growth prospects. And, they're thinking in terms of their equity valuation, sort of multiples of value of where it is today. And so they turn around to the debt markets where they're looking to fund, up to almost $300 billion year to date. And that's only going to grow, and we'll continue to see it probably grow in 2027. Whether it's an extra 25, 50, or even 100 basis points in financing costs on a $20 billion transaction, I don't want to say they don't care, but they are certainly far less sensitive to that increase in borrowing costs than what we're used to seeing in the corporate bond market. So it's an interesting dynamic. It's going to weigh on the market for the rest of the year. And if what I would add in there, and that's only, we're just talking technical, supply, demand, wider yields, wider spreads, et cetera. If this kind of AI story hits a speed bump or takes a turn the market's not expecting, like maybe there's less compute, maybe there's social pressure because of the job loss, whatever the twists and turns may be, if you have a fundamental disruption on top of the supply kind of overhang, that could really cause a kind of a repricing and increased volatility across the entire corporate bond market, as well as the equity markets.
Brian, thanks so much. Always appreciate a few minutes of your time. Well, if I'm a fixed income salesperson on Wall Street, I'm not sure I want to call Brian Whalen. He's a tough call, I think. You can't get any BS behind him.
I know, he tells it like it is.
I know. Brian Whalen, Chief Investment Officer, Fixed Income, TCW. I don't think he takes any salesperson's calls anymore. Switch gears, get back to the earnings front. Ford, stock's up 5.7% today. Some good numbers here. Let's break it down with Craig Trudell, Bloomberg Managing Editor, Global Business Coverage. First question, why aren't you in London? Did you come back here?
I'm back.
Oh, okay.
I'm
Very
back.
good. Very good. Good. Okay, talk to us about Ford here. The stock is higher today.
Yeah, Ford and GM really consistent across several fronts. I think the fact that SUVs and pickups have been so strong in this market, the fact that the Trump administration has so relaxed emissions standards and fuel economy rules, they're really able to sort of go whole hog and sell as many SUVs and pickups as they possibly can, and that does a heck of a deals a sort of heck of a boost to their bottom line.
What surprised you the most when you look at Ford and GM and what they've managed to show as they double down on what works?
Yeah, I think the execution has been strong. I think they have been trying to sort of pivot in a way that has to be really dramatic, considering the degree of change from one administration to the next. The fact that the Biden administration wanted these companies to sell a heck of a lot more electric vehicles, and they built the plants to do so. They not only built the car factories to do so, but the battery plants. And Ford has been trying to sort of, make lemonade out of lemon in the fact that Americans were not ready to buy electric vehicles at the rate everybody was hoping for. And both of these companies are trying to sort of maybe turn some of these battery plants into factories that can actually make sort of storage units, which we've seen Tesla turn that into a tidy little business. So I think there's still some sort of show there that we need, instead of just tell that they're going to be able to make that transition. But that's going to be something that we're going to watch in the months and maybe even years to come.
I mean, if I'm Ford and GM, I think I have to. This is just kind of opinion. I think my strategy's got to be maximize shareholder value. The way I do that is making pickup trucks and SUVs. And my EV strategy has got to be driven by the marketplace as opposed to policy. If that's the case, I'm not sure we're ever going to get to a big EV percentage in this country. How are they thinking about it?
Yeah, I mean, I do think it's interesting that you still do hear Mary Barra, say that she thinks that electric vehicles and batteries are just the better powertrain. And I think, candidly, if you sort of drive, in my experience, if you drive, the same vehicle, one with a battery in it and the other with a combustion engine in it, it's actually a lot of fun to drive an electric vehicle. The instant torque and the sort of, get up is actually pretty great. And I think avoiding, the gas pump right now is also a big positive. So I think they're really stuck in the situation of a lot of consumers still not being ready for this transition. And yet there is this sort of looming question over, is the rest of the world going to make this change more successfully? And will they be left behind if they don't figure this out eventually?
You just mentioned you moved back from London. I mean, looking at the cars on the road, it must be kind of a shock just to see the transition back to gas-guzzling SUVs everywhere.
I mean, the vehicles here, I grew up in Michigan, I've been around these companies a long time. Vehicles have always been much bigger here, but it is a sort of shock to the system to see just how big, even as someone who's covered this industry a long time, man, these pickups keep getting bigger. And I think it is also amazing for people who, go from here to London. What I hear from people, who do travel to Europe is, man, look at all of these Chinese EVs, crawling the streets of Europe and around London.
I know. It's us and the rest of the world. I don't know how it's going to play out. In
Parallel tracks.
Yes, exactly right. All right, Craig Trudell, thanks so much. Appreciate it. He's back in the States, everybody, for better or worse. The product of Michigan State University. How about that? This is good.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash on a day when the major averages lower again. S&P 500, 64 points lower. That's down 0.9%, 73.62 in the index. Dow Jones Industrial Average down 845 points. That is a decline of 1.6%. The NASDAQ 100, 375 points lower, a decline of 1.4%. As the war escalates again, oil pushing higher, Brent crude above $90 a barrel. Energy, the best performing industry group in the S&P 500. Two-year yield ahead of the Fed meeting today, up 3 basis points. That actually has more to do with inflation concerns related to oil, I suspect. 432 right now on the 2-year. The Philadelphia Stock Exchange Semiconductor Index down again, down over 3%. And as we've been telling you, Meta and Microsoft opened their books to investors after the close of regular trading today. Spending on AI going to be a major focus. Dan Suzuki at iCapital says investors expecting quite a bit from the hyperscaler earnings.
And I think the way to think about it now is the bar is set so high. The new beat is call it a 10% beat on earnings and a lower capex guidance. I think that's the thing that's going to get stocks to rally.
Okay, I'll do this one time, and this is like, I want to be done with Cracker Barrel this quarter, but Cracker Barrel, and this is serious actually, they're going to continue to cover security for the outgoing CEO, Julie Masino, for an undetermined stretch of time after she exits August 10th.
She was literally chased out of that job because of her attempts to, change up the logo, refresh it?
Yeah, well, it's a pretty rare move, but comments over the company's botched image redesign. So that's still reverberating with some, I guess, crazies out there.
I mean, they scrapped that. They're back to the original one.
Yep.
Yeah.
So the people won.
Well, she's still apparently getting threats, which is pretty serious.
It's not bothering her.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, John Tucker, with our Bloomberg Business Flash. We have the Fed meeting today. It began yesterday, but the decision coming out at 2 p.m. starting at 1:30 p.m. Bloomberg Radio and Bloomberg Television will bring you the Fed Decides, hosted by Tom Keene and their surveillance crew. So be sure to tune in for that. But ahead of that, we want to welcome in Danielle DiMartino Booth. She is one of our regular guests on these Fed days, CEO and Chief Strategist at QI Research, formerly with the Dallas Fed. And it's all going to be about what Kevin Warsh says and does, because he has brought in a new regime and he is not big on tipping his hand on how he's thinking. He doesn't really want to provide forward guidance. He doesn't want to include a dot. He claims to be about surprises. Do you think he will deliver one?
Well, he keeps talking about these good family fights. I mean, you would think that, think about Thanksgiving Day, bad family fights and badly, the uncle leaves early, but a good family fight should end well, right? So if a good family fight is ending well, then we won't see any dissents. And we're not going to see any dissents if there's a rate hike. We will see dissents if there is.
Interesting. So, I don't know, we just had, pretty big bond investor on right before you saying he thinks they're going to hold steady here today. But the market's pricing in pretty decent odds that there will be a hike. I mean, what do the fundamentals tell you, I guess?
I mean, look at Procter & Gamble. Look at waste management. I mean, waste volumes have a almost perfect correlation with GDP growth, and they fell yesterday when they reported. So we're not seeing any kind of pickup. Apartment concessions are at the highest on record, according to Zillow. So we're not really seeing the pass through to the core that would suggest that these energy prices are filtering down, and part of it's just a lack of purchasing power on the part of U.S. households, which they demonstrate one earnings report after another after another. But again, if you're talking about the element of surprise, there was a 50 basis point hike during Powell's tenure. And the weekend before that surprise hike, word leaked in the media that something big was coming. So at least the bond market was not absolutely shocked. But at least it got probability north of 50%. And that was kind of the new line in the sand, if you will, that 50% line. It used to have to be above 2/3 probability. And then Powell kind of lowered it to 50%, Now you're talking about possibly lowering it to 36%. But again, breaking the mold of if markets are expecting it, they'd better price in 50% or more. If he doesn't care about how markets are interpreting Fed policy, then he won't be sitting there staring at the probability for a rate hike on his Bloomberg terminal.
Are you one of the folks that believe that he needs to cut rates in order to fortify his inflation-fighting credibility?
Hike rates?
Yeah.
No, but again, I think that that's somewhat irrelevant right now. The bond market has fully priced in a rate hike. He doesn't really get penalized for hiking rates today because the bond market's done all the heavy lifting for him in advance.
Is that what he wants?
I don't know if it's what he wants. Again, what he wants is for the market to interpret the data, not for the market to interpret how Fed officials interpret the data. So he wants bond traders to grow up. I don't think bond traders want to grow up at all, and that's why they're hanging on every single word, whether it's Lori Logan or Christopher Waller, every single word that every voter is saying they're hanging on to for dear life. But I don't think Worse cares.
I mean, again, the market, you say the market's done the work for it. I think it seems absolutely correct. I mean, the 10-year 464. I mean,
yeah.
we're there. I mean,
the danger is if he goes nuclear,
okay,
and goes 50 basis points or something, and immediately slams the 2's 10 yield curve into inversion. On the other hand, if you want to set up the Fed for an easing cycle and not say boo about it, when he was in Portugal recently, he said, we have the dot plot for now. Are we going to have a dot plot in September? He's not going to tell us one way or another.
Task force.
There's a task force for that. So if I wanted to shock the markets and set the markets up for an easing cycle headed into the midterm elections, today's your day.
Okay. All right. So what will you be listening for when he speaks? There are some who believe that this news conference, he's holding one, and there were questions about that a few weeks earlier, won't last very long.
I don't think it will last very long, but I will be actually, for a change, paying attention to the statement, because I'm going to want to see if there's a quid pro quo. If there's a rate hike today to make sure that the good family fight ends well, no dissents, unanimous decision, what's the quid pro quo? Does he get something on the balance sheet side? Is there something unexpected? Are the regional Fed bank presidents going to come out and make hawkish because they don't have a vote about the discount rate? I'm going to be looking at the statement today for the first time in a long time, because his baby is that balance sheet. And I know there's a task force for that too. I have great respect for Jeremy Stein. He's picked the right people, put the right people in the right place, Mervyn King, communications, et cetera.
But that's his priority, you're saying?
That the balance sheet's his priority.
What do you think he wants to do with the balance sheet?
I think he wants to make sure we never cross the Rubicon again of buying mortgage-backed securities, given the damage that it's done to the housing market, not once but twice. And there's, again, if you're talking about the element of surprise, why don't you just say, we're going to accelerate the roll-off of mortgage-backed securities, and we'll roll it into treasuries. Fine.
That's quantitative tightening, isn't it?
No, not if they roll it into treasuries.
Okay.
So they're holding the size of the balance sheet steady. They're not changing that aspect.
Just moving into something else.
Just delivering a message to markets. If you expect for us to buy mortgage securities the next time, and then corporate bonds the next time, and then the ultimate equities, he's saying, no, I'm moving the line back. We're just, if and when we're forced into a state of QE, it's going to be treasuries, and or treasuries.
All right, there we go. I might even pay attention on the train. Put down the movie I'm watching at 2 o'clock and pay attention.
Well, it might just be like a 15-20 minute news conference, so you don't have to pay attention for long.
All right, very good. Danielle DiMartino Booth, she'll be paying attention. She's the CEO and Chief Strategist at QI Research. We appreciate her coming into our studio. She is based down in Dallas, so we appreciate the effort, and particularly on these Fed days. I think this market's looking a little tepid right here.
Yeah.
The S&P's down 0.8%. The Dow off 820 points, 1.56%. I remember when 820 points meant something. for this market. The NASDAQ down 286 points. That's 1.1%.
You have oil prices higher, so it follows that energy stocks are the group that's rising the most, up 2.5%. Then you've got consumer staples and healthcare in the green as well, so some defensiveness in equities.
Very good. More coming up. This is Bloomberg.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube as well. Okay, the World Cup is over. I think it was a fantastic World Cup. I think everybody was generally pretty happy. The fans seemed to be happy. The games were good. We had a great finals there. I don't know. I tell you, it's important for a lot of companies out there, none more important than Nike and Adidas. And let's break that down. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence. Poonam, just kind of scope out for us for the big name brands that were really associated with this, Nike and Adidas. Talk to us about what it means for them.
Yeah, so for both of them, the World Cup is a real big deal because it allows them to come front and center with their fans and consumers alike. So when you think about who has the ball, who has the kits, who has the teams, it matters. So when we got to the finals, Adidas had the win already, right? Because both teams were sponsored or wearing Adidas gear. So at the end of it, who won the World Cup? It's Adidas of the athleisure names, and that's great brand heat for them. In fact, they came out saying that they had expected in euros $1 billion from the World Cup kit sales and jerseys, etc., and they topped that by 50%. So 1.5 billion euros is what now the number is for the momentum they got from the World Cup on just kits and jerseys and gear ahead of it.
Yeah, I mean, we had so many games here in the New York metro area. that all throughout the city, throughout the tournament here, there were jerseys all over the place, and people were really into it. So, do these companies, do they break out how big soccer is for them amongst all their the sports that they are involved with?
I wish I did, but or they did, but they don't. And we don't know by sport how big it is, but just as you can imagine, when you think about the world of sports, soccer is one of the largest watched and played sports in the world. So it definitely does build momentum in terms of their sales, whether it's the cleats, whether it's the apparel, the jerseys, etc. The players they sponsor matter. Messi being in the game for Adidas was a big deal. Mbappe for Nike in the top 5 running was a big deal. And these players also against the teams that they sponsor really do raise visibility for them and get to draw traffic into their stores and their brands.
Do we have a sense of if Adidas wants to sponsor, Spain or an Argentina, what that costs them? Do we know that kind of number?
So those contracts vary and they change. And clearly, with Spain having won the World Cup, the price tag goes up once the contracts are up for renewal. Right now, what I can tell you is the soccer ball, which Adidas has owned in the World Cup for the last, I believe, 25 years, is now being likely taken over by Nike in 2027, 2028.
Okay.
So it does. So things do change when contracts expire, but for many of the teams, for many of the players, they do have various lengths of contracts and prices do vary.
How about for Nike, an American company? How did they fare in the world of global football?
It would have been nice to see Nike versus Adidas in the final, I must say, but that wasn't the case. They still did well. They were up in 3rd place, so I think they do still gain the brand visibility. In fact, some data sources that we look at, Nike was the top searched kit through April through June, with the USA averaging more than 14,000 weekly searches. So we do think that even though Nike didn't win the World Cup, they were definitely in the running, and they were very visible across the board. And having Mbappe and winning 3rd, 4th place does still go a long way for them.
How about for a brand like Puma? It feels like they've kind of, at least here in the United States, a little bit of a lagging behind, say, the Nikes and the Adidas of the world. Talk to us about Puma.
Yeah, so Puma, they're definitely much smaller, right, when you think about them in the world of sports. And I think they didn't have as many teams as Nike and Adidas have, so they do lag in that front. But I think what worked out well for them on the World Cup was Morocco and Switzerland's quarterfinals, right? I think that really helped them gain visibility, and it did prove positive for them. They're missed a big turnaround right now at the brand, and they're really trying to find their place. Where does Puma sit relative to Adidas and Nike? And I think where they win is in the smaller sports that Adidas and Nike play in, but aren't as aggressive in. If you think about cricket, if you think about the F1, right? Those are sports where I think Puma has a larger leg up than Nike and Adidas, but they're smaller.
And these companies, they're not just sneaker companies. It's a whole athleisure thing, right? I mean, that's kind of where the market is now defined, or how the market's defined.
They're not sneaker companies. When you think about Adidas and Nike alike, yes, sneakers are where they probably get most of their visibility and their player lineups from, but apparel is an important piece of the business. It's growing, but when you think about Nike and Adidas, Nike wins in the footwear race, right? Nike's share is over 20% of the global footwear market. Adidas is around 12%, so almost double. But when you look at apparel, they're very comparable. Nike's about 10%, Adidas about 9%. So apparel is the opportunity for both of them to step up and really gain margin.
All right, Poonam, thanks so much. Appreciate it. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence, based down there in Princeton. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. It is Fed Day. Again, Bloomberg Surveillance, Tom Keene and the team will be on Bloomberg Radio and television, bringing you all the analysis. That starts at 1:30 p.m. Wall Street time. The statement comes out from the Fed at 2 p.m. and then the press conference it will be at 2:30. And Michael McKee, Bloomberg's Michael McKee, he's down there in D.C. He'll be ready covering that press conference for us. S&P down 69 points. That's 0.9%. The Dow off 855 points, 1.6%. And the NASDAQ off 313 points, 1.3% there. WTI crude oil up 7.2%, $85 a barrel. There you go. We'll have more coming up. This is Bloomberg.
From ABC News, I'm Michelle Franzen. Tense moments on Capitol Hill. Dr. Anthony Fauci appearing before a Senate hearing on the COVID response. That hearing, chaired by Republican Rand Paul, comes after Paul released hundreds of pages from Fauci's diary, which includes the COVID-19 pandemic. The former medical advisor to President Trump during his first term, also the lead of the White House coronavirus task force, and stayed on during the Biden administration. Fauci today invoking his Fifth Amendment rights. ABC's Jay O'Brien has more.
President Biden's preemptive pardon, in the words of the chairman of this panel, Rand Paul, who would be the one making any kind of criminal referral to the Justice Department, doesn't cover future actions. It only is retroactive from the date the pardon was issued. And Fauci seemed to acknowledge that as well. So what Fauci was saying in his opening statement there is he believes that Chairman Paul is bent on putting him, in Fauci's words, behind bars.
U.S. forces across the Middle East are on high alert following surprise attacks by Iran just days after a pause in fighting was announced by the White House. ABC's Rachel Scott has details.
Saudi Arabia under fire from Iranian-backed groups in the region, shooting down drones in the eastern part of the country. Overnight, the U.S. and Saudi Arabia retaliating, striking Iran-backed proxy groups in Iraq. The first time Saudi Arabia has carried out strikes in that country since the start of the war. And in the Red Sea, the Iranian-backed Houthi rebels in Yemen claim to have struck a Saudi oil tanker, threatening another critical waterway in the Middle East.
The Federal Reserve Board is wrapping up its two-day policy meeting today. Analysts say the ongoing war with Iran, now in its sixth month, and impact on oil and gas prices could factor in whether the board could raise interest rates. At least 13 people have died in Japan following yesterday's powerful earthquake, according to Japan's Prime Minister. Crews, meantime, continue to search through the rubble of a collapsed mall in the quake zone. You're listening to ABC News. The American Red Cross with an urgent appeal for blood donations.
We need people to step up. Matt Trotter is with the American Red Cross, which has declared a national blood supply emergency.
If 3 more people came to every Red Cross blood drive over the next month, we would be out of this crisis.
The nonprofit has been hit from both sides, a seasonal increase in demand for blood products and a precipitous decline in donors. Jim Ryan, ABC News.
Schools are now turning to drones to help combat active shooters. ABC's Sophie Flay has details.
The aircraft, called Campus Guardian Angel, can ram into a threat at 50 miles per hour. Mithril Defense, the company behind the drone, says they'll be stored at the schools so teachers can activate them during an emergency. But some parents are raising concerns.
They are operated remotely from Texas.
Critics also argue the drones could misidentify a threat, and they argue school resources should go towards preventing gun violence.
At least 9 schools in Florida, Georgia, and Colorado are now being equipped with those drones. A New York State school district that had planned to use a robot powered by artificial intelligence in the classroom is now putting that idea on hold. Parents and teachers cited concerns about how students' personal information would be used. The $60,000 robot named Sally is built by a company called Robotics, and it was supposed to be used as a teaching assistant. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Saudi Arabia enters the fight. Welcome to the Wednesday edition as the kingdom puts fighter jets in the air alongside the U.S. to strike back at Iranian-backed militias in Iraq. A pronounced escalation that is raising a lot of questions today about a wider war in the Middle East. Oil prices are up sharply as a result, and we'll discuss where we go next from here with Becca Wasser, defense analyst at Bloomberg Economics. Jay Clayton is confirmed to be the next director of national intelligence without a single Democratic vote. But President Trump's pick for attorney general could be running into the YOLO caucus, as we'll get into with our political panel, and later our conversation with John Bozella from the Alliance for Automotive Innovation on the impact of high gas prices and the effort to keep Chinese-made cars out of America. First, though, we turn to Wall Street, where we're getting clobbered today. Charlie Pellet has the latest from World Headquarters in New York. Charlie, what's going on?
What's going on? We're seeing major losses for the Dow, the S&P, and NASDAQ. We have got oil selling off, topics you're going to be touching on right here on Balance of Power. But traders gearing up for a 2 p.m. Fed decision. Stocks lower, oil is jumping. Market also bracing results from two of the biggest AI spenders after the close of trading. We will be hearing from both Meta Platforms and Microsoft. Meta right now down 1.1%, Microsoft up by 0.3%. But let's get right to the numbers here. Big numbers to the downside. S&P is lower by 1.1% now. S&P down 80 points at 73.47. Dow Industrials down 916 points on the Dow, a decline there of 1.7%. NASDAQ Composite down 358, drop there of 1.4%. The SOX, the Philadelphia Semiconductor Index, that is dropping now by 4.9%. We've got the VIX back above 20 and a 2-year on this Fed Wednesday, 4.33%, the 10-year 4.64%, and the 30-year 5.12%. Spot gold right around $4,000 the ounce, 4,010 now, down 0.5%. But the move in crude, WTI back at $85 a barrel, up 7.2%. Brent crude $90.72, higher by just about 7.9%. Bottom line here, we are awaiting the Federal Reserve decision coming up at 2 o'clock Wall Street time. Kevin Warsh's news conference, 2:30 p.m. We'll have it for you live here on Bloomberg. So what to expect today from the Fed? Sarah Malik is Chief Investment Officer at Nuveen Asset Management, and she was a guest this morning on Bloomberg Surveillance.
My view is that we do not get a hike today. We stay in the pause camp, and the Fed communication is going to be around what's happening with this five task force, and also that they're going to be depending on incoming data in terms of inflation. And with the Middle East war going on and volatility in oil prices, it's very uncertain in terms of where inflation is going to go from here.
Nuveen Sarah Malik interviewed on Surveillance. Keep it locked in to Balance of Power, by the way, for any and all developments out of both Washington and the Middle East. I mentioned oil rallying today. Right now, crude, West Texas Intermediate, $84.99 a barrel, up 7.2%. The oil majors all surging. ExxonMobil up 3.2%. Chevron up 2.7%. ConocoPhillips up by 3.8%. Lots going on. Fed Wednesday, worth repeating that. Joe Matthew, that is a Bloomberg Business Flash.
Yeah, you said it. Happy Fed Day, Charlie. Is it going to be happy? We'll find out in a couple hours. I just bumped into Michael McKee. He had his briefcase, and he was on his way over to the Fed. Well, the Treasury is where they do this, right? But he'll be talking about this, of course, with us a little bit later on in the broadcast. We'll get, of course, the announcement on interest rates. We'll get the policy statement, and there will be a news conference today. We'll take it live as part of our special Fed coverage. That begins at 1:30 p.m., the news conference at 2:30, and we'll have all the voices you expect and trust here on Bloomberg as we watch the markets crumble today. This is pretty ugly, with the VIX now suddenly above 20, and we're all looking at oil. As Charlie mentioned, we're above 7%, and I guess it shouldn't be a surprise based on the news that we received overnight. So thanks for joining us here on the Wednesday edition, each day feeling slightly more important than the last, even though we don't have a sense of exactly where we're going from here. But we're live for you on Bloomberg Radio. We're streaming live on YouTube, where you can dial us up by searching Bloomberg Business News Live. And we are once again straddling both ends of Pennsylvania Avenue with our eyes on the Middle East. The president will be speaking later on today. There's an event at the White House about 3 hours from now with the Treasury Secretary, and they're going to be talking about one of our favorite topics here in the Washington area, and that's how to get rid of or somehow renovate Dulles Airport. They're getting rid of the people movers. And if that's not something we can all agree on, I'm not sure what we have left. But when the president talks to reporters about this, surely he'll be asked about what's happening in Iran. Surprise attack is the headline we wake up to this morning. Saudi Arabia in the subhead. And if you're like me and you grew up in the 1980s, that was the recipe for World War III, right? The U.S. starts bombing Iran and Saudi Arabia gets involved in the Middle East? How do you get out of that? The president doesn't have an answer yet, but he is pretty angry. Let's just set the baseline. We heard from CENTCOM a while ago. In fact, it was late last night when they told us that the Islamic Revolutionary Guard Corps launched multiple ballistic missiles from Iran in an attempted surprise attack on U.S. forces based in the Middle East. All Iranian missiles were successfully intercepted. Pretty impressive. U.S. forces remain vigilant, it says, at a high state of readiness. Yeah, attempted surprise attack is the language we're going with here. Now, the U.S., of course, had paused the back and forth for some time. I guess we have let go of the pause button here because the president is promising something fierce after the U.S. and Saudi Arabia, in response to more than 30 drone attacks directed by the IRGC, got in the air together. Saudi fighter jets alongside Americans, pounding targets in Iraq. These are Iranian-backed militias, or as CENTCOM put it, Iran-aligned terrorists doing the work for Tehran. President spoke with Fox News. Wow, can't read it on the air. We'll be hitting them hard. We hear they're going to be getting a beating, he said. We're going to beat the effing S out of them. The President of the United States telling Fox News. It's right here in black and white, with lots of dots in between. So what's about to happen? At times like these, we turn to Becca Wasser, and I'm glad to say she's back in our Washington bureau. Leads our defense analysis at Bloomberg Economics. And Becca, it's great to see you. I'm just curious, were you modeling an event like this with Saudi Arabia's involvement when you were at the Pentagon?
I mean, it is a long-standing tradition of U.S. military warfighting to fight alongside allies and partners in coalitions. In fact, this war actually stands apart in that it was launched with only the United States and Israel. So here, the U.S. has fought alongside Saudi Arabia in the past, but the Saudis haven't been quite as active in previous coalitions, like the fight against the Islamic State, where they have contributed some military and financial support, but not necessarily flown sorties alongside the United States.
So this is the first time we've seen them put jets in the air and fire missiles?
Well, at least in more recent memory, that's for sure. And the U.S. has trained them. They have U.S. fighter jets, they have U.S. training, and they've also learned during the campaign that they waged against the Houthis in Yemen during the Yemen air war, little bit in like 2015 or so.
Got it.
So Saudi Arabia has learned on the fly, but that doesn't necessarily mean that they are at the same level of prowess as the U.S. military.
Okay. Are they flying F-15s? Is that the most advanced aircraft they have? This is a few generations behind what we've got for our best.
They've got their own specialized version, the SA, so that's what they've largely been flying.
And we're training them, or we have trained them, but I guess your point is these are not the top guns who are flying for the United States in the region. Are they helpful, or is this more about presenting the united front?
Whether they are helpful or not, let's put that aside. But the fact that they are entering the fray, they are directly taking responsibility for their own security after being hit. They are contributing to a fight, albeit a fight against IRGC-backed militias, as opposed to against Iranian targets directly. But they are contributing, and that is what we are starting to see, which is a widening of this conflict. There have been reports of other Gulf states contributing to strikes on on Iranian targets. We've also seen a broadening of geography. The Red Sea is now in play. And now, frankly, you have parts of Lebanon, Yemen, and Iraq that are now party to this broader conflict.
Assuming the pause is off here, should we stop calling this then the U.S. war with Iran? This is the Middle East war, isn't it?
We'll see where it goes, but right now it still is the U.S.-Iran war. Those are the two primary belligerents. But, you know, I think our longstanding call at Bloomberg Economics is that this is a protracted conflict, a long conflict that's going to ebb and flow in fluctuation. And part of the histories of protracted conflicts is that they almost always expand geographically and in the number of parties involved. And that's what we're starting to see play out here.
Fascinating. The two primary belligerents. Someday I want to be able to talk in the lingo like the defense analysts around here. Ben Jensen was hailing Kayleigh Lyon's use of opportunity cost yesterday. You guys have your own glossary, which I'm fascinated by.
So does the president with his terminology about strikes.
Okay, glad you brought me there. So when we talk about the effing and the S and the rest of it,
those are doctrinal terms, by the way.
Okay, that's good. Are we talking power plants, bridges? What can we actually do to inflict harm that has not been felt?
Well, it's a question of whether you want to inflict that level of harm, right? Because power plants, bridges, they could be for military use, but they are also for civilian use. And that puts the U.S. in a very potentially dangerous footing. So yes, there are plenty of different targets that the U.S. could go after in terms of continuing its air and missile strikes that would ratchet up the pain on Iran, but it would also ratchet up pain on Iranian civilians. And it's an open question whether the U.S. wants to go down that route. Additionally, the president has said before that, you know, all options are still on the table, and that includes other efforts, potentially trying to move towards escorting ships in the Strait, potentially even a very big operation that would either be, you know, a strike, say, on an Iranian nuclear facility, or even an operation to reopen the Strait by force, which would put U.S. boots on the ground and be incredibly costly in terms of blood and treasure.
Which we've discussed before as these are the options, the menu of options before him. When we spent time with Mike Pence, the former vice president, last evening, he kept saying, you know, they don't come to the table, we'll do it the hard way, kind of like President Trump says, and we'll finish this for them. But is that what you're describing? Boots on the ground, forcibly open the Strait, occupy Karg Island? That's the full effect?
I think that's right now probably the highest escalation option on the table, but that doesn't mean that it's going to, you know, finish the job and bring Iran to the table. It could actually backfire and put the U.S. On the path to this being a true forever war, because when you see U.S. ground forces often go into countries, it's a long time before the U.S. Ends up coming out, and we are sometimes looking at years, if not decades, if you want to look at Afghanistan.
Good God. Well, then it's the definition of quagmire. Becca Wasser does this for a living, and we're lucky to have her in our bureau with Bloomberg Economics, leads our defense analysis. And Becca, it's great to have you back. Thank you so much. With much more to discuss, and we shall over the course of the program, with the impact of this war on energy, something that we're going to get into straight ahead with John Bozzella. As we turn to the auto industry, the CEO of the Alliance for Automotive Innovation is coming up next, right here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Down and to the right, lows of the day right now on the S&P 500 index. Let's get right to the numbers. S&P down 80, drop there of 1.1%. Dow Industrials down 916 on the Dow, a decline of 1.7%. NASDAQ down 341, down 1.4%. And the NASDAQ 100 index is down 1.6%. Traders sending stocks lower. Oil is jumping. The market bracing results for results from big AI spenders, namely Meta Platforms and Microsoft. Right now we have got the SOX, the Philadelphia Stock Exchange Semiconductor Index, down 4.6%. The VIX above 20. The 2-year 4.33%. We've got a Fed decision coming up at 2 o'clock Wall Street time. 10-year 4.65%, and the 30-year 5.12%. Spot gold now at $4,014 the ounce, down 0.4%. Crude is surging 6.7% on WTI, $84.59 a barrel. Brent 90.42, up by 7.5%. President Trump says the U.S. will hit Iran hard after a recent attack targeted a military base in Jordan. That's why oil is surging. Bears repeating on WTI, up now by 6.7%, $84.55 a barrel. After the bell, we will be hearing from both Microsoft and Meta Platforms ahead of earnings. Meta down 0.8%, Microsoft up 0.4%. Tomorrow, Amazon and Apple. Amazon down by 1% right now. Apple now in the $5 trillion club. Apple up right now by just about 0.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pallett. That Joe Matthew is a Bloomberg Business Flash.
All right, my friend. Thank you, Charlie. He'll be back in about 20 minutes with more on the markets as we connect the dots here between Washington and Wall Street on Balance of Power. Thanks for joining us. I'm Joe Matthew in Washington. It's interesting to see what's holding up in this market today. I mean, this is brutal. You get the Dow down 900 points, and you wonder if anybody's buying anything. They are. They've been buying the automakers. GM was positive until, of course, I mentioned this 2 seconds ago. It's down a fraction right now. But look at Ford after earnings, up 3.5% in a market like this. And it has a lot to do with the SUVs as opposed to the EVs. Similar narrative coming from both companies. Remembering that President Trump was actually out at GM at the testing facility there last week. Remember we talked about the proving ground? Pretty cool, by the way. You know, they did a drag race for the president. Must have loved this stuff. We saw images of him there. They put a Hummer up against an Escalade. What's more fun than that? Actually, they put a Corvette up against a Hummer. I'd show up for that too. Maybe we'll have some results for you on this drag race. But the president was making the point that this is a business that America is invested in and is growing in this environment. Here's what he said.
We're building more auto factories and more plants than at any time in the history of our country. Today, I'm proud to say that the auto industry is back and America is back, and it's pulling Detroit and Michigan along with it. I placed historic tariffs on foreign producers and manufacturers, including a 25% tariff on foreign automobiles, something that no other president had the courage to ever do.
Remembering that gave automakers some heartburn. The idea of retooling factories, moving production lines. Of course, a lot of this runs into the USMCA, which makes it a little bit easier for a General Motors or a Ford. But we want to talk about some of these issues and the new effort to keep Chinese-made cars out of the country, which is something that's been cooking on Capitol Hill. The bill just cleared committee last week, as we told you. John Bozzella is with us, the president and CEO, Alliance for Automotive Innovation. John, it's great to see you. Welcome back.
Good to be here, Joe. How are you?
I'm great. I got to tell you, I looked this up because we covered this the day it happened. James, I don't know if you saw this, but the 1,250 horsepower Corvette, this is a ZR1X, decisively beat the Hummer. I guess maybe we shouldn't be surprised. But the Hummer easily outperformed the Escalade. I'm not sure if there's a life lesson in there, but I kind of wish I was at the drag race. Were you at the track that day?
I was not at the track that day, but I would love to.
Super cool facility. This is like where the first rollover test took place. They got 150 miles to drive whatever they want to do out there. And the president did have a pretty good story to tell. How are these companies putting up numbers like this in an environment like this where a year ago we were talking about the potential for a catastrophe beginning with the tariff regime?
Yeah, I think there's one word to describe it, and it's resiliency. I think the companies are resilient. I think the customer is resilient. And so what's happening is companies like General Motors and Ford and Toyota and others are having to navigate a challenging and complex industry, and they're doing it really well because they have products that customers want and need, and the market's holding up pretty well.
And they're answering demand, we're told, by turning back to the old-fashioned ICE product like an SUV. We're at $4 and something a gallon, and people can't seem to fill the tank fast enough. What do you make of this?
Yeah, I think, well, that's certainly...
Is that not true?
That's part of the top line, but let's unpack it a little bit.
Sure.
There is no question that SUVs and pickup trucks are selling. But what we're also seeing is compact SUVs and small pickup trucks are outselling large SUVs and large pickup trucks. What we're also seeing this year so far is a downward trend in the sale of ICE vehicles and an upward trend in the sale of hybrids and a little bit of BEVs.
Interesting.
But like we're at a historic low with regard to the sales of internal combustion
hybrid
engines.
is what is filling the gap.
Hybrids are filling the gap.
Interesting.
Yeah.
Does that play into the price of gas? I'm just calling up AAA here. It $4.09 today. We've seen worse, but this is historically an issue, and you've got diesel over $5, which is a completely different conversation. But is it changing people's buying behavior?
I think it is. I think that's like this trend of more hybrids has been going on for some time.
Sure.
But it's clearly, there's a lot of opportunity for customers to get what they want with a more efficient powertrain.
Okay. I want to ask you about this move to keep Chinese-made vehicles out of the country. I went to Capitol Hill last week to talk with Senator Alyssa Slotkin, who was the Democrat on the bill, along with Senator Moreno, was the Republican. They both joined us initially when the bill dropped. We spoke with her the day it cleared committee. Here's what she had to say.
This wasn't targeted at any one car company. We want them to continue selling cars in the United States of America. We really just say, like, you can't have a serious influence from the Chinese Communist Party in what you do in America.
Interesting.
And those cars are driving surveillance collectors. I can't, as a former CIA officer and as a Michigander, in good faith, say that they should be sold in the United States.
All right, so she's talking about more than, BYDs. There are cars that people might not be thinking of, like Volvo, have a majority ownership by a Chinese entity. Mercedes. Do there need to be waivers for companies like this, or do they need to start moving things around in their ownership structure?
Yeah, it's a good question. And it's a little bit different for Volvo versus Mercedes. So Volvo is already subject to current regulation related to connected vehicle technology and potential influence from China. And what the regulator did is provided Volvo with permission to stay in the market, right? So they analyzed the situation and they negotiated and drew a conclusion that Volvo was okay to operate in the market. What the bill that Senator Slotkin and Senator Moreno were sponsoring would add, in addition to the regulation, a new ownership threshold, and that threshold would be set about 15%, and that's what would bring Mercedes in, and in that case, they would be regulated just like Volvo is, and they would have to go through that process with the regulator. Could they achieve a waiver? I would imagine they could.
That is a possibility, according to both senators.
Of course.
Would you like to see that happen? They're all part of the alliance, right?
Yes, they are all part of the alliance. This is a very challenging set of issues. We have companies on all sides of this, companies that think there should be a threshold, companies that think there shouldn't be a threshold because the agency is capable of making these decisions on a case-by-case basis. This is why we have policymakers, and this is why we depend on the leadership of Senator Slotkin and Senator Moreno to make the right political decision based on the equities as they see them.
There are questions about what it is we're trying to keep from happening, because you can't buy a Chinese car in this country. Is there a belief that if this bill were not passed, that someday you will have a BYD lot in Northern Virginia?
I think that's part of it.
Or wherever.
Look, we have strong tariff protection right now, right? The U.S. government has concluded that vehicles from China represent unfair and discriminatory competition. So that's the 301 tariff. The agency has concluded, the Commerce Department, that this technology is a surveillance and national security threat. So that's what creates the market as it is today. What the legislation does is tighten those regulations up and maybe reduce some of the flexibilities and loopholes that might be available to a future administration.
Because your fear is having a Chinese-made car like a BYD or having a Chinese part in a seemingly non-Chinese car that might be a listening device.
There's two concerns here. One is competition's got to be fair and reciprocal. When it's fair and reciprocal, companies here can compete with companies anywhere. So that's the first point. The second point is, yes, this national security and surveillance concern must be addressed. And by the way, the Chinese have similar rules.
Let's talk a little bit about the rest of the industry here, because we're in an environment with high gas prices, as we're mentioning, high oil prices, and a trade agreement with Mexico and Canada that's up for renewal. The White House doesn't seem too eager to renew it. This will keep extending and rolling year after year if we don't do something about it. How important is it to the auto sector that we renegotiate and renew the USMCA?
It is absolutely critical that we conclude a new trilateral agreement between the U.S., Mexico, and Canada. Absolutely. Think of it not just as a trade agreement. Think about it as a competitiveness platform. This is critical to create Fortress North America to be able to compete against China and to be more competitive vis-a-vis China. And so it's that important.
Does that keep automakers protected otherwise from tariffs that might force them to move manufacturing lines?
I think it's critical because right now what we've had over the last 26 or 27 years is duty-free, seamless trade that has allowed the companies to optimize labor, energy, production, and innovation to create affordability and choice for consumers. In the U.S., that's a wonderful thing. We need more of that, and that's what the trade agreement does.
What's it like when you go to buy a car? Do you like, you're like, I'm not getting the undercoating. I know this game, you guys. You must be the best guy to go car shopping with, right?
I'm maybe the second or third best.
Yeah.
I do enjoy it. You know, I learn a lot from our dealer partners every time I go into a dealership.
You go knock on Don Byer's door to talk about it. What do you think about buying a car online? Would you ever do it?
Certainly research.
I can't imagine that, by the way.
Certainly research,
sure. But people are ordering a car online, it shows up in the driveway.
You know, I'm a kick the tires guy.
You want to go take it out for a test drive, right?
I do.
Do you take the guy with you on the test drive, or do you demand the car on your own?
No, always.
You don't want to be alone in the car?
No.
Really?
Well, it's not that I don't want to be alone. I want to.
You don't want this guy breathing on you.
I want to give a running commentary.
Okay, really?
Wow. I'll give the feedback.
Would you come with me when I buy my next car?
I'd be delighted.
All right, this is the deal. We have this on the air. You got the date, James. This is great. I'm glad you came to see us once again.
Joe, thank you.
Because we have a lot of important issues to talk about when it comes to USMCA. The impact of energy prices, they all converge on your business. It's really something.
No doubt.
Cars are America, I guess.
Indeed.
Something like that. John Bozzella, you can steal that if you want. Alliance for Automotive Innovation. It's great to see you. Thank you, sir, for coming with us. You never know who you're going to meet here in the Washington Bureau at Bloomberg. We will assemble our political panel next. We've got a lot more to talk about, including two important confirmations. One of them's already done. Jay Clayton has the keys to the intelligence apparatus. We'll have that next, right here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Fed Wednesday, we've got the Dow, the S&P, NASDAQ very much in the red, off-session lows, but still looking at a almost 1% drop now on the S&P 500 index, down 70 points to 73.58. The Dow down 861 points, lower by 1.6%. NASDAQ Composite down 1.1%. NASDAQ 100 down 1.4%. Traders are sending stocks lower as oil jumps. Also, the market is bracing for results from big AI spenders. And of course, 2 o'clock Wall Street time, we will have a Fed decision. Right now, we have got the SOX, the Philadelphia Semiconductor Stock Index. It is down another 4.4%. All of this with a VIX right around 20, a 2-year 4.33%, the 10-year 4.64%, and the 30-year 5.12%. Gold now at $4,017 the ounce, down 0.3%. West Texas Intermediate crude surging 6.5%, 84.45 a barrel. Brent crude 90.26 barrel of Brent, up now by 7.3%. So again, coming up in 1 hour 19 minutes, we get the Fed decision. Former Kansas City Fed President Esther George is expecting the Fed to be on hold today, but she says she'll be focused on Chair Kevin Warsh's communication.
While you're going to stop short of giving forward guidance, I think it's always helpful to be clear about what you are looking for. So today, I think, will be important to listen to what is the rationale, how is the committee thinking about the current state of the economy.
Former Kansas City Fed President Esther George interviewed this morning on surveillance. Ford shares are up 3.3%. Ford has raised its profit outlook for the second time this year as consumers continue to buy the automaker's high-margin SUVs. Again, Ford right now up by 3.3%. BMW has reached a deal with workers to offer buyouts across Germany, also to cut about 8,000 jobs globally as sales plunge in China. BMW ADRs today, they're up by 0.8%. Recapping, S&P now lower by 1%. West Texas Intermediate crude 84.45 a barrel, up by 6.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
All right, Charlie. I've told people, Charlie, before about you. You travel around the world as a daring, not tourist, but traveler with a deep interest in aviation and have flown into some of the most wild airports, in fact, the most dangerous airport in the world.
Absolutely right. That was
Charlie.
Lukla, Nepal. One fantastic trip. I'm big on infrastructure, too. I seek out the stations, the trains, the sewage plants, the city halls. I love seeing stuff like that.
That's right. See a sewage plant with Charlie Pellet. But no, I'm just wondering, I bet you're one of the guys who likes Dulles Airport. Am I wrong?
Without a doubt, absolutely right. And I'll tell you why, and I know exactly where you're going with this. One of the few places where you can ride a people mover. We used to have those at JFK, by the way.
So, look, if they had actually fulfilled their original purpose in design, the idea was to have a mobile lounge, right? You would get into this thing after you left the terminal. It would drive you to your plane. They were going to rise up. You walk on the plane. It would be super cool. But they never did that, Charlie. And now all they do is drive around in circles, sometimes bump into each other.
Well,
and the president today is announcing a renovation to finally get rid of them.
Let me up the ante. Do you ever think we'll have a day, and I don't think we will for a number of reasons, but how cool would it be to have the nose of the aircraft actually pull into the terminal so you can get out without a jetway or a bridge? Think about that.
Wow.
And another innovation happening in your old stomping ground of Massachusetts, getting you from the middle of Massachusetts out to Logan. You handle your TSA ahead of time, get on a bus, and then you've already cleared security. Just amazing.
Listen, I'll meet you on the Logan Express anytime you want. If they can do that for me, that's a deal, because I have to go like an hour outside of Boston to visit.
Well, if you're free this weekend, we could do a sewage plant together.
He's the last of the romantics, everybody. Charlie Pellet with thank you. He'll take you out on a people mover.
My pleasure.
Sewage plant. I don't know. So here's the plan, by the way. CBS was the first to report this. Washington Post did some other reporting as well. A new Dulles, this is a $22 billion renovation. Refurbish the interior. He wants to keep the slanted roof, you know, the sloped roof main terminal. It is pretty cool. So sort of Jetsons architecture. Scrap the mobile lounges and install a new underground U-shaped aero train. I don't know why it's not just a train. An aero train to bring travelers to their terminals, along with moving sidewalks. I'll go to Dulles anytime if you guys work all this stuff out. If you're with us on 99.1 here in Washington, we see you. Now, the president's going to be rolling this out at 3 o'clock. He's got an event in the Oval with Sean Duffy. They're going to have, I'm sure, schematics and artistic renderings talking about the airport. And I suspect they'll be talking about Jay Clayton, assuming reporters get questions, and Todd Blanche. This is getting interesting. It seems Dulles Airport and the people movers are not the only thing President Trump needs to worry about. He may have messed with the wrong Texan. Enter John Cornyn, quote, "Maybe they think I'm just going to give up or, go along. But they are mistaken." The outgoing Republican senator from Texas, the man who could have been majority leader, is the reason why the president cannot get Todd Blanche confirmed as Attorney General. Maybe Tom Tillis would say the same thing, but John Cornyn is in the lead here. These are the two YOLO senators who have nothing to lose. Cornyn saying less than 24 hours before a critical committee vote for Blanche to become full-on Attorney General that he is not prepared to support this confirmation until he gets paper. He wants it in writing that there is no anti-weaponization fund. And this is where we start with our political panel. Bloomberg Politics contributor Jeannie Shanzano is with us, her Democratic analyst, democracy visiting fellow at Harvard Kennedy School's Ash Center. And Katie Frost is back, Republican strategist, political director at the American Principles Project. Great to see you ladies both, and thank you for being with us. Jeannie, I don't know if you've ever been stuck on these people where they'll drive you around all day if you don't, and they slam on the brakes, everybody goes falling down. Is this not the bipartisan move that the president needs to make right now?
Yeah, infrastructure is always popular. But Joe, what is a U train that is an aero train? I'm confused by that thing you described.
That aero train.
So I don't know, but I'm with Charlie Pella all the way. Charlie is the best. So if Charlie says we go to Logan, we go to Logan, and they keep the people movers at Dulles.
All right, fine, done. How do you make Todd Blanche Attorney General while you're at it? The president has the airport figured out, I think.
Yeah, that he's got a tougher job with Todd Blanche. No, so what I understand now is the meeting they were supposed to have today, which was supposed to wrap this thing up, because we know that the committee needs to know by 4 o'clock if the markup is on for tomorrow, has now been canceled. And John Cornyn seems to be telling reporters on the Hill at this moment that the DOJ, Todd Blanche, have not done enough to assuage his concerns about this $1.8 billion fund and the fact that it is clearly and officially rather dead. And so we also, I understand, have Todd Blanche on the Hill right now. So I don't know, Joe, maybe this goes forward, this meeting, and they get what they want. But we are down to the wire now because they need to know by 4 o'clock. And I think the ball is now in Todd Blanche and the DOJ's court. Do they put this in writing or not?
Yep. Katie's got Hartfield Jackson down there. You get on that tram. I've spent more time on that tram than the Amtrak to New York. I'm riding around. How many terminals are in this thing? Weigh in if you want, Katie, but I'm wondering what would keep the DOJ from presenting this in writing if nothing other than the president?
Well, you have a bunch of attorneys in a room, so they're going to make sure and be very careful what they put in writing. But look, this meeting needs to go forward, and obviously they want to move the nomination, and hopefully it'll be more efficient to move the nomination through the Senate than the people movers are at Dulles. I say this, I'm a Reagan girl. That's my airport of choice for D.C. But yes, I was pretty much raised at Hartsfield Jackson. So whenever people complain about their airports, like we have the busiest airport in the world in Atlanta, and we still figure out a way to make it efficient. Once you learn the map, it's super easy. My record is 7 minutes from the curb to the jetway. So Atlanta's
all right. Well, I need a lesson. I'll take Katie through the air. The old people, we still call it National Airport, but that's a whole other conversation. I want to ask you about Jay Clayton. This is interesting. He got the keys, Jeannie, and maybe we shouldn't be surprised. It was a party line vote, 51-47, but now there's talk of delaying his swearing in. If we believe the reporting by Politico, Bill Pulte this was the acting, the housing guy, is urging the president to delay Clayton swearing in or at least try to stay in the job longer so he can finish the job of firing people or I guess reorganizing the department. He's laid off a significant number of folks in the intelligence community. Jeannie, should he be allowed to continue?
Well, it's really up to the president and when this swearing in occurs, and that Politico story was just fascinating. They're talking about this bromance between Donald Trump and Bill Pulte, which we know has been going on for a long time, and that Bill Pulte really wants to stay there so he can finish the job that Donald Trump gave him, which includes the firings that you mentioned, these social media posts, declassifying material. And even when Clayton is sworn in, we are hearing that Bill Pulte doesn't want to go too far, and I don't think he's going to. He also would like a cabinet position at some point, so he's angling for that. And he is the sort of darling of the MAGA right at this point. And so I don't think he's going anywhere. But what's fascinating in both of these nominations, Joe, is the fact that it is the 2020 election that has sort of held up, certainly still holding up Blanche's, and made it difficult for Clayton to get his nomination forward. So we are still talking about an election 6 years ago, and that is still impacting these nominees for the president.
Yeah, it's kind of wild to think. Is there a cabinet position for Bill Pulte that you can imagine? Katie, what are they keeping him on ice for?
Well, it'll be interesting to see because it's not uncommon that you see there's some turnover after a midterm election. That's not to be unexpected. We've already seen 2 members of the cabinet leave for various reasons, and I would anticipate 3, and I would anticipate potentially a couple more after the midterms. So we'll have to see. But if you think about it from a perspective of being a businessman, I understand why Pulte would want to finish the job, so to speak. He goes, look, I came in here, I'm reorganizing this agency, and I want to finish what I started. And when you realize that the Director of National Intelligence's job is to oversee 18 intelligence agencies, I'm sure there are plenty of redundancies there that could definitely be eliminated, and that's what he's been focused on. But let's pay attention. Who wants to go back home to their state that's currently in the administration? Who potentially sees maybe a Senate opening or a gubernatorial race that they want to run for and leave the cabinet? Then that might be an opportunity for Pulte to slot right in. He already has the relationship with the president. He already has relationships with other cabinet members. It would be an obvious choice.
Yep. Just keeping him in the orbit, Katie. That makes a lot of sense. How about Chief of Staff, Jeannie? Susie Wiles not be around forever, and this post-midterm world that the president will be living in, I don't know. I could envision this. How about you?
I could certainly envision it, particularly after the midterm election. I don't think it makes much sense to begin with, but I could see it after the midterm election. But let's remember, Bill Pulte is in there, as Katie mentioned, rightly so, 18 intelligence agencies and 0 intelligence experience. And that is the real concern for all of us. At a time when the United States is at war, he wants to finish a job that deals with an election 6 years ago and reorganizations and firing. And we are in war, and the president needs the best intelligence. He doesn't need somebody who's going to tell him what he wants to hear. He needs to hear the truth, and he needs it from somebody with experience and somebody with a background in intelligence. Bill Pulte has none of that. He is a friend of Donald Trump's. He has engendered himself to Donald Trump, certainly, but that doesn't make you qualified to lead U.S. intelligence.
Well, he's certainly a loyalist, and we'll see what comes of this with our political panel. They'll be back with much more in our second hour. You guys are great. I'll meet you both at the airport. We've got a lot to figure out here. The president will be talking about Dulles coming up at 3 p.m. Eastern. That's Katie Frost, our Republican strategist, Jeannie Shanzano, our Democratic strategist and Bloomberg Politics contributors. We'll catch up with you guys in about 20, 30 minutes here in our second hour on Balance of Power. Even less than that, as a matter of fact. We've got something important coming up. Kaylee's going to join us, of course, as always, and jump in the pool here along with our global television audience. And we have an important conversation coming up as we'll be joined by the Energy Secretary. Chris Wright is in Kentucky right now for a story that you might have heard about earlier today on Bloomberg. This is the new data center project that NextEra is involved in, a $100 billion deal that we're going to be talking about with the Secretary of Energy. Brookfield and NextEra with a $100 billion data center campus, just as the AI trade is unwound on Wall Street. I'm Joe Matthew in Washington. Glad you're along today on the fastest show in politics, and we'll have much more, as I mentioned, in our second hour. The panel will return, and we'll also talk with Anna Wong as we count down to the Fed. We'll be in special coverage just about a half an hour from now, only on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Fed Day edition, as oil prices kick higher on new strikes in the Middle East and a Federal Reserve looking warily at rising prices. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, remarkable to see Saudi Arabia enter the fight for the first time, which is why we're seeing a sharp jump in crude oil prices today.
Yep, Saudi Arabia joining with the U.S. on strikes against an Iran-backed militant group in Iraq. This follows the surprise attack, as the U.S. described it, that Iran launched at U.S. forces in the Middle East. And that is why President Trump is now promising to respond, saying in an interview that he's going to beat the effing S out of Iran.
That is the quote from the interview with Fox News. He's made similar threats, of course, to Iran. We don't know exactly what form or shape that will take, but we'll be watching watching closely, just like the markets are. We're seeing 7% increases in crude oil here. Of course, gas prices will likely follow, and it's part of the reason why, of course, rising prices are bringing us to Kentucky coming up this hour as the Energy Secretary cuts the ribbon effectively on what will be a new data center project powered by nuclear.
Yep, $100 billion. It's a NextEra and Brookfield joint venture, and we'll talk with the Energy Secretary, Chris Wright, about that. And of course, as we're having this conversation around utility costs, around gas costs, it all points to inflationary forces at work, and that is what the Federal Reserve is grappling with as we speak. We are just an hour away from that rate decision, which actually is a live one. The market thinks that there is a greater likelihood the Fed's going to hold, but they haven't ruled out a hike entirely.
Yeah, more uncertainty than we've had in some time for a Fed meeting, which is why you'll want to be here for our special coverage that starts in just a half hour's time. So we've got a lot to talk about.
Indeed, we do. And let's check on how the markets are shaping up outside of oil ahead of the Fed's rate decision as we turn to Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee and Joe. Yes, we are looking at a down day here, perhaps putting it mildly, with an almost 800-point drop right now on the Dow Jones Industrial Average. We're at 51,965 on the Dow, down 781 points, a decline right now of 1.5%. The S&P 500 index is down 56. For the S&P, a decline of 0.8%. NASDAQ down 0.9%. Traders gearing up for the Fed decision. Oil is jumping. The market also bracing for results from two of the biggest AI spenders. That'll be Meta Platforms and Microsoft after the close of trading right now. Microsoft higher by 0.5%. Meta lower by under 0.1% right now. And of course, Amazon and Apple rounding out four of the Mag 7 names tomorrow. Again, we've got the NASDAQ 100 index down 1.1%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down now by 3.9%. And all of this with the VIX. The VIX currently just below 20. Your 2-year, 4.33%, with the 10-year, 4.64%, the 30-year, 5.12%. Gold is up $2.50 the ounce, little change, flat on the day at $4,031. But crude continues to be an ongoing major story right now. WTI 84.49 a barrel, up 6.6%. Barrel of Brent crude 90.47 now. Brent surging 7.6%. We'll have a whole lot more on the energy outlook for you coming up in just a moment when we speak to Energy Secretary Chris Wright. President Trump, meanwhile, says the U.S. will hit Iran hard after a recent attack targeted a military base in Jordan. The latest clashes have caused Brent crude oil to surge, taking oil majors higher. Shares of ExxonMobil, they are advancing today, along with ConocoPhillips and Chevron. Right now, we are looking at ExxonMobil shares. They are gaining today by just about 3% on shares of ExxonMobil. Some of the other stories that we're following for you. DoorDash building its own delivery drones. It has gained the necessary approvals to operate them commercially. It is the latest in its effort to delegate more orders to robots as a way of cutting delivery times. And Caterpillar shares are falling today. They are plunging down by roughly 6% after Baird cut its recommendation on the industrial giant and slashed its price target. So again, recapping here, we are looking at a down day for the Dow, the S&P, and the NASDAQ Composite Index. The NASDAQ 100 Index lower now by 1%. S&P 500 Index down 7%. That crew quote bears repeating. 84.52 on WTI, up now by just about 6.6%. Recapping, Fed decision coming up at 2 o'clock. I'm Charlie Pellet, and that Joe Matthew and Kaylee Lines is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much indeed. As Charlie was just running us through, this is a market that is braced not only for a rate decision from the Federal Reserve, but also is waiting and watching to see what happens in the Middle East as the U.S. is promising to retaliate against Iran, potentially more strikes on the way after Iranian missiles targeted U.S. forces in Jordan. That is why we are seeing, as Charlie mentioned, higher oil prices today, back above $90 a barrel on Brent crude, with a lot of volatility obviously having happened in the energy space, and a lot of those higher energy costs having shown that they were feeding through into inflation when they were on the rise. They have led to lower inflationary prints most recently because gasoline prices dropped so steadily, but it's very uncertain as to what the trajectory will be, and that is why it's such a tough call for FOMC members as they make their rate decision today, knowing that this is supply side problems that higher rates can't necessarily solve for, and yet if they want to promise that they're going to beat back inflation, it may lend credibility if they go ahead and hike rates.
Well, they're going to be looking at the core as well, but surely questions are going to be centered around this very issue when reporters like Michael McKee have a chance to go back and forth with the chair. We're going to bring all this to you live, as we always do, beginning with the decision at 2 p.m., the news conference at 2:30. Our special coverage starts less than a half an hour from now, live from New York. Kaylee, these stories all collide somehow when we talk about energy prices, and you introduce the idea of data center, which many believe is driving electric bills higher, and it started a conversation about a closed circuit around these facilities. And here's a new take on this. You probably heard about the NextEra story. It was out first thing this morning. NextEra teaming up with Brookfield to build a $100 billion data center campus. In this case, though, it's going to be run by a nuclear facility in Kentucky. They're basically relighting a nuclear plant powered by uranium that will be home to a data center campus.
Yeah, so this is a generating plant that is coming with it. It all feeds into this ratepayer protection notion we've heard so much from the president about. He was just at the EPA last week announcing an expansion of that ratepayer protection pledge. He essentially wants these data centers to be bringing their own power, to be insulating everyday consumers from the higher utility costs that could come with them.
This is down near Paducah. The Paducah Gaseous Diffusion Plant, and the Secretary of Energy is there right now because the administration is very much supporting this effort. We're glad to have Chris Wright with us. Mr. Secretary, welcome back to Bloomberg TV and radio. It's good to see you, and it looks like the weather's nice today in Kentucky. This plant made uranium for the U.S. during the Cold War, privately funded. So I'm curious, what is the extent of government involvement and exposure here other than simply transferring the site? Is that why you're in Kentucky?
Yeah, I'm here. Joe, you summarized it well. We're here just to celebrate the Department of Energy is leasing these federal lands to multiple private companies to build some new nuclear technologies, as you spoke about. Also to build 2 gigawatts of new natural gas power generation that'll serve both a 1.2 gigawatt data center that'll be built here. That's the majority of that $100 billion. But also to add 800 megawatts of additional power onto the grid here, which will benefit all of the surrounding states. This is sort of a cornerstone move of the Trump ratepayer protection pledge, driving prices down and industry and job creation up.
As I'm sure you're well aware, Mr. Secretary, there is a live conversation happening in and around financial markets right now as to whether there is overinvestment happening into artificial intelligence and the infrastructure that powers it. If we're building perhaps too many data centers. And I wonder, Mr. Secretary, if you can still hear me, if there's a concern here that if it is in fact an oversurplus of data centers, is the power that comes with them going to be pulled off the grid as well, or is this power that stays?
Say overinvestment. I'm sure overinvestment in artificial intelligence, and then it
All right, it seems like the Secretary is having a little bit of difficulty hearing us. We'll try to reestablish that connection, Joe, but this is obviously the conversation that you've been seeing happen in real time in a lot of these technology stocks in particular, the notion that perhaps all of this investment isn't necessarily going to pay off, and that certainly is going to be front and center as we consider the hyperscaler results that we're going to get after the bell today. The market is going to be watching their CapEx numbers, perhaps forecast CapEx much more closely than even the earnings themselves on some of these very concerns.
That all starts tonight. Of course, Microsoft is going to be the big one we're looking at with Meta. We've got also Amazon and Apple coming up all in the next 2 days. Interesting, NextEra was holding up pretty well. It just turned slightly negative. When I saw $100 billion in that headline this morning, I thought it would be an excuse to sell because that is the fear, right? We keep dumping money into this thing and all of a sudden it's like we were laying fiber in 1999 again. The fact of the matter is, though, Kaylee, we wake up every day to a deal like these. It's just part of the news cycle right now, and these hyperscalers are committed. The question is, for how long, I guess?
Yeah, and will the market continue to tolerate that commitment or punish them for it further? Those are certainly the questions that the market is contending with, not even including the political considerations around this, which, of course, come back to the notion of power and utility costs, hence the ratepayer protection pledge. We were just hearing the Energy Secretary discuss, and Chris Wright is back with us now. Mr. Secretary, I apologize for the technical difficulties here. My question to you was around this notion that we're over-investing in data centers, that too much is being poured into the infrastructure. And I wonder if it does turn out that we have a surplus of these, if you expect the power that is being generated by them as part of these large projects is going to stick, that won't ultimately leave the grid if we see some kind of data center collapse.
No, it definitely won't leave the grid. In fact, it's one of the great things data center development is doing is it's funding and underwriting the development of so much new power generation capacity. Look, I think the upside for artificial intelligence is tremendous, but if there did turn out to be overinvestment and surplus of artificial intelligence, we would love to have the extra power. That'll allow reshoring manufacturing in the U.S. and continual downward pressure on electricity prices.
Interesting, Mr. Secretary. The NIMBY issue is one I'm sure you're familiar with, and I wonder if what you're announcing today in Kentucky is an answer to it. This is sort of the ultimate form of a closed-circuit data center from what it sounds like. Would that include water as well? Will you have your own water supply for this campus?
Absolutely. But as you know, a modern data center uses precious little water. These closed-loop cooling systems, you know, you build a giant data center and it uses as much water as a McDonald's. So we do have water supply here. We are building new power generation. But you're right, using federal lands that was already an industrial site during the early part of the Cold War and repurposing it for a data center, tremendous community support to have that development going on here. And we are doing this at multiple locations across the Department of Energy, taking old industrial sites, bringing development to communities that are hungry for these investments, for these tax dollars, and for these job opportunities.
Well, yeah, how much opportunity is there, Mr. Secretary, to tap federal lands further? Where should we be looking for the projects of the future?
There's a lot of them. You know, we have 17 national labs and then additional federal sites. So we announced a big one in Portsmouth, Ohio. We have this one in Paducah. You'll hear about one in South Carolina. You're going to hear about one out in Washington State and Idaho. So we have a lot of federal lands, and there's a lot of interest to develop. And again, not just data centers and power production, but right here in Paducah in Kentucky, we're going to have a new company called General Matter is developing modern uranium enrichment, essentially a more modern way to do what the giant buildings down here were built to do, to fuel the commercial reactors that are coming in the nuclear renaissance. So a lot of new technology and industrial development across our country.
Well, we don't see those buildings behind you right now, Mr. Secretary. If you're watching Bloomberg TV right now or with us on YouTube, you see Chris right in front of a beautiful open field with some trees. What's the timeline? How long will it take for you to get this site up and running and actually producing electrons to create whatever this data center will be cranking on?
So the data center should be under construction in the next 6 months. There actually is construction already underway. You can't see it because it's off to my right and not in your camera. There's already 100 acres under intense development right now to build new uranium enrichment capabilities. And then the power generation and data center will come on in phases over the next 4 years. But simply a large commercial development already started here in Paducah, Kentucky. And this is, again, what the Trump administration is about. Let's build additional energy generation to put downward pressure on prices. And with that additional power we're going to generate, let's bring American jobs, American industrial might, and lead artificial intelligence right here in the United States of America.
Well, of course, utility prices are one thing. Prices at the pump, Mr. Secretary, are another. And we have seen those climbing back above $4 a gallon as we're seeing oil prices today once again spiking as the president's threatening to hit Iran hard once again. How high realistically should we expect prices to go if there is no immediate reopening of the Strait of Hormuz in the near term, if the diplomatic process is indeed not going to be successful and we see a return to military action?
Well, if there's military action, it's relatively brief. We are using the United States military today to escort out oil and natural gas out of the Strait of Hormuz. That actually has gone remarkably well. Little reported in the news, and probably that's because we don't talk about it too much. But we are restoring supplies of global oil and refined products to the world out of that region. independent of
how much
whatever
supply,
Iran
sir? Do you
agrees to or
have an
doesn't agree
updated
to.
number for us in terms of how much is actually getting through the strait?
So a 7-day trailing average right now out of the Arabian Gulf region is 13 million barrels a day. About half of that flowing through the strait and half of that through bypass pipelines. So we're about 2/3 of the delivery of oil out of the Arabian Gulf region as we were before the conflict started.
That's really great information, Mr. Secretary. And I wonder your thoughts on what is now the involvement of Houthi rebels from Yemen creating a potential second choke point, as we've discussed, in the Red Sea. This is something that Saudi Arabia had already tried to pipeline around with regard to the Strait of Hormuz. Is there a bypass to the bypass, as Javier Blas put that you're talking to Saudi Arabia about, where additional pipe could be installed to get around this second choke point?
There is a bypass to the bypass called the Suez Canal. So you can go across to the Red Sea, and instead of going south down to the Bab el-Mandeb, you can go through the Suez Canal. That is happening as we speak. There's both oil tanker capacity through the Suez, and there is a pipeline that follows the same route, both of which will be employed to divert more oil that way.
Well, of course, as we consider the supply of oil, we also have to factor in the reserves that the U.S. has and that the rest of the world has been tapping into over the last several months as this conflict has been ongoing. Mr. Secretary, we know the SPR is at the lowest level in 4 decades, more than that. And I wonder how much lower realistically it can be allowed to go, where the operational floor is and what the plan is if we reach it.
Oh, we are a long way from the operational floor. I've heard some people that don't understand, not you, but I've heard people who don't understand how the SPR works saying, oh, it can't go below X amount of barrels. That's just not true. They seem to misunderstand that it's just oil in these caverns and otherwise it's air. All of these caverns are full of a combination of water and oil, and they are always 100% full. We just use the water to displace the oil out of these caverns. But with the planned sales we have, which will run into this fall, we'll still have meaningful supply, over 200 million barrels of oil in our SPR at the end of those releases. And what's great about the releases we're doing through the Trump administration is we're not selling these barrels, we're trading them. At the end of the day, these releases will add more than 40 million barrels a day to the storage in the SPR after the conflict than we had before the conflict started. These are additive, not subtractive.
We're looking at $4.09 a gallon on average nationally today, Mr. Secretary. Is it even possible to forecast where we'll be by the end of summer, by Labor Day?
It's not possible to forecast, but look, all I can say is gasoline prices today are $1 a gallon cheaper than they were 4 years ago in the Biden administration. That was just about a war on fossil fuels and selling fear. Here we are ending Iran's nuclear ambitions, ending a 47-year conflict.
Well, it had to do with the war in Ukraine as well,
and we
right?
still have gasoline prices. That didn't interrupt the flow of oil. It was just the fear of the interruption of the flow of oil. The Biden administration feared that Russia would slow their exports of oil or refined diesel, and the Russians did not reduce their exports. Just fear and bad management. They drained the SPR and they sold those barrels and didn't replace them. So misunderstanding energy and selling fear has not been effective. The Trump administration's about being honest, about being fact-based, about solving our geopolitical problems and balancing our energy markets. I'm confident we will see gasoline prices continue their long-term trend downward later this year. And of course, we are working every day to lower prices for the American consumers.
Well, you mentioned there, Mr. Secretary, finally, the question of Russian diesel, which now is not being exported because so many refineries have been targeted by Ukrainian drone strikes. I understand that for most gas that consumers are seeing at the pump, it may be one thing and you may expect prices to go lower. But is the same to be said for diesel, which also powers a lot of our economy?
No, you're right. Ukraine's attacks on Russian refineries have reduced the supply of diesel globally. It's reflected in prices. the best offset we have to that is the American refining complex. We are refining today more diesel, more gasoline, more jet fuel than ever in American history. And America has been the savior for world energy markets during this crisis and will continue to do so. But yes, of course, we want to see diesel prices come down, increasing the throughput from the American refineries, something the EPA and the Trump administration is working with our refiners to just, again, move towards more common sense regulations on how refineries operate. That's allowing increased output. But to truly get diesel prices down low again, that'll take another year or so of President Trump's leadership. But the trajectory will be downward with diesel prices, downward with gasoline prices.
All right, we'll leave it there. Mr. Secretary, thank you so much for joining us. The Energy Secretary, Chris Wright, joining us live from Kentucky at the site of, again, a $100 billion data center project being spearheaded by NextEra and Brookfield. And as we reflect on our conversation with the Secretary, we turn now to our political panelist, Jeannie Shanzano, a Bloomberg Politics contributor, Democratic analyst, and Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, joins us alongside Katie Frost today, Republican strategist and political director at the American Principles Project. Katie, I'd like to come to you on where we began our conversation with the Secretary around the issue of data centers, on the costs associated with them, and pushback that we are seeing from the American electorate. When we were with you in Georgia for the primary, we heard a lot about data centers and how unhappy voters are with them when they come to their communities. Is what the Energy Department is supporting here that they're doing and making sure it generates its own power and using federal lands to do it the answer?
I think it'd be an absolutely fantastic solution. Potentially, we need to see how these projects play out. But, you know, Joe correctly said, it's the ultimate NIMBY issue, not in my backyard. We all need data centers. We need that energy. We all, whether we say, oh, I don't use AI, well, just because you aren't using ChatGPT you create an image, you're using AI one way or another. It's being integrated into everything we do. So we need to have data centers, but they need to make sure it doesn't have a disproportionate impact on the community around them. So I'm from Georgia. As you're talking about, we were here, my home county of Coweta County recently rezoned 829 acres of rural farmland to accommodate a new data center project that's coming in. Eminent domain has been used to take the land around it to run the power lines, and that has created massive pushback within the community. But if this is being put on federal lands and all of the power was being self-contained, I think you'd have a dramatically different reaction. So I'm glad to see this innovation coming out of the Department of Energy and think it really could be a fantastic solution going forward.
What's your take on this, Jeannie? If this is an issue that Democrats plan to seize on, we've already got a data center moratorium in your state of New York. What's your reaction to this approach? A campus that's self-contained, off the grid, closed circuit. Is that what developers can walk into a town hall meeting and sell?
I think it's going to depend on how this is rolled out. You have real questions, Joe, about are they bypassing the public in doing this? Are they taking into concern the public's reaction to this and how it impacts them? Because while these are federal lands, they are surrounded by communities of Americans who remain concerned about these projects. There's also the issue of transparency. You've got people saying that developers have signed non-disclosure agreements with local officials, keeping residents in the dark. You've also got resource constraints. And, you know, you mentioned New York, but let's just look at Florida. You have somebody like Ron DeSantis saying American citizens, or in his case, Floridians, shouldn't be paying one more dime to subsidize tech billionaires. And so all of those things remain, whether you're on federal land or whether you are on, you use public land or private land. So these concerns remain, and it's going to depend an awful lot on how they're rolled out and how the community is educated on the impact. But I have to agree with DeSantis. Americans should not be paying to fund tech billionaires. These things are draining resources and costing Americans. And that's why I agree with Hochul on the moratorium. So you figure out the best way to roll this out that's to the benefit of everybody and not to the benefit of the very, very wealthy tech billionaires.
And finally, Jeannie, well, we did talk to him about that and utility costs. There is the question of gas prices as well. And he said he can't forecast what they will be come Labor Day or perhaps where they will be come November. Is that not the biggest problem for Republicans right now, is that they aren't able to say definitively that Americans are going to see lower prices at the pump by the time they go to vote?
Yeah, I mean, it's an enormous problem for them. The prices are really, really impacting them at the polls. The war is wildly unpopular. And of course, a lot of that is tied to the price of gas and oil. And, you know, as we listen to the administration, not only can't they predict what the prices will be, they can't predict how we see this war come to an end. And that remains an enormous albatross hanging over their head as they march into the midterm.
All right, Jeannie, thank you so much, as always. Jeannie Shanzano helping us walk up to our Federal Reserve special coverage, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Thanks as well to Katie Frost, a Republican strategist from the American Principles Project. I'm Joe Matthew alongside Kaylee Lyons in Washington. The countdown now set, 5 minutes away from special coverage, a half hour away from breaking news from the Federal Reserve. And we're joined in our Washington bureau by Anna Wong, Bloomberg Economics chief U.S. economist. It's good to see you, Anna. About a 30% chance, we're told, of a hike. Do you roll your eyes at this, or is this a real possibility?
I think it's a possibility for sure. We have seen that Kevin Warsh has reduced forward guidance, and that's the reason why there's such a big fat chunk of distribution thinking that he might move. Our baseline view is he won't move because we did have very soft inflation data, payrolls disappointed. His task force will only be reporting results at the end of this year, and I think so. And there will be a major downward revisions to inflation in September. So I think he would be pushing to buy 2 more months of time for a rate hike.
So if a hold it is to be, how hawkish can a hold be?
Well, I think the fact that there is a July press conference is a signal of how hawkish it is. So suppose that there's no rate hike as we expected. Based on what Kevin Warsh has said, there shouldn't be a July press conference at all, because he used to say that if there's nothing important to say, then you shouldn't have it. So the fact that he is hosting one suggests that he will convey the degree of family feud. The meeting today, he said there will be a good fight. If he convey in that meeting that, in fact, a sizable majority wants to hike, then it basically is a signal that September would be live. And if inflation and payrolls data did not turn out favorable for a hold, then there will be a hike in September.
How do we factor in politics into that dynamic, though? You're creeping up on a midterm election and a president who doesn't want to see rate hikes at any time of year. The chair must be aware of this, and that's what's got this narrative started in some corners, that this might be his last chance.
Yeah, so one of the often recited argument for hiking today is that he wouldn't be hiking closer to the election. Yeah. But the economics don't work that way. So based on our examination of the time it takes for a hike to transmit to the economy, it's actually 3 or 4 months. So if you start hiking today, it actually hits right before the election. So it just means that the only, if election is a consideration, the only time to hike is after the election.
Well, that doesn't leave very much time if there's officials who want to see a hike in the calendar here, 2026. Can I also ask, Anna, if the president primarily wants to see mortgage rates go down, if the Fed were to hike today, could it not actually have the effect of suppressing the long end, because it shows that they're serious about the inflation fight and actually potentially lowering the rates, at least that the president cares about?
Yeah, I think there are many things to think about and how to push the long end down. Part of it is credibility. But when you look at inflation expectations, including the 10-year inflation compensation, it's actually been going down since Kevin Warsh has become the Fed chair. So really what's driving the long end up is a bunch of stuff, including tariffs, because the fact that tariff revenues are down and the refunds, 80 billion of tariff refund has happened so far this year, is actually causing people to be more worried about the fiscal situation that is independent of inflation credibility because I think right now Kevin Warsh already has a lot of that.
So since we are having a news conference today, what would you ask the chair if you had the chance?
I would ask the chair that what does he think about the speed of transmission of policy, like whether the Fed staff is telling him that in fact there's monetary policy is long and variable, and then or whether it's short and fast.
Mm-hmm. Well, especially when we consider that the transmission can only transmit so much into areas of supply-oriented areas of the economy, like in energy. If we are to see a reigniting of what's happening in the Middle East and it drives gas prices and oil prices higher, how does a Fed hike materially change that, Anna?
Not much. In the Fed internal models, this is why I would ask Warsh this question, because internal Fed models would say if they hike into a typical gas shock, oil gas shock, then the impact on bringing down inflation is nil, like 0.1 percentage point for a 75 basis point hike, whereas it will do a sizable damage to unemployment rate and growth.
Interesting. Peter Navarro was making that point on our air on Friday, and it was interesting to hear him speak to this concern about a hike at this meeting. So we're about to find out here, Anna. It's great to have you on Fed Day. Anna Wong, Bloomberg Economics, our chief U.S. economist. We'll hand things over to our special coverage in New York in just a moment. Of course, Kaylee will get the news at 2, the news conference 2:30. We're going to have a lot to hash out with McKee at 5.
Yeah, we certainly will, knowing President Trump is going to be speaking at 3 p.m. It's about upgrades to Dulles International Airport here in the D.C. area, but he very well could be asked a question about the Fed's rate decision, especially if it's one that he might not want to see in the form of a hike. Jury's still out. We'll find out in 29 minutes.
He may not need to be asked based on what we've seen in the past, but we'll find out together. We'll unpack it all on the late edition of Balance of Power at 5. A special edition of Bloomberg Surveillance, The Fed Decides, starts after this, only on Bloomberg.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
We're live on TV and radio, counting down to another Fed rate decision and Fed Chair Kevin Warsh news conference. That decision is 30 minutes away. That news conference about an hour from now. This one feels a little bit different. Typically, you know with conviction what the outcome of any meeting will be. They guide you towards it. They hold your hand. This is a different moment. There is just a little bit of two-way risk.
And just to cite Goldman Sachs, they said the idea that there's a 30% chance of a rate hike is so unusual to have that kind of uncertainty heading in that it would be the largest surprise, regardless of what they do, since 1997.
My operative word is mysterious. I think there's all sorts of mysteries. Explain a press conference to me. Are they going to get to McKee? Is he just going to say, okay, I took 7 questions. See ya.
So first point, TK, I'll say this. We're getting a news conference, and that was news about a week ago, so that's good. How long that news conference will be, I really don't know. But I think there's a third act here, and you and I were talking about it earlier on this week. Typically, at the ECB, you would get a statement, a news conference, then a few hours later, sources. What am I talking about? Sources will speak to a media publication and tell you what really went down in that meeting. And I think the next 2 weeks is going to be key, because in the next 2 weeks, you'll hear from the other officials on the committee about what they really think. So if Kevin Warsh doesn't explain where we are, doesn't articulate a reaction function, if you don't get that from the Fed chair, you'll get it from others.
Especially if there are dissents, as many people do expect. So you expect to hear from Lori Logan and Beth Hammack, who have been incredibly hawkish going into this. Is it just 2, or potentially are there more? Also curious to see whether the bias has shifted to people who believe that there's going to be a rate hike to a greater degree than at the prior dot plot.
Scope and scale, John, before we get to these great conversations, I'm going back to October of 1979. To me, it's the most mysterious meeting since the historic first Volcker inflation meeting. We don't have a clue what's going to happen.
The good news at 2 p.m. is it's easy. The statement is really short, and you go to the bottom. You look for the dissent, right? You look for the dissent if you don't get a decision that says anything but unchanged. This from Governor Waller. Sternly staring at inflation until it melts before our withering gaze is not an option. Put that together with the last line of the last statement: the committee will deliver price stability. Is it enough just to say it, or do you have to do something about it?
Or do some people have to say that they would have done something about it? And Kevin Warsh continued to talk about task forces, and is that enough? I'm curious to know whether this is also going to be 130 words long, or if we're going to get a longer or shorter potential version versus the more than 300-word statement that we got earlier this year. Look, it is unclear to know exactly how this is going to play out. There clearly is a family flight taking place, and clearly a lot of people are looking for a sense of what their framework is.
Let's get to the market, Bramo. Equities this afternoon. Your equity market a bit softer. We're down by 0.6% on the S&P 500. The slide continues on the Nasdaq beyond day 5. The Nasdaq 100 is negative 0.8, and the Russell gets involved as well. We're down by 1.2 on the small caps. In the bond market, 2s, 10s, and 30s. 2s just hugging 430. We're anchored around that rate. Yields up this morning by 3 or 4 basis points. That move continues this afternoon, and crude is not helping. Brent and WTI spiking earlier on today. Brent back in the 90s.
Putting all of these things together, especially understanding exactly how the Fed is going to look at this, coming up shortly. JP Morgan's Bob Michael, SocGen's Subhadra Rajappa, and Bank of America's Aditya Bahave. They will be taking us up to that potentially 130-word Fed rate decision and statement at 2 p.m. Eastern. Then immediate reaction from Jim Bianco of Bianco Research, Diane Swank of KPMG, and Crossmark's Victoria Fernandez, and finally breaking down Chair Warsh's news conference, Apollo's Torsten Slok, and Stephanie Roth of Wolfe Research. Wonderful. I cannot wait.
Looking forward to that. What a lineup. Joining us around the table, Bob Michael of JP Morgan. Bob, good afternoon. Good to see you.
Happy to be here.
How easy is this one to predict?
I think it's actually pretty easy. I don't know what's changed since the last FOMC meeting. If you look at inflation, where they focused us, we got CPI. Year over year, core CPI was actually a little bit better than the expectation. It's at 2.6%. But if you look at core PCE, it went up a tick. It's at 3.4%. That's kind of a wash. You look at the labor market, sure, there was some improvement when you look at average hourly earnings and the unemployment rate, but non-farm payrolls came in at half what the expectation was. So all of it looks like kind of mixed to me. I don't think you do anything.
Do you think you need to hear from Kevin Warsh what his reaction function is, given the fact that a lot of people are saying it's one thing not to have forward guidance, it's another thing to not understand the Fed's response mechanism?
Yeah, we don't know what he's reacting to. I guess we can spend the next few years trying to figure it out ourselves, but it would be nice if he can tell us what he's prioritizing. Is he prioritizing inflation not at 2% for this period of time is unacceptable? Rates have got to start going up and start that process. If he hikes rates today without any sort of guidance in the past and without anything changing, then I'm going to think his reaction function is just loss of patience and frustration. That's bad for central bankers to have that out there.
Tell me about the JP Morgan economics view. What's the key distinction Feroli and companies see into this meeting?
Well, what they're frustrated by is the lack of a reaction function, particularly without the forward guidance, as Lisa said. I think they also look at everything, and they don't see the need to do anything. When we look at the statement, it will probably characterize the economy as solid. They're expecting the second half of this year for real GDP to come in at 1.8%. That looks more stable to me than solid. I don't know that the Fed has anything to do today.
Let's bring up the bond curve, and let's look at the very front end of the curve. 2s at the moment, 433. Yields higher by some 4 basis points. We've been talking about this on Bloomberg Surveillance all week. The difference between that at the front end of the policy rate right now, let's call it 50 basis points. Is that a bet on a rate hike or the risk of one in the yield curve? How would you frame things?
Yeah, the market's pricing in about 2 rate hikes now. And you can go all the way out to the 10-year. You've put 100 basis points between the Fed funds rate and the 10-year. To me, you're pricing in close to 2 rate hikes. Whether that starts today, whether it starts in September, or whether it starts in 2027, the market's a discounting mechanism, and that's the expectation for the next rate change.
If the Fed pushes back against that expectation, is that bullish or bearish for long-term bonds?
I think it's going to be bearish. I think then the market's going to start anticipating that maybe the Fed's not as inflation vigilant as it should be. Why push back on the prospect of rate hikes over the next 12 months? Just leave them there and see if inflation actually does come your way. Then you have a chance to go back to the market and help pull that out. Right now, there's no indication that inflation is going to pull back sharply anytime soon.
Could we do the show? Can Mr. Warsh have a press conference given the war in Iran? Just the headlines coming out about Iran. Oil popping $5 here, $5 there. Is this just a wasted exercise because of the uncertainty, the cacophony of news flow?
I don't think the press conference is 100% guaranteed today. Again, I don't know.
What do you mean by that?
Sure, everyone's been called to a press conference. You can hand out the statement and the announcement could be, there is no new news,
John,
there is no press conference. I think that would be
we'd
awesome.
Have to fill a lot of time.
We'd have to stop him from leaving, cancel Bob's
We'd
car.
have to start talking soccer.
I walk back to my office.
Are you suggesting that is actually a possibility, or are you just joking?
I'm more joking than not, but I sit there and I wonder, he said, unless there's something new to say, there's no point saying anything.
Lisa said the same thing this morning.
There is nothing new to say. What is he going to say?
Who was at Jackson Hole? Were you at Jackson Hole? Were you there, John, when it was like a 9-minute speech?
Yeah.
And we were all having coffee.
You're talking about the Payne speech?
Yeah.
From Chairman Powell a few years back. What would you do if this was really short? Would you be comfortable with that? It just came out, read the statement, took a few questions, walked away?
I guess I've just gotten my head around that Fed chairs are allowed to structure the Fed, all the different task forces, everything that comes out of it, however they like. You have to give them the tools to put in place what they think is best.
Do you think this market has internalized a Fed that's no longer going to hold its hand?
Yeah.
You think we're done with that?
Yeah. And look, was it holding our hand? I take exception to that.
Oh, do you
really? They put out a view, yeah. And when there were times to push back, like in 2021, 2022, we pushed back hard. Did they listen to us? A little bit late.
It felt like hand-holding at the worst of times, didn't it?
Well, it was at those times. When it was necessary, they did that, and probably the Kevin Warsh Fed would do the same, and that's the real question. Is this a moment that requires hand-holding? No. So they have the luxury of not necessarily holding the market's hand. However, there is a difference between holding a hand and providing some sense of exactly what the framework is for the Federal Reserve to act. And if they don't have that, then the accusations of political interference start to get louder.
Well said, Bramo.
Thank you.
Bob Michael at JP Morgan's going to stick around for maybe an hour longer, or two, depending on if we get this news conference 50 minutes from now. I hope we do. That decision is about 18 minutes away. In just a moment, we'll catch up with Subhadra Jaffer of SocGen and Bank of America's Aditya Barfe. We'll do all of that and more. We're doing the market lower by 0.7% on the S&P 500 and bond yields higher by 3 basis points. Your 2-year, 4.32.
When news breaks,
in comes the car into Downing Street.
Bloomberg has you covered.
Andy Burnham arriving.
For all the context and clarity you need.
A broad vision here. You
Hear it first.
I'm David Huston. Join me each week on Wall Street Week for stories of capitalism. This week, Harvard's Jason Furman on the Fed decision. The European Union moves to reform its merger regulation, but will it get the tech industry going? Johnson & Johnson gets into the robotic surgery business a bit late, but with what it thinks is a better mousetrap. And what are all those think tanks doing?
We don't go up to Capitol Hill. We don't tell the government what it should do.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
This is the first time I can really remember going into a meeting with this much uncertainty.
The market is struggling to figure out what the correct policy course going forward is.
The market's not ruling out July, and
I will show you how to get the
There's
best
not an urgency for the Fed to hike.
I don't think there's going to be any Fed action.
This meeting puts them on a hold.
The meeting this week is likely a no action.
I don't see the rationale for a rate hike. The bar for hikes is relatively low.
I don't think that the Fed is going to hike rates, this year.
I think the inflation data the next couple months can get us to price out those hikes.
We have no strategy, no playbook from Warsh.
We really have no idea how Kevin Warsh thinks about monetary policy.
Chair Warsh does not want to communicate.
He listens to everyone, he finds a consensus, but he will set the policy out.
The statement could be pretty interesting this afternoon.
Today, I think, will be important to listen to what is the rationale, how is the committee thinking about the current state of the economy.
Consensus view, overwhelmingly no change. Conviction levels really, really low going into this one. 15 minutes away, your market looks like this. Equity slide on the S&P 500, negative. Down across the board on the S&P. On the NASDAQ, we're heading towards a 6th consecutive day of losses on the NASDAQ 100, the longest since October 2022. In the bond markets, 2s, 10s, 30s, yields elevated. It's been a feature of the year so far. We're holding on to these higher and higher levels. 460 on 10s, 430 on 2s, north of 5% on 30s, and crude is contributing to the move. WTI and Brent this morning higher off the back of renewed attacks overnight, continues this afternoon, up by 7% on Brent, back in the 90s. The shock in energy, the shock in rates. The good news for this Federal Reserve, no growth scare just yet for this economy.
Yeah, the good news for that, as well as the latest CPI and PPI data, which is incredibly dated, was better than expected, a little bit more disinflationary. Does this give them a pause and a breathing space? Can I just say, everyone's saying that Kevin Warsh has a communication problem. It sounds like everyone's feeling very frustrated. There needs to be a market-fed therapy session, and maybe we'll get that today.
Oh, is that what this is today?
I think so.
I don't feel that. Bob seems pretty chill.